Hello everyone, I hope you guys are doing well and studies going in full swing. This is an important video where we are going to do the marathon for your CA Final FR. We would be covering all the topics, all concepts and also the questions. The topics we would be discussing from our shield, but nevertheless we will have a general discussion, so even if you don't have a copy for the same, that's fine. And the questions we would be discussing from the Super 99 questions file that we have shared. You can find the copy for the same on the Telegram channel, the link for which is there in the description. So we will kind of subdivide this video into two parts. We will cover the important topics in the first section and then we will do all the other Ind ASs in the other section. So the first section will comprise of topics like share-based payment, financial instruments, business combination, consolidation, Ind AS 115 and 116. That is the first part, approximately half of your paper, and all the other Ind ASs including the theory topics in the second part, the remaining 50% of your paper. So let us get started. The first topic that we will start with is going to be share-based payment, Ind AS 102. So over here the accounting for share-based payment is covered by Ind AS 102. The standard over here covers share-based payments to employees as well as other than employees. It covers equity-based share-based payments like ESOP as well as cash-based share-based payment like a SAR. So when you look at an equity-based share-based payment, let us say to an employee, you create what you call as an SBP reserve. This SBP reserve is to be shown along with other equity, and because it is a part of other equity, it cannot be remeasured. The measurement for the same will be based on the fair value as on the grant date. However, SAR is shown along with liabilities, and being a liability, it will be remeasured at fair value at each balance sheet date. A few important terms that you should be aware of is the grant date, which is the date when all the terms are finalized, at least for an employee share-based payment. Vesting refers to entitlement, and the period that has to be covered for the purpose of vesting is called as a vesting period, after which you are entitled to the options. Exercise period starts after the vesting period, and this is a period when you can exercise for the options. Valuation happens by something called as fair value, which is typically given in the question, and the fair value can be measured by an option pricing method like a Black-Scholes model or a binomial model, as the case may be. Usually the ESOP valuation will happen based on fair value only. There's also something called as intrinsic value, which is calculated as a current market price and on the date when you're doing the workings minus the exercise price. The only relevance of intrinsic value is if there is a SAR at the time of exercise of SAR, the payment will happen based on the intrinsic value. So when you look at employee share-based payments, the timing at which you will record will be usually over the vesting period on a straight line basis. However, if the options have been immediately vested, then you will record it immediately. In case of measurement, you will always measure these options at the fair value as on the grant date. There will be no further remeasurement, at least for ESOP. For SAR, it will be fair value based on each balance sheet date. These are fair value of the options. You will not look at the fair valuation for the employee service. If you look at the journal entries over here, typically as and when service is rendered, you will say employee benefit expense account debit to SBP reserve or SBP liability as the case may be. If it is a SAR, SBP liability. If it's an ESOP, then SBP reserve. You will record it on a pro rata basis, on a straight line basis over the entire vesting period, and whatever is the employee benefit expense will be taken to the profit and loss account. At the time of exercise, if it is an ESOP exercise, you will have bank account debit with the exercise price, SBP reserve account debit with the fair value, to share capital to securities premium. In case of a SAR, that is cash settlement, share appreciation rights, it is SBP liability account debit to bank. And in case of lapsing, in case of an ESOP, you will debit the SBP reserve, take the credit to retained earnings, whereas in case of SAR, you can take it to the statement of profit and loss. The important point that you have to remember is you have to take the number of employees that you expect to continue till the end of vesting period for the purpose of this measurement, and remember the estimate of the number of employees can very well keep on changing. Okay. Next, when you look at reassessment, remember for SAR, that is a cash settled plan, you will try to remeasure the liability at each balance sheet date during the vesting period and even during the exercise period for the unexercised options. So this will be measured based on the fair value at each respective date. However, if a few employees exercise the options, then the payment to the employee will be based on the intrinsic value at the point. Not very important is share-based payment to other than employees. For goods or services, the timing of recognition will be when the risk and reward of the goods is transferred, and for services as and when services are rendered, and the measurement will typically be based on the fair value of these goods or services, and if they are not determinable, only then will you go to the fair value of these shares. Here the concept of grant date and measurement date is slightly different. Like in case of an employee share based payment, the grant as well as the measurement date is the measurement date for the purpose of fair value is the same as the grant date. So over here, the fair value will be based on the grant date. However, when you look at other than employees, then the fair value will be measured on the measurement date, which is different from the grant date. Grant date is a date when the agreement is entered into for buying goods and services, whereas the fair value is measured on the date when the risk and reward of those goods, let us say, are transferred. So the measurement date and the grant date can be different for other than employees. Now, a very interesting discussion over here can be for a possibility of a barter. When you look at a barter, typically we say that we buy the machinery and we, let's say, give another land or something, in which case Ind AS 16 applies. However, if we buy a machinery and settle it by issuing our own shares, then Ind AS 102 will apply, in which case the measurement of the machinery received will be based on the fair value of the machinery received and not based on the shares given up. Remember, in general, barter of Ind AS 16 says you will measure it based on the fair value of the assets given up. However, that is if Ind AS 16 applies. If the settlement in case of a barter happens through own equity instruments, then Ind AS 16 does not apply. In fact, Ind AS 102 applies, whereby the machinery that you are acquiring will be based on the fair value of the shares that you are issuing. Okay. Next, you have something called as group share based payment, that is parent issuing shares in the SBP plan of the subsidiary or subsidiary issuing shares in the SBP plan of the parent. In which case, in the SFS of, for example, the parent or the subsidiary, what will be the entry? So, if it is parent issuing shares in the SBP plan of the subsidiary, in the books of the parent, there is no employee service. However, there is an investment in the subsidiary indirectly. So, the entry will be investment in S account debit to, let us say, SBP reserve. But in the books of the subsidiary, there is no shares to be issued. However, there is employee service and hence EB account debit to, let us say, capital contribution from the parent. So, these are the two new line items. If subsidiary issues shares in the SBP plan of the parent, in which case this is like a dividend paid or a dividend received transaction, and as a result in the books of the parent it is like dividend received. So that is employee benefit expense account debit to dividend income, and in the books of the subsidiary it is the other way around, it is dividend distribution. So dividend distribution account debit, let us say, to SBP reserve. One needs to remember that this is a treatment in the respective SFS. When you are preparing the CFS, these individual line items will internally cancel. So investment in capital contribution will cancel, dividend received and dividend paid will also cancel, and hence in the CFS you will not have these separate line items. Okay, a very important area in this chapter is cash plans with equity settlement alternative. Here you are giving the employee a choice on whether they can exercise in equity or they can exercise by cash. So if they are exercising, for example, in either of the two, we don't know ultimately the employee will take which of the two choices, and hence at the grant date we will have to measure how will you treat this plan. The standard says you will treat this plan as if it is a pure cash plan with an equity option. So if it is a pure cash plan, you will treat it as a pure SAR. However, it is added with an equity option. So you will have to measure the fair value of the equity option. Now, how are you going to do that? On the grant date, for a single employee, you will say that what will be the fair value if that single employee exercises the equity plan. Second, you would say that what will be the fair value if that single employee exercises a cash plan, and hence the difference between the two on the grant date is the additional value of the equity option. Going forward into the vesting period, you will try to do the expenses as if it is a pure SAR. So you will remeasure as if it is a cash plan based on the fair value at each balance sheet date, and apart from that, the fair value of the equity option will also be recorded on a pro rata basis. So you will have EB account debit to SBP liability for the SAR and to SBP reserve on account of the equity option. Now at the end, once the employee decides to exercise, if they decide to exercise in the form of cash, then you will settle the liability, SBP liability account debit to bank. The balance in the SBP reserve will be transferred to retained earnings from one component to another component of equity, whereas if they decide to issue in shares, your entry would be SBP liability account debit, so the liability is foregone. SBP reserve also account debit to share capital to securities premium. So the institute's current material allows you to take it into securities premium as well, though in the earlier material you were taking it against the retained earnings. Now both the alternatives are possible, but if given a choice, you will take it against the securities premium because shares have been issued. Okay, scope exclusions, there are 3 points which are not covered under Ind AS 102. If you are issuing shares to shareholders in their capacity as shareholders, like bonus or right shares, not covered. Second, you are issuing shares as a part of business combination, Ind AS 103 as a part of PC, not covered. And third, if it involves settlement of non-financial items which are going to be settled on a net basis, it will be covered under 109, and that is not covered. So these are the 3 areas where you are not covering. A few detailed workings over here. Special cases will involve vesting conditions. Vesting conditions are conditions to vest or entitle. It can be let us say service conditions, which is linked to service, let's say 3 years, 5 years, or performance conditions. Now within performance conditions, you have to see whether it is market linked or non-market linked. If it is linked to the entity achieving a certain level of market price or market price growth, it is called as a market linked performance condition. Whereas if it is linked to an entity not necessarily attaining a specific market price target, but some other factors like sales, production, etc., in which case it is other than market. So the accounting for the two will be different. So if it is a non-market linked performance condition, the accounting for a non-market linked performance condition is a very logical accounting. At each balance sheet date, you will try to gauge whether the estimate, whether there will be actual vesting or not. If there is likely to be an actual vesting, you will try to refine your estimate that when will the vesting happen. So your estimate of vesting period can possibly change at each balance sheet date. However, when you look at a this is for a non-market linked performance condition. If it is for a market linked performance condition, the standard says that there would be no separate remeasurement of the vesting period after the date of grant. So you will take the estimate of the vesting period as it is expecting as on the grant date, and there will be no possible change. The logic over here is that the fair value is based on the market price, and if the market price estimate cannot change, then other things like vesting period, which are also linked to the market price, also cannot be changed, and hence you will continue the same vesting period. The only exception to this would be is if actual vesting happens before, let us say, the period estimated under the market linked performance condition, then in the year of actual vesting, you will recognize whatever is the remaining employee benefit expense. In other cases, you will not change the vesting period or the possibility of vesting. You will take the same vesting period and possibility of vesting as you had determined as on the grant date. This is for a market linked performance condition. If it is a non-market linked performance condition, then you will keep on changing this at each balance sheet date as well. So this is one possible thing. Next, you have subsequent modification. So there is two cases over here. One is there is possibility of a modification and there is possibility of a cancellation. So when there is a modification, it is a change typically of exercise price. There are two ways you can possibly reduce the exercise price, reprice it, reduce the exercise price. Now typically this is beneficial to the employee. If it is beneficial to the employee, we treat it as if it is a new plan. So remember, your existing plan cannot be remeasured, and hence even if there is a modification that is at a later date, you are trying to change the exercise price, you will not touch the accounting for the existing plan. You will treat it as if the existing fair value of the existing option will continue to be spread over the existing vesting period. No change in that. Second, when you are trying to find, let us say, a modification, in case of a modification, you will try to find the incremental fair value, and this incremental fair value will be spread over the remaining vesting period. Now, how do you find the incremental fair value? It is a fair value of the modified plan as on the modification date minus fair value of the original plan also as on the modification date. The difference between the two is the incremental fair value which you spread over the remaining vesting period. This is the thing that you do in case there is a modification which is beneficial to the employee. If there is a modification which is adverse to the employee, you will still continue to record the original plan in the same way, no changes. However, in the new plan, the incremental fair value will be negative. Now that does not really make sense, and hence there will be no separate recognition for the so-called new plan because it carries a negative, that is a zero incremental fair value. So this is provided it is adverse to the employee. Okay, then you look at cancellation. Cancellation is treated as acceleration of vesting. Cancellation does not mean lapsing. Cancellation means that earlier I was thinking that if you serve with me for 3 years, I will give you, let us say, my shares, my options. However, after 1 or 2 years, I decide I don't want to give you these. That means I'm breaching my contract. And if I'm breaching my contract, probably I'll have to pay you a cash compensation. So I'm still paying you. So it is not like lapsing. I'm still paying you, and hence for employees who are there with me till the end of, let us say, the second year, that is the date of cancellation, to these employees I will have to pay the cash compensation, and hence this is treated as acceleration of vesting. So first point, you will treat it as shortening of the vesting period. So on the point of cancellation, you will record whatever is a EB. Second, when you pay the cash compensation to the extent of the fair value as on the date of cancellation, you will adjust it against the SBP reserve. The excess, if any, of your cash compensation will be adjusted against the profit and loss. Now there's a possibility that after doing all of these adjustments, you still have some balance in the SBP reserve which will be adjusted in a way against the retained earnings, transfer from one component of equity to another component of equity. And then there is a graded vesting. Graded vesting would mean phase wise vesting. So let us say there is one plan of 100 options where 20% of the options will vest if you serve for 1 year, another 30% vests if you serve for 2 years, another 50% serves if you vest for 3 years, if you stay for 3 years, in which case you will treat it as if there are 3 plans of 20 options, 30 options and 50 options respectively, and then do the working for these 3 plans separately. So this is the entire roundup in detail of your share based payment section. So if you try to review the questions for this, let us say from your Super 99 set, if you go to page number, where is this, 161. So if you go to page number 161, there are a few questions. Now while discussing questions, I hope you appreciate that in the interest of time, we will review these questions. If I sit and read every question, discuss every adjustment, it will take hours and hours, which may not be fruitful. So if you want, you have the Super 99 questions. You can, if you want to have a detailed understanding of that question, you can pause the video, read the question which we are discussing, and then come back to it. In most likelihood at this stage you must have seen these questions already, so a pure glance of the question and you would know what the question pertains to, and hence I will not invest my time in reading each and every question. Rather, I will invest my time in discussing the important areas of each of these questions. Okay, so in this first question you have an ESOP, a SAR plan, where you have a vesting period of 2 years, and after 2 years there's a 2-year exercise period where you have been given 2 separate intrinsic values. So what are we supposed to do in such a question? We are asked to find the expenses to be recorded. So for the first year, if it is a SAR plan, you will take 12, which is the fair value at the end of the year, into, in this case there are 1000 employees, into you have 1000 options per employee, into 40 employees which were there, and 36 which are going to continue. So in this particular case you will have, let us say, 36,000 into 12, that is equal to 4,32,000. So this is your total 4,32,000 of expense till date. However, you will have to prorate it. Vesting period is 2 years, so this entire working 4,32,000 into 1 by 2, and you will get 2,16,000. Now this is for the first year. Second year, because it is a cash settled plan, so over here this is share appreciation rights, and hence it is a cash settled plan. You will remeasure at the fair value at each balance sheet date, and hence at the end of the first year you are having 8 rupees. So this is 36 again into 1000 into 8, you see 2,88,000 less earlier recorded, and hence 72,000 will be the expense. So EB account debit to SBP liability is what you will record in the first 2 years. Now after that, there are 36 employees, out of which 6 employees exercise the option. The remaining 30 employees still don't exercise it. So for the 6 employees who exercise the option, there are 1000 options per employee into 6 such employees. So that is 6,000 options getting exercised, and when they get exercised, the question tells you that the intrinsic value was ₹10. So your entry would be SBP liability account debit to bank. So to bank would be 10 rupees. However, in your ledger, the latest SBP liability recorded at the end of the second year was 8 rupees. So SBP liability will be debited by 8 into 6,000. To bank will be credited by 10 into 6,000, and hence there is a remaining balance of 12,000. Now to whom is this 12,000 going? Well, this 12,000 is also at the end of the day going to the employees, and hence you will debit this against the employee benefit expenses. So the payment is happening at intrinsic value. However, in your ledger you are shown it at the last remeasurement date at fair value. So after that your SBP liability falls by 48,000. Whatever is the remaining SBP liability, 2,88,000 minus 48 will give you the remaining SBP liability. However, that is nothing but 30 employees which are remaining into 1000 into, you are showing it at 8, so that is probably 2,40,000. However, for these 30 employees, the remeasurement will happen based on fair value, and fair value at the end of the third year is around 13 rupees. So if you multiply this, this probably comes to around 3,90,000, and as a result there is an increase of 1,50,000. Now this is again payable to the employees, and hence EB account debit to SBP liability. So this is around 1,52,000. So during the third year, 12,000 as well as 1,50,000, that is 1,62,000 is going to be taken to the profit and loss account. Okay, next you have, let us say, the last year when the exercise happens. When the exercise happens at the end of the last year, your payment is 12 rupees. So that is something account debit to bank. So your SBP liability will be debited. Your SBP liability is at 3,90,000 to bank, that is 30 into 1000 into 12, that is 3,60,000, and hence For the remaining 30,000, that is reversal of EB that was earlier recorded, which will be credited to the profit and loss account. So this is 30,000 which will be credited to the profit and loss account. So this is an important question and an adjustment that you should be aware of. So this is question number 1. Next you go to question number 2. Over here there is an ESOP with a cash alternative, in which case you will try to find the fair value of the equity option as on the grant date. So for this, what will you do? You will look at the share alternative, which is 1500 shares with restriction. So 1500 shares with restriction will be 1500 into 102. So probably this will come to around 1,53,000. And compare this with if the employee were to exercise a cash option. So this is 1000 into 113, and hence this comes to around 1,13,000, and hence the excess, that is 40,000, will be the fair value of the equity option. So this 40,000 will be prorated 20,000 in each of the years. And for the cash plan, you will remeasure. So this will be 1000 into 120, that is 1,20,000, prorated 1 by 2, that is 60,000 to be recognized in the first year, and then again 1000 into 132, that is 1,32,000 minus 60 earlier recorded, and then 72,000 to be recorded in the second year. Sure, working in each year would be as if it is an SBP liability, so 60,000 and 72,000 of expense, and along with that an equity option, so that will be a 20,000 of expense. So this is probably 60 and 20, and then the second year 72 and 20. After this, your SBP liability at the end of the second year comes to 1,32,000, and your SBP reserve comes to 40. In this question, it is told that the employee exercises the cash option, and if the employee exercises the cash option, you will pay 1,32,000 unless otherwise given. So your SBP liability account debit to bank will be 1,32,000, and the remaining 40,000, well, it is like lapsing of the option, and hence SBP reserve account debit to retained earnings will be for the remaining 40,000. However, if you were to assume an equity settlement, in which case the journal entry would have been SBP liability account debit the entire 1,32,000, SBP reserve account debit, let us say 40,000, to share capital to securities premium, 1500 shares into whatever is the face value, and the balancing figure will go to the securities premium. So this is in case of ESOP with cash alternatives. Third is a case where you have performance linked vesting, and this is non-market linked. Performance linked vesting, which is not market linked. Over here you are giving 100 stock options to 500 employees who are there on the grant date, and at the end you have been told that the fair value or at the grant date is 30. Now at the first year you have been told that the earnings increased by 40%, 14%, 30 employees left. So whatever were your targets were not met, and hence the vesting did not happen. So when did the vesting happen? Enterprise expects the earnings will continue to grow in the same rate in year 2, and options would vest at the end of year 2. So since it is a performance linked vesting which is non-market linked, we will take the estimate of the vesting period at the end of each year. So over here we will say that, okay, if you see the entire data, 440 employees are expected to continue to the end of year 2. So we'll say 440 employees. To every employee you have given probably 100 stock options. So 440 into 100 into 30 rupees. So this is your total fair value. However, you will prorate it over the estimated vesting period, that is 1 by 2, and hence that will be your expense. When you go to the second year, you will see that the targets in the second year also have not been met. However, you expect the vesting to happen in the third year. So you will say that, okay, we are expecting around let us say 417 employees to continue, whatever is the number of employees to continue, into 100 into the fair value still as on the grant date, but now you remeasure the vesting period, that is 3 years. So this will be into 2 by 3 less earlier recorded. I think earlier 6,60,000 was recorded, and hence whatever is the remaining will be recorded in the second year. And in the third year, you see targets have actually been met, and hence whatever is the number of employees, probably 419 employees into 100 into 30 less earlier recorded, and this will be giving you the expense of the third year. So one needs to remember that you will take the vesting period based on the estimate and possibility of vesting which is expected to prevail at the end of each year. Okay, next you have question number 4, which involves, I think, modification. So in this particular case, you have granted 1000 share options each to 2000 employees, and you have been given various data points. You have been told that at the end of the first year, you expect 1850 employees to continue till the end of vesting. 1800 was expected at the grant date, that estimate changes to 1850. She'll say, well, 1850 employees are expected to continue till the end of vesting period, into have granted 1000 options to them. However, this is a share option, not share appreciation, right? And hence your working will be based on the fair value as on the grant date. There are a lot of fair values given over here, but the relevant fair value over here will be the fair value on the grant date, which is 1.2, and hence This will give you the expense to be recorded in the first year, but this is to be prorated over 3 years. So this is minus 1 by 3 less 0. Now when you go to the second year, you see that there is a modification. The modification actually happens on 30th of September. When it happens, let us say on 30th of September, we say that on 30th September, if there is a modification, then you will try to find the incremental fair value. You will see that the fair value is 1.05 of the modified award was 0.90 of the original award. Remember, you don't remeasure it in the books, but that is a fair value as on the date of modification. And hence the incremental fair value comes to 0.15. This is to be treated as a new plan with the remaining vesting period of 18 months or 1.5 years. Remember, your original plan will continue as it is. So now your estimate of number of employees are 1840 into 1000. You will still treat this as 1.2. So into 2 by 3 less earlier recorded. So for the original plan, you can see that 7,40,000 was earlier recorded. So let us say this was 7,40,000 less, if you go to the second year, less 7,40,000, and hence this will give you the expense to be recorded on account of the original plan for the second year. However, in the second year there is also modification, and this is to these 1840 employees into 1000 into 0.15. But this is to be spread over the vesting period of 1.5 years, out of which 0.5 years, that is 6 months have gone by. So this is into 0.5 by 1.5 less nothing was earlier recorded, and that will give you the answer. So if I go to say for the original plan and then for the new plan, the incremental fair value, this is the important 0.15 calculated as 1.05 minus 0.9 and the prorated vesting period of 0.5 upon 1.5. Okay, so this will give you your total employee benefit expense to be recorded, let us say in the required year 12-13. Okay, next you have this question where you have been given a case of immediate vesting. So over here there are 10,000 share appreciation rights that vest immediately. Remember, if they vest immediately, whatever is the total expense will be recorded immediately. So over here, as on the grant date, the fair value over here is probably given as 95, and as a result 10,000 options into 95, that is equal to 9,50,000 will be recorded in the P&L immediately. However, since it is a SAR, it will be remeasured at each balance sheet date till the time it is exercised. So at the end of the first year, the value is 112. If employees have not yet exercised it, that 112 still remains. However, you are expecting only 95% of the employees to exercise. So 112 into 10,000 into 95%. So if you go to see, this is what 9,500 into 112, that comes to 10,64,000. Currently we were at 9,50,000, and hence the remaining, for example, 1,14,000 will go to the P&L. Similarly, in the next year, the fair value is 109, but now you expect only 92% of the employees to exercise. So that is 10,000 into 92% into, for example, 109. You will probably get your balance as 10,02,800, but currently I've been showing 10,64,000, and hence there is a reversal of EB and so on. So basically in this case there is an immediate vesting, and hence 9,50,000 is immediately recorded. Don't get that wrong impression that we are doing this because it is a SAR. Even if it was an ESOP, 9,50,000 would have been immediately recorded. The additional working which is going to the profit and loss account in each of the years is happening because it is a SAR and you are remeasuring. But if it is immediately vested, the entire expense will be recorded in the P&L immediately. Okay, next you have, so this is regarding the questions on share-based payment. Next you will go to the all important chapter of financial instruments. Now financial instruments is covered under Ind AS 32, 107 and 109. Ind AS 32 covers definitions, 107 covers disclosures, and 109 covers the accounting as well as measurement. So when you look at a financial instrument can either be a contract which is creating a financial asset for one entity and either a financial liability or equity for another entity. Now what do you include within a financial asset? Cash, equity instruments of another entity, instruments where you have a contractual right to receive cash or another financial asset like trade receivables, bills receivable, loans given, debentures invested, all of these you have a contractual right to receive cash, or convertible instruments of another entity, you have a contractual right to receive another financial asset. This is also a financial asset. Further, you will also include items where you can exchange financial assets or liabilities at terms that are potentially favorable to you, like you are an option holder, for example, in which case that is also a financial asset. Remember what you have studied over here, the exact opposite also is there for a financial liability, where you have a contractual obligation to deliver cash or another financial asset, which can include like trade payables, bills payable, loans taken, debentures issued, all even expenses payable will be covered within this larger heading. Also, if you are agreeing to settle on terms which are potentially unfavorable to you, like you are an option writer, even that will be treated as a financial liability. Now, derivatives will also possibly get covered over here. Certain derivatives, there can be equity derivatives, there can be bond derivatives, there can be currency derivatives. Over here, if these derivatives, where the three crucial features are, the settlement happens at a future date, there is an underlying, and the amount paid initially is nil or insignificant, then derivatives can also be covered under financial instruments, provided they get covered under this definition. So typically, equity, bond and currency derivatives will get covered either into a financial asset if it is a profitable derivative, or a financial liability if it is a loss making derivative. The problem arises in case of a commodity derivative. In case of a commodity derivative which is net settled, it is still covered under Ind AS 109 because the settlement will or may happen by settling in cash. Net cash you will either receive or net cash you will pay. However, if it is a commodity derivative where the settlement is happening in the commodity, then it is treated as an executory contract where the standard believes that this is like going to be covered in the respective standard. So if you are planning to buy inventory, then it will be covered under the standard of inventory. It's like a purchase order for inventory for your own use, or planning to buy machinery, it is a purchase order for machinery again for your own use, and hence you will not separately cover Ind AS 109 for commodities which are gross settled, in which case something called as own use exception applies. So that is a brief discussion regarding derivatives. Another important area in the definition is the settlement that will or may happen in entity's own equity instruments. The thumb rule over here is, if the settlement will or may happen in own equity instruments, if the settlement is happening for a fixed number of instruments at a fixed price if applicable, then it is in the nature of equity. However, if there is any variability either in the number or in the price to the extent applicable, then we treat it as a financial liability if you are going to issue shares, or a financial asset if you are going to receive the shares. So we are not going to go into the detailed rationale for that at this stage, but the general rule from an exam perspective is what you call as a fixed for fixed test. So if the settlement will or may happen in own equity instruments for a fixed number of instruments at a fixed price, it is treated as equity. If there is any variability either in the number or in the price wherever applicable, typically derivatives will have an agreed price, non-derivative will not have an agreed price, in which case it is going to be a financial liability or financial asset if there is variability. Otherwise, it is to be treated as equity. Okay, so these are the core definitions of your financial assets and liabilities, and then there is a definition of equity. Within equity, we say any instrument which evidences what you call as residual interest in the assets or liabilities is treated as equity. So when do you say that it evidences residual interest? When you get something which is left over of the net assets. You don't have a contractual right to receive a fixed amount or an obligation to pay a fixed amount of cash, in which case it is an equity. Like equity shareholders, classic meet the definition of equity. However, items like preference shares that you are issuing, you have a contractual obligation to pay a fixed amount on these preference shares, and hence preference shares don't meet the definition of equity. Rather, they will generally be shown, the cumulative redeemable preference shares will generally be shown within the nature of financial liabilities. Now, there are a few examples that we have outlined over here. You can go through them, but an important special cases over here would be income tax payable is not a financial liability because it is statutory, not a contractual obligation. Product guarantee or warranty, again not a financial liability because there is an obligation to repair, not to deliver cash. Prepaid expenses, you have a contractual right, but that is to receive services, not to receive cash, and hence not a financial asset. Financial guarantee is a conditional obligation, contingent obligation, but to deliver cash, and hence financial guarantee is very well a financial liability. It is contingent. Accounting will be slightly different, but it is a financial liability. Next, you have unearned revenue, like you pay me fees in advance, bank account debit to unearned revenue. I have an obligation to render service to you, and hence this is treated as a liability but not a financial liability. I don't have an obligation to deliver cash or another financial asset to you. Advance for machinery, I will pay the advance account debit to bank, but against this advance I have a contractual right to receive machinery, which is not a financial asset, and hence this is advance, which is also not a financial instrument. Physical assets like PP and intangibles are also not treated to be a financial instrument. Constructive obligations, remember the law says contractual obligation to deliver cash, and hence constructive obligation which either arises out of past practices or published policies are not treated as a financial liability. It may be treated as a liability under the other respective standards. Next, you have preference shares or debentures issued, as the case may be. So when you look at preference shares or debentures issued, there are two possibilities over here. So we will look at the three core features. First is distribution. So if the distribution over here, like the coupon payments, is mandatory, that is in the nature of liability, but if it is discretionary, it is in the nature of equity. Redemption, if it is redeemable, and if there is a redemption, then it is in the nature of liability. If it is irredeemable or perpetual, it is in the nature of equity. And then comes conversion. In case of conversion, if it is a compulsory conversion, it shows that the settlement will happen, provided it is happening for a fixed number of entities' own equity instruments, it is in the nature of equity. But if there is variability, it is in the nature of liability. So assuming there is a fixed for fixed conversion, then the conversion feature is in the nature of equity if it is compulsory conversion. For an optional conversion, you have to see whether it is the option with the holder or the option with the issuer. If nothing is given, we'll assume that the option for conversion rests with the holder. In which case, if the holder decides not to convert, you are under an obligation to deliver cash. So there exists a financial liability, but along with that, there is an equity conversion option. So there is a special accounting for this. But what if the conversion is at the option of the issuer? In which case, if the data in the question is specifically given, which showcases the intention of the issuer, like the issuer wants to kind of convert in shares, or the issuer wants to settle by paying cash, then you will show it accordingly. However, if nothing is given, as per the latest institute solution in one of the Ind AS 33 EPS problems, institute has assumed that if nothing is given, we will assume that the issuer will settle by issuing own equity shares. Having said that, an alternative assumption is very much possible. So you can write a note for the assumption and accordingly solve if the option rests with the issuer. Okay, so when will there be a compound financial instrument? Well, if one of the features like distribution is, for example, in the nature of liability, whereas one of the features like compulsory conversion in the nature of equity, where an instrument has multiple features, is called as a compound financial instrument. So this is an important thing for gauging whether it is a compound financial instrument or not. Well, sometimes what happens is interest is deferred, and sometimes interest is deferred up to perpetuity. If it's a perpetual instrument and interest can be deferred up to perpetuity, then there is no obligation on you to pay interest, and hence that deferred interest is in the nature of equity. However, if interest can be deferred only for a specified number of years, let's say for 5 years, in which case you may not pay the interest immediately, but you are under an obligation to pay the interest, let us say after 5 years, and hence it is in the nature of financial liability if the deferral can happen only for a specific period of time. Like we mentioned for commodity derivatives, if it is gross settled, we say that then this is a commodity that you are buying or selling for your own use, and hence Ind AS 109 will not apply. But if it is net settled, Ind AS 109 will apply. Derivatives accounting of FVTPL will be applicable for commodity derivatives which are net settled. For other derivatives, that is equity, bond or currency derivatives, whether they are gross or net settled, Ind AS 109 FVTPL derivative accounting will typically apply. Okay. We have also mentioned the settlement in own equity instruments. If it is for a fixed number of entities, own equity instruments at a fixed price, it is in the nature of equity. If there is any variability, to the extent applicable, it is in the nature of financial liability if you have to pay, financial asset if you have to receive. Okay, there are a few exceptions to this fixed for fixed rule. That is, if the variability is only to kind of maintain the number of shares, etc. In case of a bonus or share split, that variability can be ignored. Or if the variability is only due to the passage of time, like passage of time is considered to be constant and hence that variability can be ignored, or it is due to, let us say, conversion and conversion of instrument, foreign currency convertible bond, where the variability arises because you are converting at different rates in your books, but for the investor the conversion price in the foreign currency is fixed, in which case you can ignore the variability. So 3 exceptions over here is variability in case of bonus, share split, etc., variability on account of time, and third on account of a foreign currency conversion. So this is the first part of the standard. The second part of the standard goes into the classification, where financial assets can be classified into either amortized cost, FVOCI or FVTPL. Financial liabilities in general between amortized cost and FVTPL, and equity, there is no separate sub-classification. It is to be recorded at the value at initial recognition. So the law over here mentions that financial assets can be measured at amortized cost if 2 conditions. First, there is a business model test, but before that, first, for something to be amortized cost, they have to meet what is called as a CCFC or SPPI test, whereby we say that the cash flow characteristics are solely in the nature of payment of principal and interest. That is typically a debt feature. And secondly, the business model is to collect only. So in simple words, debt instruments that are intended to be held till maturity are within the amortized cost working. Under the FVOCI workings, we will say again debt instruments, that is instruments where the contractual cash flow characteristics are in the nature of principal and interest. First, and second, the business model is to collect and sell both. So basically, in simple words, debt instruments that are available for sale before maturity can go under FVOCI. which means everything else will go under FVTPL. So by default, your derivatives will always be FVTPL. Held for trading instruments for purpose of immediate buying and selling will always be FVTPL. And in general, if nothing else is available, then items like even investment in equity shares can go under FVTPL. However, for this, there's a separate one-time irrevocable choice which is available at the stage of initial recognition, where investment in equity instruments can be one-time irrevocable be shown under FVOCI. If they are shown in FVOCI, they will remain in FVOCI. If they are shown in FVTPL, they will remain in FVTPL. Remember, this is an unconditional choice and is available only and only for investment in equity shares. So the general rule over here is that when you try to evaluate for the classification, you will see, let us tell me, is this, okay, this is the general rule, just, okay. We will say that if it is derivatives or a held for trading item, or even if you are designating something at FVTPL to prevent an accounting inconsistency or mismatch, then you will say that this will be going under FVTPL. Second, for investment in equity shares, you will see that it is either FVTPL by default, or if you have taken a choice, in FVOCI. And for every other financial asset, you will first apply the CCFC test. If the contextual cash flows are solely in the nature of payment of principal and interest, then you will then we say SPPI test or CCFC test is passed. You will go further. If they are not solely in the nature of interest and principal, in which case CCFC test fails, in which case the instrument will directly be classified as FVTPL, like a gold index bond. CCFC test will fail because the payment is not solely in the nature of principal and interest, and hence this will by default go under FVTPL only. But if it passes, then you take further and say, is the business model collecting only, in which case amortized cost, collecting and selling both, in which case FVOCI. This is how your overall classification goes. So when you're doing this overall classification, there are two tests. One is a CCFC test, contractual cash flow characteristics, CCFC, or SPPI test, solely payment of principal and interest outstanding, SBP test. What does this test say? This test says that you have to check whether the cash flows that are getting received are same as what a lender would have expected in a basic lending arrangement. So what does a lender expect in a basic lending arrangement? Typically, a lender expects compensation, let us say, for time, that is inflation, compensation for credit rating or credit risk, and third, a reasonable profit margin. Apart from that, a few other charges like prepayment, extension charges, etc. can also be there. But otherwise, this is what a lender typically expects in a basic lending arrangement. So if your compensation comprises of that only, then we can say CCFC test is met. If it has something else, then CCFC test is not met. Like a gold index bond or an oil index bond gives you compensation which is linked to gold price changes, which is not what a lender expects in the ordinary course. Second is a business model test. In case of a business model test, business model refers to the way in which an entity manages financial assets. So you are holding a portfolio of financial assets with the sole objective of collecting cash flows only. You don't want to buy and sell, in which case the business model is that of collecting only. But if you are an active investor who is getting the right opportunity, you will sell, again you will buy, in which case the business model is collecting and selling. Various things that can be seen is what is the objective? Like, are you building this for the purpose of buying a particular asset? If yes, when is the asset going to be bought? After 5 years, okay. Are your investments for 15 and 20 years? Okay, then after 5 years, you will have to sell them. Business model of collecting and selling. But if your investments are 2 and 3 years, then you will generally collect them only because you don't need to sell it for the purpose of this investment. Again, what you will look at is the normal case, not the worst case. And you will do an aggregate overall identification and not a point by point. If one asset is sold, does not mean the entire group of assets becomes collecting and selling. So your evaluation will be based on an aggregate basis. This is highly subjective and fact based. Okay, next you go to the most important part arguably of this chapter, or rather the entire syllabus, which is accounting for financial instruments. So when you look at accounting for financial assets, accounting comprises of initial recognition, whether it is amortized cost, FVOCI or FVTPL. Initial recognition happens at fair value. If the transaction is at market terms, then the transaction price is the fair value. Now, how do you know whether the transaction is at market terms or it is off market terms? If there is anything hidden, that is apart from a pure lending or borrowing, there is some other hidden element like staff welfare, like let's say a tenant arrangement or a grant or a parent subsidiary. If there is something hidden, that is when we say that the transaction is off market. Otherwise, if there is no hidden element, if nothing is given, you will always assume that the transactions happen at market terms. And if they happen at market terms, the transaction price is the fair value. However, if there is some hidden element involved, apart from pure lending and borrowing, then you will have to determine the fair value separately, which is typically done as the present value of the future cash flows discounted at the rate had there been a fair transaction, in which case you will try to find the fair value. So initial recognition is not necessarily at cost. Initial recognition in case of these instruments happens at what you call as fair value. But sir, what if there's a transaction cost? Usually transaction cost is added in case of amortized cost as well as FVOCI items, but if there's an FVTPL item, then the transaction cost is directly taken to the PNL. So this is your initial recognition. At every subsequent balance sheet, in case of amortized cost, you will show this at the amortized cost. For every other items, you will show it at fair values. Okay, sir, but if it is upward or downward, yes, you will still show it at fair value, which means there is a possibility of an unrealized gain or an unrealized loss, which will not arise in amortized cost working, but in FVOCI or FVTPL, it will arise. So if in FVTPL, there's an unrealized gain or loss, it goes to the PNL. In FVOCI, it goes to a separate reserve, a separate line item called as fair value reserve, which will be shown in OCI. Now within this, there are two types of OCIs. There is a reclassifiable and non-reclassifiable. Within a reclassifiable OCI, the balances on happening of certain events will be transferred from the OCI, that is fair value reserve, to the statement of PNL. Like FVOCI debt instruments are an example of reclassifiable OCI as stipulated, and non-reclassifiable means on happening of certain events like sale of investments, the balance in the fair value reserve will directly go to the retained earnings and not through the statement of profit and loss account. And as a result, FVOCI equity instruments are examples of non-reclassifiable OCI. So when you look at initial recognition, subsequent recognition, unrealized gains or losses, then you have dividend and interest. Remember, interest and dividend will go to the profit and loss account. Typically, you will take effective interest. And effective interest will be based on an effective interest rate, which will typically given in the question. And if not, you can calculate using the IRR method, trial and error method that you do in your AFM as well. But usually it will be given to you. So this is effective interest rate that will go in your profit and loss account. Realized gain is typically rare in case of amortized cost, but if it is arising, it will go to the PNL. For FVOCI debt, the realized gain will be transferred from the fair value reserve, if applicable, to the statement of profit and loss. For FVOCI equity, it will be transferred from fair value reserve to, let us say, retained earnings, because it is a non-reclassifiable OCI. If nothing is available, let us say fair value is not determinable, the standard allows you to show it at cost with a disclosure that fair value was not determinable, and hence you have to show it at cost. Okay, application of EIR over here, there's a fairly detailed discussion done for the application of EIR. EIR usually for a bond, let us say financial asset, the return that you are going to get is coupon. However, in certain cases, you might get more or less than the coupon. Why? Well, because the bond may be issued at a discount or a premium, or the bond may redeem at a discount or a premium, or there may be transaction cost. So basically, in all cases where the bond is either issued or is redeeming at a discount or a premium, or in all cases where there's a transaction cost, your effective interest rate will be different from the coupon rate, and you will have to calculate the effective interest rate. Typically, it is calculated using the trial and error method, that is the IRR method. But otherwise, you can always calculate it separately using any method, but typically in an accounting paper it will be given. So how do you calculate the effective rate? Well, the opening balance into the IR will be your effective interest, which will be taken to the PNL. Coupon is not taken to the PNL, it is treated as recovery. So your amortization table will be your opening balance plus effective interest minus coupon that is recovered minus principal that is recovered, and then the closing balance that you get is called as a closing amortized cost. Slowly the amortized cost method is structured in such a way that slowly you will move from your initial recognition base all the way up to the redemption value. So you are slowly moving towards the redemption value under the amortized cost method. So a trick to figure out whether you have done the working right or not is to ensure that at the end, at least in case of a bullet bond, your payment goes up to the redemption value, and if it is an amortizing bond where the payment is happening each year, then ultimately it comes down to a zero value, because every year the principal is paid, so answer will ultimately come down to zero. Okay, so you mentioned regarding initial recognition, usually at fair value. If nothing is given, the transaction is at market terms and the transaction price is the fair value. If there's a hidden element available where you have been told there is some hidden element like staff welfare, etc., then there's a possibility on off market, provided you have been given a separate rate where you could have charged had this transaction been at fair terms, in which case you will have to find the present value of the agreed cash flows discounted at the rate which was a pure fair market rate. So this is possibly an important adjustment. You do get a lot of questions regarding loan at off market terms. And if just a second, if we jump to transactions, common transactions which may be off market. Well, in case of employer-employee, the balancing figure may be prepaid EB. In case of landlord-tenant, the balancing figure may be right of use asset or unearned, let us say, rental income. In case of government and entity, the balancing figure may be grant. In case of parent and subsidiary, the balancing figure may be investment or capital contribution, or it can be dividend distribution, as the case may be. So there are various cases which you should practice at a good level of length. We will also do a problems or discuss problems for the same. Now, we were discussing regarding financial assets, but what about financial liabilities? Well, typically there are only two classifications. Financial liabilities at FVTPL, there are 6 items like derivatives, loss-making derivatives, held for trading items like short sold, accounting for the purpose of preventing accounting mismatch, designated at FVTPL. Then 3 new items, that is financial guarantee, contingent consideration, and continuing involvement approach. These 6 items will be taken at fair value and everything else will go at amortized cost. So typically the changes in fair value in case of FVTPL will go to the P&L. There's one specific exception over here, that if the changes are happening due to changes in entity's own credit risk, it can go to OCI, but that is not a very important area per se. So over here, this is classification of financial liabilities, and the accounting for financial liabilities, again, initial recognition happens at fair value. For amortized cost as well as FVTPL, if it is FVTPL, there is a transaction cost, it will be taken to the P&L. The problem arises that if there is a transaction cost in case of a liability, that is a loan taken. Usually we are trained to think that transaction cost is to be added, because typically everywhere we see transaction costs pertaining to an asset, PP, inventory, everywhere. But here for a liability, remember liability is a credit balance, transaction cost is a debit balance. So you will not add the transaction cost, rather you will deduct the transaction cost at the time of initial recognition. Your initial recognition will happen at fair value minus the transaction cost. At every subsequent balance sheet, you will show it either at the amortized cost or at fair value. There will be unrealized gain in FVTPL which will go to the P&L. There will be no unrealized gain in the amortized cost, and interest, if any, will be recorded using the effective interest method. The principles for effective interest calculation continues to remain the same, that is the IRR method. An important item would be if there's a loan of the market terms and there's a prepayment, in which case you will try to find the fair value or the present value of the future cash flows which are remaining of the loan, and then accordingly find and compare it with the payment which is made. So we will do a detailed problem on this, which is important, where we try to find that what is the present value of the future cash flows which are still remaining and compare it with the ledger balance. The difference between the two can be said as the part that you are paying. However, when you pay a loan, prepay a loan which is off market, then some of the staff welfare etc. that you think would have been happening will also in a way be reversed. Like you were thinking that you are giving a concession loan which is benefiting the employee for 5 years, but if the employee prepays it, then probably the benefit reduces because the employee does not enjoy the benefit of concession interest for 5 years, and hence there may be an adjustment with prepaid EB as well. It is best understood with the numerical, which we will also probably discuss. It has come twice in the exam, so that way it is relatively important. And the last part is when you go to the equity section. So when you go to the equity section, we said that equity will be initially measured at fair value, and that will not be remeasured. So there's no FVTPL, no amortized cost, no FVOCI, nothing. Just that there may be a possible transaction cost along with equity. So if there's a transaction cost on existing issue of shares, then it will be taken to P&L. However, if you are issuing new shares, then the transaction cost for those new shares will be deducted from the equity balance. So this is regarding the transaction cost. The summary for transaction cost would be that for financial assets at FVTPL, it goes in the P&L. For other items, it is added to the initial recognition base. For financial liabilities, again for FVTPL, it goes to the P&L. For amortized cost, it is deducted. For equity issues, for a fresh issue of shares, you deduct it from the equity section. For issue of existing shares, you will take it to the P&L directly. Okay, next we have reclassification, which is relatively less important. In case of reclassification, you cannot reclassify within financial liabilities. So FVTPL to amortized cost or amortized cost to FVTPL not permitted. Equity has no separate sub-classification, and hence there is no question of reclassification. But for financial assets, reclassification is permitted in extremely rare cases if there is a change in business model. If there is a change in business model, that is a way in which the entity decides to manage financial assets, which is treated to be extremely rare. That is when you do a reclassification. And you have been given certain guidance on what will you do in case there is a reclassification, though that is not very important from an exam perspective. Next, you go to compound financial instruments. Now within this chapter, the two most important areas are loans at off-market terms, accounted for using amortized cost method, and second is compound financial instruments. It is almost certain that you will get one of these two in your main exams. Almost every exam has had that, so do that properly. So when you look at a compound financial instrument in the books of the issuer, not in the books of the holder. In the books of the holder, it is a financial asset to be recorded using FVTPL. In the books of issuer, there is an equity feature as well as a liability feature. Sir, what is a liability feature? Well, liability feature is, let us say, if you are a compulsorily convertible debenture, the obligation to deliver interest is in the nature of liability. Further, the settlement in own equity instruments for a fixed number of own equity instruments is in the nature of equity. So, where do I show a compulsorily convertible debenture issued? Pure liability, pure equity, or both? Well, it is both. And hence, you will have to do what you call a split accounting. In split accounting, what do? You take the issue proceeds and then find how much of this is in the nature of liability. How do you find that? Well, present value of the future cash flows, which are in the nature of liability, like interest, into the present value factor, discounted at the market rate of interest of a similar non-convertible instrument. So let's say 100 is the issue proceeds. If the present value comes to, let us say, 30 rupees, 30 rupees in the nature of liability, then why is the investor paying you 100? Well, for the remaining 70 is in the nature of equity. So a journal entry will be bank account debit 100 to the liability component of, let's say, the convertible bond 30, to the equity component of convertible bond, let us say 70. Now this liability component of 30 will be recorded using the amortized cost method. And in case of a compulsorily convertible bond, will come down to 0 because at the end of 5 years there is no further obligation. And in case of a equity component, it will continue to remain the same. At the end of 5 years, when shares are issued, you will say that equity component account debit to share capital to securities premium. The problem arises in case of an optionally convertible instrument where the option is with the holder's choice, where in the nature of liability, you have an obligation to deliver cash for the interest as well as obligation to deliver cash for the principal amount. So why is there an obligation? Well, if the holder demands, I have to pay. So a student thinks that the entire instrument is in the nature of equity, which is wrong. You are having an obligation to deliver cash for the interest, obligation to deliver cash for the principal, yes, but you are also giving an option to the holder to convert into shares. Now that option is something which may settle in entities' own equity instruments for a fixed number of entities' own equity instruments, and hence that is treated as in the nature of equity. So again, the working will be the same. You will take the issue proceeds, let us say 100, liability component, that is interest into the present value factor had there been a non-convertible instrument, plus the principal into the present value factor, and you get, let us say, the answer as 85. So we'll say out of 100, 85 is in the nature of liability, then the remaining 15 is in the nature of equity. Your journal entry will be bank account debit to liability component to equity component, in which case you prepare amortization table for the liability component. It will slowly go up from 85 to, let us say, 100. If the holder demands redemption, your entry would be liability component account debit to bank, and then equity component lapses, so equity component account debit to retained earnings. However, if the holder exercises, your journal entry will be liability component account debit, so liability foregone is a consideration for shares issued, equity component account debit to share capital to securities premium, and accordingly your entire working will kind of proceed. A few special features over here is including what came in the recent exams. Transaction cost in case of a CFI. Remember, in case of a CFI, if there's a transaction cost, this transaction cost is not just for a liability, not just for equity, but for both. And hence, what will you do? The steps that the institute follows is, you will first find the liability and equity component had there been no transaction cost. Once you find that, then whatever is the transaction cost, you will split between the liability and equity component in the ratio of their respective carrying values. Like, if the issue proceeds were 100, and the transaction cost was 5 rupees, you will ignore that 5 rupees, you will split the 100 between 85, liability component, 15, equity component, and then you will split the 5 rupees in the ratio of 85 is to 15. And that 85 into 15, whatever is the ratio that comes, for example, I have not done the calculation, but let's say 4 rupees and 1 rupee. In which case, you will say that this 4 rupees is the allocated transaction cost for the financial liability, which is to be recorded using amortized cost, and hence 85, which is the financial liability, minus 4, that is equal to 81, will be your effective financial liability. Your EIR will also change. Equity component, again, this is a transaction cost of 1 rupees against a convertible instrument, which will involve you having to issue fresh shares, and hence this one is also to be deducted against equity. So 15 minus 1, that is equal to 14. So effectively your journal entry will be bank account debit, let us say 95 effectively, to liability component 81, to equity component, let us say 14, and that is how your entry will flow, and then your EIR will correspondingly be slightly different because of the existence of a transaction cost as well. There may be a possibility of an irredeemable instrument, in which case you will recognize a liability component using interest divided by the cost of debt. You will get the answer, and the remaining will be in the nature of equity. That is not as important. There is a possibility of an early redemption that can happen. If there is an early redemption, you will do the working in the usual way till the time there is early redemption. Once there's an early redemption, you will take the early redemption proceeds and then you will segregate these early redemption proceeds between how much of it is attributable to liability and the balancing figure equity. So you will take the present value of the remaining cash flows discounted at the prevailing market rate to find that if I'm paying 5,25,000, how much of the 5,25,000 that is early redemption proceeds is attributable to the liability, which means the remaining is attributable to equity. Why are we doing this working? Well, because the gain or loss on settlement of the liability component will go to the P&L, but the gain or loss on settlement of equity component has to go to the retained earnings, and hence you have to segregate and find how much of the early redemption proceeds are attributable to equity and how much of it is attributable to liability. Now, one of the most tricky parts that students kind of encounter over here is identifying whether a question has convertible debentures which are compulsory or optional. Now, usually the question should be clear, but if not, then you will scan through the question for possible hints. Like sometimes a question might tell you somewhere that the holder of the option exercises the option after 3 years. So there is an option, that too with the holder. Or question might tell you there's an early redemption. Remember, early redemption can happen if there's a redemption in the first place. If data like that is given, we'll say okay, there is a possibility of redemption, and hence this can possibly be treated as an optionally convertible instrument. However, if nothing is mentioned, then you should pray to God and assume it as compulsorily convertible and solve. Hopefully that should be this consistent with the institute's assumption as well. Similarly, if nothing is given, you will assume that if this is an optionally convertible instrument, we'll assume that it is convertible at the holder's choice and not at the issuer's choice. Okay, sometimes there can also be instruments with callable or puttable features. Callable features means the issuer of this instrument has a right to call back the instrument and give you back the money. The callable feature is typically favorable to the issuer, adverse to the holder, and hence the holder is ready to pay a slightly lower amount if the bond is a callable bond. A puttable feature is, on the other hand, a feature with the holder that the holder can put the bond whenever the holder wants and the issuer will have to give back the money. This feature is typically favorable to the holder, and as a result, the holder is ready to pay slightly more in case of a puttable feature. So if the question gives you callable and puttable features, while finding the equity component, you will first adjust the fair value of the callable or puttable features. Adjust meaning deduct the fair value of the callable features if applicable, or add the fair value of the puttable features if applicable along with the liability component, and then find the balancing figure for the equity component. There's one problem, but not very important. And then if there's a floating rate instrument, you will take the coupon rates, the market rates, based on the rates prevailing at initial recognition, and based on those rates you will find the liability and equity component. Okay, so that takes care of the brief discussion of compound financial instruments. Then you have regular way contracts. Regular way contracts, which are contracts which in the regular way are settled by within a time frame decided by market stipulation or legal regulation. It is not mutually decided, like T+2 settlement on a stock exchange. In case of regular way contracts only, you have two choices to follow: something called as a trade date accounting or something called as a settlement date accounting. In case of a trade date accounting, you will record the purchase of asset as well as derecognition of asset on the date of trade. You will not wait till the time of settlement, that is it going out of your demat account. So usually if nothing is given, we follow trade date accounting, where you record the asset on the date of trade, derecognize it on the date when it is traded, irrespective of when it moves out of your demat account. Your income starts accruing from the date you purchase the asset and stops accruing from the date you sell the asset, irrespective of whether it is there in your demat account or not. So even in case of settlement date accounting, your income recognition will be done in a manner which is similar to trade date accounting. You can refer a particular sum which was done for this purpose. Special cases in case of financial liability classification would be puttable instruments like units in an open-ended mutual fund, or instruments of a limited life entity like a joint venture which has a limited life. These instruments typically will fall within the standard definition of liability because there's a contractual obligation to deliver cash if the holder demands, or if a certain liquidation happens, you have an obligation to deliver cash, and hence it is in the nature of liability. However, a lot of its features resemble those of equity features, and hence the standard over here says that only and only for puttable instruments or instruments of limited life entity, you will check for 5 conditions, and if those 5 conditions are fulfilled, then you can show it as equity irrespective of the contractual obligation to deliver cash. First feature, that the instruments will give a share pro rata on the net assets, no minimum or maximum limit. In case of a liquidation, these rank the most subordinate. Third, the instruments in the most subordinate class have equal features. Fourth, there is no other guaranteed return. And fifth, the payment is going to happen based on the expected cash flows, etc. If these features are satisfied for puttable instruments or limited life entity instruments, then you show this in the nature of equity. In case any of these are not met, you will show it in the nature of liability. Okay. Remember also, in case there are financial instruments that you are holding in the ordinary course of your business, like you are a stockbroker, you will not apply Ind AS 2, you will apply Ind AS 109. Okay, next you go to the section of derivatives. Derivatives have three features as we discussed. There should be an underlying amount paid initially should be nil or insignificant, and settlement should happen at a future date. If these features are fulfilled, it is a derivative. If it is a derivative, and within that, if it is a commodity derivative which is gross settled, then own use exemption will apply. Ind AS 109 will not. If it is other than commodity derivative being gross settled, then Ind AS 109 can apply. Ind AS 109 being applicable, you will have to see what is the accounting principle. Well, you will see that if it is an equity derivative where settlement will or may happen in entity's own equity instruments, then it will be accounted for based on fair value at initial recognition, like equity component. You do not remeasure it. But other than equity derivative, equity meaning own equity derivative, this will be a derivative financial asset or a derivative financial liability which will be accounted for using FVTPL unless hedge accounting applies. Positive fair value means a derivative is a financial asset. It gives you a positive fair value on net settlement. A negative fair value means a derivative is a financial liability. It will result in you having to make a payment in case of a financial liability. Now, embedded derivatives are derivatives which are inbuilt or stitched inside main derivative products. So, when you look at an embedded derivative contract, it is something which is inbuilt or embedded within the main derivative, in which case the standard gives you a guidance. Should you separate the embedded derivative and host contract? Well, if the host contract is a financial asset, no separation to be done. But if the host contract is either a financial liability, like a host contract is a bond and there's a conversion option, should you separate the embedded derivative? So, if the host contract is a financial liability, an equity or a non-financial item, separation can be done if the economic characteristics of the host and the embedded derivative are not closely related. The derivative on a standalone basis meets the definition of derivatives. And third, the contract entirely is not designated FVTPL. If these three features are met, then you will separate the host contract and the embedded derivative and show them separately. A classic example of this is compound financial instruments. Remember, CFI is an example of embedded derivatives which are getting separated. And you are separating because a host contract, that is debenture, is not closely related to the equity conversion option, and hence you separate and show them. But how do you separate? Well, you will try to measure one of the two which is more reliably measurable, like the liability component is more reliably measurable, and hence the other part will be taken as a balancing figure. This is a requirement for separation. Now, the standard gives you two specific examples, cases for the embedded derivatives. First is prepayment options in a loan. So, if there is a loan with a prepayment option, remember, if you have given the loan, it is a financial asset, no separation is to be done. But if you have taken the loan, that is you are a borrower, then the host contract is a financial liability. The embedded derivative over here is the prepayment option. This prepayment option again derives its value from the market rates of interest. So, if the market rates of interest go up or down, maybe the value that you have to prepay will change. Second, the settlement will happen at a future date and the amount that is paid initially is kind of insignificant usually. In which case, should you separate or not? Well, it depends on whether they are closely related or not. And how do you do that? Well, there are a few steps. First, you try to find the fair value of the loan had there been no prepayment option. So, you will discount it at the rate of interest had there been no prepayment option. Second, prepare amortization table for that loan. Third, compare the prepayment payment at each prepayment date with the amortized cost and find the difference. If these amortized cost at each prepayment date is approximately equal, so the range can be up to 2% unless otherwise given, plus or minus. If they are approximately equal, then we will say that they are closely related, and as a result no separation is required, in which case the entry will directly be bank account debit to loan. That's it. However, if at even one of these prepayment dates the gap is more, then we say they are not approximately equal, in which case a separation is required. And in case a separation is required, you will say bank account debit to loan, let us say without the prepayment option, and the balancing figure will be like a derivative financial asset. So, these are the steps, as we said, for the purpose of determining whether separation should be done or not. Second is foreign currency derivative embedded in a purchase or sale contract. Now, you might be buying, let us say, a machine, or you might be selling a machine or a goods, and in return you are going to get, let us say, cash. You are going to get in dollars. Now, this is typically a typical sale contract. So, your host contract is a sale contract. However, this is not sale in your own currency. This is sale in a foreign currency, and hence, if you are doing a sale, machinery is going out, dollars are coming in. Dollars are coming in is treated as similar to a forward buy of dollars. So, you'll try to separate the contract as if it is a host contract of sale of goods in your own currency at the forward rate, and in return buying, because dollars are coming in, buying, that is purchase of dollars at the agreed forward rate. The forward purchase contract will be accounted for using FVTPL and the sale contract will be accounted for as per Ind AS 115. Now, whether it is a sale or purchase will be dependent on whether the dollars are coming in or going out. Don't apply the hedging principles that you apply in foreign exchange AFM. We have done a detailed video for this embedded derivative discussion separately. If you want, you can refer that as well, because here students do face some level of problems. Okay, so this is kind of the workings. Then you go to derecognition of financial assets. I would say this is relatively less important. Derecognition of financial assets happen when the risks and rewards, that is control of the financial asset, is transferred. If control is not transferred, then you will not derecognize. Like in case of a bill discounting or a recourse factoring, you do not transfer the risk of the cash flows, and as a result you don't treat it as a derecognition of the bills or the debtors. In fact, you will treat it as a loan. Your entry will be bank account debit to loan. The bills or the debtors will continue to appear, and then the loan will be recorded using the amortized cost method. But in case there is a non-recourse factoring, in which case the risk of the debtors is actually transferred, and hence you can derecognize the debtors and recognize the gain or loss on this derecognition as well. So this is, let us say, non-recourse factoring. Now, sometimes there's a sale and a repurchase. So here the thing that you have to remember is, if there's a sale along with the repurchase, if the repurchase is happening at a fixed price, then we say that the risk is really not transferred, and as a result it is still treated as a loan transaction. But if the repurchase is happening at fair value, then we say that, well, you know what, the risk in the intermediate period is transferred, and hence you can derecognize, that is, you treat it as a sale and then you treat it as a purchase. Now, sometimes what might happen is, there is a sale along with the repurchase option. So if there is a repurchase option involved, we don't know whether the option will be exercised or not, and hence, unless we are absolutely sure that is the option is deeply in the money, we will follow the legal form, that is, we will treat it as a sale. If there's a subsequent repurchase, we'll show it as a purchase, but otherwise we will not treat it as a loan. You will treat it as a loan only if the option is deeply in the money, that is, it is highly likely that the option will be exercised. Okay, another special case is securitization, whereby where a company has sold a bunch of illiquid assets to your trust, and this trust has issued certain certificates like a participatory note or pass-through certificates, which passes through whatever cash flows are collected without material delay. In that case, the trust has actually given up the risk, or even to that extent the reward, in which case, in case of a securitization transaction for the asset reconstruction company or the trust, you can derecognize proportionally the financial asset if three conditions are met. Exactly the cash flows that are going to be collected are going to be shared, nothing more, nothing less. Second, you are not allowed to sell or pledge this asset, and third, these cash flows have to be transferred without any material delay, in which case you will, let us say, you will derecognize this asset in the books of the trust. Then you have certain continuing involvement approach. This is something that you do in line with what the institute has done. That is, if you have sold the debtors, let us say on a non-recourse basis, however you have given a part guarantee for a part, in which case, as per the ICI solution, the continuing debtors and guarantee liability will be recorded. So a guarantee liability will be recorded at the fair value of the guarantee given plus the fair value of guarantee commission, and that is the exact value at which the continuing debtors will also be recorded. Is there an alternative solution possible? Well, yes, in fact that would be more appropriate, but from an exam perspective, if this question comes, you will derecognize the debtors but recognize continuing debtors, because you have given the guarantee, and hence you recognize the guarantee amount as well. The guarantee amount, the associated guarantee liability is to be recorded as the guarantee amount plus the fair value of the guarantee commission, and that is the exact value at which the continuing debtors will also be recorded. So this is regarding the continuing involvement approach. Then you have partial derecognition, in which case, if there is a possibility that you can partially derecognize the assets, you can find the proportionate carrying value of the assets to be derecognized and find the gain or loss on these assets to be derecognized. So this is something that you can go through quickly. The next important section from this is the derecognition of financial liabilities. So the four most important parts for financial instruments, in my opinion, are loans at off-market rates. Second is compound financial instruments. Third is derivative accounting, and fourth is derecognition of financial liabilities. So when you go to derecognition of financial liabilities have to be ideally derecognized the moment they are discharged. That is, they are either paid off or they are waived off. However, in certain cases, there is a substantial modification, like a renegotiation of the liability, in which case the standard says that you will have to follow three steps. First, calculate the carrying value of the liability as on the date of the renegotiation. Second, find the present value of the modified cash flows at the old, that is existing EIR, and see if there is a difference. if there's a difference which is greater than or equal to 10%, either positive or negative, we call this as a substantial modification. And in case of a substantial modification, we treat it as derecognition of the existing loan and creation of a new loan. The new loan that is created is the present value of the modified cash flows, but this time around discounted at the new EIR. So you will derecognize the old loan, create a new loan, and the balancing figure will be shown as a gain or loss on extinguishment. However, if the modification is less than plus or minus 10%, in which case it is not a substantial modification, in which case the accounting is as per GAAP. So as per generally accepted accounting practices, what you will do is you will either adjust the carrying value keeping the EIR constant, or adjust the EIR keeping the carrying value constant. Usually it is easier to adjust the carrying value because EIR adjustment will require again quantifying and finding the EIR. Okay, remember you will do this only and only, this 10% test applies only in case of a financial liabilities. In case of financial asset, there will be impairment provisions that can possibly apply. This 10% rule does not apply in case of financial assets if there is a renegotiation. Further, there can be a transaction cost over here. If there is a transaction cost, you will consider the transaction cost in the present value of modified cash flows at old EIR for the difference working, and then also at the present value of modified cash flows at the new EIR for quantifying the new loan. Obviously, once you quantify the new loan and you pay the transaction cost, then that will be reduced from the liability. But this transaction cost has to be considered for the purpose of PV of modified cash flows at both old as well as the new EIR. Okay, there is a special case of debt for equity swap where you earlier had to pay a loan, however you don't have the money, so you are issuing your own shares. So this is not like a convertible debenture. You had an obligation to deliver cash, however you don't have cash and hence you are settling by paying shares. So this is a settlement of a liability transaction, and hence if you settle by issuing your own shares, and if there's a difference, your loan was 100, you are paying 90, the difference of 10 will go to the P&L because it is a settlement of liability transaction. But it is possible that only 50% of the loan is settled by issuing shares, the remaining 50% continues. If it continues without any modification, no problem, but if it continues with modification, then again you will have to apply the guidance that you studied for the purpose of modification accounting. Okay, next we have impairment of financial assets. For financial assets which have contractually agreed cash flows, remember these are typically debt instruments which have contractually agreed cash flows. Equity instruments do not have a contractually agreed cash flows. For instruments which have contractually agreed cash flows, if your expected cash flows are less than what is contractually agreed, then there is a possible indicator of impairment. And if there is an indicator of impairment, you will try to find what is the value that you are recovering today, that is the present value of the expected cash flows discounted at the given EIR, and the difference between the two is the impairment loss. Remember, impairment loss is only calculated for financial assets which are accounted for using amortized cost or FVTPL. That to debt instruments, not for equity instruments because equity do not promise any contractually agreed cash flows. And secondly, for instruments which are there in FVTPL, by the way, automatic impairment happens. The instrument is already at fair value and the gain or loss, if any, is already going to the P&L, and hence you don't need to do any further workings for the same. So over here you will do impairment, let us say for impairment for the purpose of this calculation. The second part over here is the calculation of expected credit loss can be calculated using various rates like the loss rate method, the probability of default method, debtor aging schedule, but you can calculate the expected credit loss. This expected credit loss can be calculated for financial assets depending on the stage in which they appear. Stage 1, there is no change in the credit risk, so you can create a provision based on the 12-month expected credit loss, 12-month probability of default. However, if there is a significant increase in credit risk, you go to stage 2, in which case you create a provision based on the lifetime probability of default. And if you go in stage 3, there is a credit impairment, in which case the buyer communicates that he is unable to kind of pay, or the issuer communicates they are unable to pay, in which case over here there will be a lifetime probability of default for the purpose of calculation. Interest recognition in general happens based on the gross amount, except if there is an impairment in stage 3 where your interest recognition will go as per the net amount. Okay, so this is your expected credit loss method. A special accounting treatment for financial guarantee. For financial guarantee, let us say if it is at market, bank account debit to financial guarantee liability in the books of the surety. However, if it is off market, like a parent is giving a guarantee for subsidiary, subsidiary is not giving anything in return, in which case you will have to find the fair value. Fair value over here is calculated as a higher of the present value of the interest savings discounted at the original rate, or loss allowance, whichever is higher will give you the fair value. You will continue to remeasure this financial guarantee at fair value because it is one of those 6 items which is recorded using the FVTPL principles, and hence any differences in fair values will be taken to the profit and loss account. So For financial guarantee, remember at initial as well as each balance sheet date, you will take the present value of future benefits, that is interest savings, discounted at the rate at which the entity can borrow on its own, or the loss allowance, select whichever is higher, and do the FVTPL accounting for the guarantee. There's a separate sum that we have solved and a detailed video for the same as well. If you want to refer that, you can refer that separately. Okay, next we have hedge accounting. Hedge accounting, remember, is not very important from an exam perspective, that it is optional in practice as well. So when will hedge accounting apply? When an entity can designate a particular hedged item and on that designate a particular hedging instrument and establish an economic relationship between the two. If it has risk management policies and it can document that there is an economic relationship between the two, then it can follow hedge accounting. If it does follow hedge accounting, it can classify the hedge into one of the three categories. There is fair value hedge, cash flow hedge, or hedge of a net investment in a foreign operation. In case of a cash flow hedge or in case of a fair value hedge, typically the gain or loss on the hedged item as well as the hedging instrument will go to the P&L, except if the hedged item is investment in equity shares recorded at FVOCI, then in this case both hedged item and hedging instrument gain or loss will go to the OCI. In case of a cash flow hedge, usually the gain or loss on the derivative will be recorded in the hedging reserve as a part of OCI till the time the cash flow goes to the P&L. Whenever the cash flow goes to the P&L is the same time where the hedging reserve, which is a reclassifiable OCI, will also be transferred to the P&L. And last is the net investment of a foreign operation. In this case, you might have a foreign subsidiary where you are having, let us say, an FCTR. FCTR is shown as a part of OCI, and hence if you have taken a hedge for this foreign exchange element, that is to prevent the foreign currency gain or loss. Now that foreign currency gain or loss FCTR is sitting in the OCI, so the gain or loss on the derivative will also sit in the OCI. It will be transferred to the PNL when the FCTR goes to the PNL. So these are the three items. There was an amendment that is on account of the IBOR reforms, that is the interbank offer rates moving out and then benchmark rates like SOFR or SONIA coming in, where Ind AS has just clarified that your hedge will still be treated as effective irrespective of the fact that earlier it was benchmarked against a LIBOR. Now probably it is benchmarked against some other benchmark interest rate. So this kind of takes care of the theory section of financial instruments. I hope this has been comprehensive and clear for you. Now we will go to, let us say, the questions for this. So if you go to the questions, we are on page number, I think, question number 1, page number 200 of your sheet. Okay, so let us review these questions. Question number 1. In this particular question, you have a company, let us say KK, who is giving a loan to its subsidiary YK, and this loan has three possibilities. One is it is a loan which is repayable on demand. Second is a loan which is a term loan for 3 years, and third, it will be repayable when the subsidiary, let us say YK, has enough funds. So over here, what will be the accounting treatment? So first they said that the loan is given to wholly owned subsidiary, is interest free, and such loan is repayable on demand. Whenever the loan is repayable on demand, one needs to remember that the fair value will equal to the transaction price, which is equal to 10 lakhs. So in the books of the lender, that is KK, the entry will be loan account debit 10 lakhs to bank 10 lakhs. There is no gap to create, let us say, anything else. Second, in each year, if the loan is not repaid, it is a 0% interest loan, there will be no interest. So there will be no further entry. In the books of YK, that is a recipient, you will receive the loan bank account debit to, let us say, loan, and that is 10 lakhs. And as a result, there is no further entry other than that. Second, the said loan is interest free and will be repayable after 3 years from the date. The market rate of interest is 10%, and considering the same, the fair value is 7,51,000. In which case, in the books of KK, who is giving the loan, the entry will be loan account debit 7,51,000 to bank 10 lakhs, and hence the remaining 2,49,000 or something will be taken in investment. This is because it is a holding subsidiary relationship. Am I giving this to you at a lower rate, and hence 2,48,000 will be treated as investment. That investment will continue as it is. There will be no change in the investment amount, and each year you will record interest. So in the first year, 75,000, 132 will be your interest. So that will be loan account debit to interest income. And similarly, in the books of YK, I will receive, so it will be bank account debit 10 lakhs, to loan, the liability of 7,51,000, and to capital contribution of 2,48,000 or so, that will continue to appear, the balancing figure. Each year your interest will be recorded, interest account debit to loan, that is 75,000 in the first year, and so on in the second and the third year. Your capital contribution will continue to appear. When you prepare consolidated financial statements, loan given, loan taken, eliminated. Investment, capital contribution, eliminated. Interest income, interest expense, eliminated. So basically the transaction in a way is a nullity when you prepare CFS. And third, the loan is interest free and would be repaid as and when YK has sufficient funds to repay. Now, in such a case, it is not a loan repayable on demand. You will have to estimate how many years will it take for YK to have that sufficient funds and accordingly do the working in a manner which is similar to sub point 2. The question also asks that what will be the case if YK, that is a subsidiary, were to give to the loan to KK. In such a case, there would be a hidden dividend distribution because subsidiary giving to the parent is like distribution. Parent giving to subsidiary is like an investment. So this is like your question number 1. In case of holding subsidiary cases, if this was an employer-employee case, there would be a prepaid staff welfare. Landlord-tenant case, there would be a right of use asset or unearned lease income and so on. So this is question number 1. Next you go to question number 2. This is a 2-time exam question as well. In this case, you had a loan where you are given to the employee, and if you have given this loan to the employee, again at off market terms. So if you go to see, this is a loan given to Mr. X, who is the executive assistant. The loan amount is 10 lakhs. Interest rate on the first 4 lakhs is 4%, 7% for the next 6 lakhs. But if you go to see, this is a loan with the term of 5 years. You have been told that the market rate of interest on a comparable loan is 12%. So how do you know that this is a loan at off market rates? There are 2 things. First, it has been told that WHEEL has a policy of giving subsidized loans to employees. So there is a reason to employees. And second, the market rate is different. So this seems to be an off market transaction, and as a result, at initial recognition, you will try to find the value of the loan. How will you find the fair value? Well, as the present value of future cash flows. So you have been given the cash flows over here, but even if they were not given, you could have calculated. In the first year, if I take the total over here in the first year is around 2 lakh, I think 58. Then in the second year, just a second, this is 2 lakh 58. In the second year, this is 2 lakh 42, then it is 2 lakh 30, then it is 2 lakh 16 and 2 lakh 8. So these are your cash flows, and you try to find the present value at the rate of 12%. So as you go to see 2 lakh, all of these numbers discounted at the rate of 12%, and you get 8 lakh 43. However, you have given a check of 10 lakhs. So your entry will be loan account debit 8 lakh 43 to bank 10 lakhs, which means a balancing figure around 1 lakh 56,000 and something will be attributable to prepaid staff welfare. So there is a prepaid EB which is 1,56,114 in this particular case. Now subsequently, your loan will be recorded using amortized cost method. Your prepaid EB will be 156,114 divided by 5, and hence 31,223 of the prepaid EB will be recorded to the PNL over each of the years. This will continue for 2 years, because at the end of the second year you see that there is a prepayment that is happening. So what you do is you will continue recognizing the interest for 2 years at the rate of 12%. So your loan comes to 5,25,610, and you will recognize your EB amortization also for 2 years. Now going forward, there's a 4 lakh rupee payment, and hence you currently, now out of the 10 lakh loan, you have paid 2 and 2 and another prepaid another 2 lakhs, and hence you are left with another 4 lakhs. Now you will say that this 4 lakhs is going to be discharged over the remaining 2 years. The outstanding principal is only 4 lakhs, and hence the rate of interest is 4%, and as a result you will try to find the remaining cash flows over the next 2 years, which is given in the question. But even if not given, you can say that in the next 2 years the cash flows are going to be 2 lakh 16 and 2 lakh 8, discounted at the rate of 16%, discounted at the rate of 12%, this will come to 3 lakh 58. So ideally in your ledger, when you see 5 lakh 25, this 5 lakh 25 due to this early payment will come down to 3 lakh 58. So the difference between the two of around 1 lakh 66,000 and something, if I'm not wrong, this difference will be reduction in loan, but you are actually paying 2 lakhs, or you are receiving 2 lakhs. Your entry will be bank account debit 2 lakhs to, let us say, loan. The difference between these two, as you see over here, this is the important entry. Bank account debit 2 lakhs to loan. The difference between 525 and 358, this is 166. The remaining is a reduction of staff welfare. So your staff welfare, which was earlier 156,114, out of which 31,223 and again 31,223 or something, and you're left with 93,000 and something. But we are saying that that is assuming that you are going to get benefits over 3 years. You are prepaying, and hence you are not going to get benefit for one of the years, and hence 33,074 is to be reduced. So from this 33,074 is reduced, and hence you are left with 60,694 to be spread over the remaining 2 years, and hence around 30,300 and something. So 30,300 approximately will be recorded over the next 2 years. Your ledger balance will be now 3,58,684 after this entry, which you will amortize at the rate of 12%, and ultimately this will also come down to 0. So this is a loan at off market transaction where you show prepaid EB, continue that for 2 years, then there's a prepayment find out how to allocate the prepayment. You'll say first part of the prepayment will be attributable towards the loan, the reduction in the loan balance, and then the remaining will be against the prepaid EB, and accordingly you will solve for the further years as well. Okay, next you have question number 3, which is on compound financial instruments along with transaction cost. In this case, if you go to see ignoring the transaction cost, you can read this question. Ignoring the transaction cost, you are getting a total issue proceeds of around 10,000 at the rate of 150, that is around 15 lakhs. Now, this is a compulsorily convertible instrument, and because it is compulsorily convertible, you have an obligation to deliver cash for the interest. So that is around 15 lakhs into around 10%, that is 1,50,000, obligation to pay 1,50,000 over a period of 5 years. Do I have an obligation to pay principal? No, it is compulsorily convertible, and hence you find the liability component as 1,50,000 into the PVAF at the rate of 15%, ignoring the transaction cost for a period of 5 years. If you go to see the working over here, will give you a liability component of around 5,02,830. Total issue proceeds 15 lakhs, and hence the difference between the two would be 9,97,170, which is the equity component. So technically your entry should have been bank account debit 15 lakhs to liability component 5,02,000 to equity component 9,97,000 approximately. However, there is a 2% transaction cost, and hence 2% of 15 lakhs, that is equal to 30,000. Now 30,000 is attributable both to the liability and equity component, and hence you will allocate the 30,000 in the ratio of the liability component, that is 5,02,000, and equity component, that is 9,97,000, and hence you will allocate in this ratio. So over here you will get 10,000 attributable to the liability and 19,000 attributable to equity. Now you can even directly do this. You can directly take the liability and equity component and then subtract minus 2% directly. You will get the same answer. However, this is how the institute has solved, so preferably do it this way. Now what do you do with the transaction cost of 10,000? Well, this is liability at amortized cost, and hence you will subtract the 10,000. Equity at equity method, so you will have 19,994 and you will subtract the same, and hence this will give you the net components 492 as well as 977. You will subtract these two, and this will give you the net balance. Going forward, you will record the liability component at effective interest, but effective interest is not 15%, it is 15.86%. 15% is the rate, that the market rate of interest for a similar instrument. You have to pay the market rate of interest, but over and above you have to also meet the transaction cost, and hence your effective cost is around 15.86%. and for you, for example, 492,773 into around 15.86%, around 78,154 will be your interest in the first year. Second year, third year, you keep on doing this. Your entry will be, let us say your entry would be interest account debit to liability component, first with 78,000 and so on for 5 years, and then each year liability component account debit to bank, let us say 1,50,000, karte over 5 years this will become 0. At the end of the 5th year, your equity shares will be issued, so equity component account debit in your ledger, equity component will be 977,277 to equity share capital. So let us say that is whatever is a share capital, 10,000 at the rate of rupees 10 each, that is 1 lakh, to the remaining 8,77,277 will be a part of your securities premium. So this will be the equity component to equity share capital to securities premium. Maybe over here in printing, maybe in some of the cases you might have seen that the interest workings have been kind of interchanged, but nevertheless at a conceptual level we have kind of done the discussion over here. Okay, so you have question number 4, which is also a question of compound financial instrument. If you refer, this is on early redemption. So over here, the fact that it is an early redemption, the fact that it is happening as an early redemption, the institute implicitly assumes that it is redeemable in the first place where it is early redemption. So over here, what do? You first say that till the time of early redemption, you will have to find the ledger balances of the liability component and equity component. So first you will do the segregation between liability and equity component. So for this, you will first ask yourself that is it a compulsorily convertible instrument or optionally one? Question 3 had compulsorily convertible. Question number 4 has optionally convertible, where the option to convert is with the holder, in which case you will try to find the liability component, which is you are going to receive 5 lakh rupees, 5 lakh into 8%, that is coming to around 40,000, a contractual obligation to deliver cash, 40,000 for 5 years, and then because it is optionally convertible, you will pay 5 lakhs at the end of the 5th year. And as a result, when we do this working, you will say that liability component will come to 427,700 and equity component is 5 lakhs minus 427,700, which is 72,300. This is your entry at initial recognition. Next, over the next 3 years, your equity component remains the same, that is 72,300, but your liability component moves from 427,700 using amortized cost method at the rate of, let us say, 12%, you will come to the ledger balance of around 465,912. This is there in the liability component in your ledger. Now early redemption happens at 5,25,000. Now out of the 5,25,000, we don't know how much is attributable to the liability. Well, we say that the fact that a holder is ready to early redeem, he is foregoing the cash flows of 40,000 and 40,000 for the remaining 2 years, and his ability to get 5 lakhs at the end of the second year, not 5,25,000, 5 lakhs at the end of the second year. And hence, how much will the holder minimum need for that? So that is 40,000 discounted at the market rate prevailing. Then I think this is 9% for the next 2 years plus 5 lakhs for the second year, and that will give you around 4,91,000. That comes to around 4,91,360. So is the holder agreeing at 491,360? No, he is demanding 525. So maybe the additional he is demanding for the equity component, that is 33,640. So now when you do the settlement, you will say liability component account debit, whatever is there in your ledger, 465, you will debit 465 to, let us say, bank. You are paying 525, but out of 525, 491 is towards the liability component. So to bank 491, and hence the remaining 25,448 is a loss on settlement of liability, which will go to the profit and loss account because it is a liability settlement. However, when we look at, let us say, equity, your equity component debits by 72,300 to bank. Let us say you are settling at 33,000 and something, and hence the balancing figure over here is a gain, but this gain will go in other equity, that is retained earnings, because it is a owner to owner transaction. So this is a point that you have to remember. Apart from that, one needs to remember that the redemption price and the settlement price are two different things. Conversion price is different, redemption value is different. You may redeem at 100, but the conversion price is the price that you are going to pay for each share, which may be different. So merely because in this question a conversion price is at 5% premium does not mean that the redemption happens at a 5% premium. Okay, next you go to question number 5. This question is on derivatives. So over here you have, as Samco, purchased a dollar forward for $20,000 at the rate of ₹68. Now this is a forward contract on dollars, that is a currency. It is not a commodity, it is not own equity, and hence it is a derivative. If it is a derivative, it is going to be accounted for using fair value through profit and loss account, that is FVTPL principles. So over here if you go to see, the fair values are given on initial, the fair value is 0. How do you say that initial fair value is 0? Well, the question says Samco did not pay any amount on entering the contract. So if Samco did not pay anything, that means there is no premium attached, and hence the initial recognition value, let us say, is nil. So this is, let us say, no entry at initial recognition, but at the end of the first quarter, the fair value appears to be, let us say, 25,000, and as a result this is a negative value. So that's a derivative financial liability, fair value loss account debit to derivative financial liability, 25,000. However, in the next quarter the fair value changes to 15,000. How that is calculated? It is given to you 15,000, your liability is at 25, you have to bring it down to 15. So derivative financial liability debited by 10,000 to fair value gain credited by 10,000. Okay, and then on 30th September this comes to a positive 12,000. So you are going to take it up from a derivative financial liability to a derivative financial asset. So derivative financial liability debit 15,000, derivative financial asset debit 12,000 to a fair value gain 27,000. So this is what you get. Now at the last day you have not been given the fair value, but you have been given that the spot rate is 66. Now you have a forward contract, which means you will have to buy the dollars by paying 68, but these dollars today are worth 66 only, and hence you will say bank, USD bank account debit $20,000 at the rate of ₹66 to bank, the INR bank, that you are paying $20,000 into the agreed payment in rupees of 68. So this is, let us say, bank of USD account debit 1320 to let us say bank of 1360. Derivative financial asset was, let us say, 12,000. You will credit that to derivative financial asset of 12,000, and hence the balancing figure will be taken as fair value loss. Now this is if there was a gross settlement. If there was a net settlement, rather than you paying the entire 1360, receiving $20,000, you would pay just the net difference, that is 68 minus 686, that is ₹2 for every dollar, into $20,000, that is 40,000. So this will be, let us say, something account debit to bank. So fair value loss account debit to bank to derivative financial asset, your effect will still be the same, 52,000 to bank, let us say 40,000 to derivative financial asset 12,000. This is if there's a forward contract. There could have been also an option contract, in which case you would have paid a premium initially, in which case your entry initially would have been derivative financial asset account debit to bank, and accordingly you would have found the fair value by comparing the derivative financial asset balance. At the end, you will not blindly exercise, you will see that whether it is worthwhile to exercise or not. Like in this case, if you had a call option to buy, you will not necessarily buy at 68 when in the market it is available at 66, in which case at the end there will be no separate entry. So that is a possible case over here. This is question number 5. Okay, next you have question number 6. This is derecognition of financial liability. So 2 questions on loans at off market rates, including special cases, 2 questions on compound financial instruments with special cases, 1 question on derivative, and 1 question on derecognition of financial liability. Question number 6. Apart from that, you can also refer a question on financial guarantee, which is also separately there. Okay, Wheel Company borrowed 500 million from a bank on 1st January 11. So this is borrowed. So this is a financial liability and you have been given the original terms. The important part over here is there is an upfront processing fee of 5.87 million and your coupon rate may be 11%. You have been given that the effective rate is 11.5%. Now, a lot of times students say that, sir, this is a transaction off market. Remember, off market does not mean that the coupon rate is different from the effective rate. Coupon rate can be different from the effective rate due to transaction cost, due to premium on issuer redemption. It is off market if there is some other hidden element other than pure lending and borrowing, which is not the case over here. If you are confused, you still find the present value of future cash flows, it will come to the same amount. But if not, you can save time by saying that, well, you know what, the value at initial recognition should be 500. Fair value is equal to the transaction price minus the transaction cost. Transaction cost over here is 5.87. And hence, if I take the difference, 500 minus 5.87, this comes to around 494.13. So your initial recognition will happen, for example, at 494.13, on which you will prepare the amortization table at 11.5%. For the first year, in the first year, your payment of 100 of the principal as well as 55 of the coupon will be paid. But in the second year, you are able to pay the coupon but not the principal. And as a result, when you try to find, let us say, the carrying value at the second year, it will come to around 397.48. There is certain degree of modifications that are happening. So if there are modifications which are happening, you will compare 397.48 with you will compare this 397.48 with the present value of modified cash flows, but at the old EIR, because you want to find the difference to see whether there is substantial modification or not. So you will find that there is 400 of principal outstanding now to be spread over the next 10 years. So 40 paid in each year, coupon rate of 15%. And as a result, you will try to find the total value, which comes to probably 194 as the case may be in each of these, discounted at 11.5%, and hence the present value comes to 451. So the PV of modified cash flows at old EIR is 451. The existing carrying value is around 397. The difference between the two divided by 397.48, that difference comes to around 13.6%, in which case it is greater than 10% and hence a substantial modification. If it is a substantial modification, extinguishment accounting applies, and under extinguishment accounting, you will derecognize the old loan and create a new loan. The old loan in your ledger is appearing at 397. So your entry will be old loan account debit 397 to new loan. Achha, can you create the new loan at 451? No, 451 is the modified cash flows at 11.5. Now you will have to calculate the modified cash flows at new EIR, which is going to be not 11%, which is going to be 15%. And as a result, if you find this working, this comes to approximately 400. And hence your answer would be old loan account debit 397 to new loan 400, and the balancing figure 2.52 will be the loss on extinguishment, which will be taken to the P&L. Subsequently, in each of the subsequent years, you will recognize the effective interest at the rate of 400 into 15%, that is equal to 60, and then you will recognize loan account debit to bank. So you will pay the loan and the total payment of 100 in the first year, 94 in the second year, and so on. Okay, so that takes care of question number 6. Next, you have this question on financial guarantee, that is question number 7. This is a guarantee which is given by Sun, who is a parent, for a loan taken by its subsidiary, that is Moon. So this guarantee, you will try to find the fair value. The fair value is to be calculated initially and then at each of the subsequent years. Here the working is only for 2 years. How will you find the fair value? Well, it is the higher of the present value of the remaining benefits or loss allowance, whichever is higher. Now in the first year, there is no separate, at year 0 initially, if you see the question, there is no separate loss allowance given, and as a result, in line with the institute solution, we have ignored the same. So over here, you will take the present value of the benefits, that is 30,000. How do you get 30,000? You will read the question, you will say that Moon could have borrowed at the rate of 11%, but because of the guarantee, it can borrow at 8%. That means there's a 3% saving on a 10 lakh borrowing. That is 30,000 of saving because of the guarantee in year 1, 2 and 3. So 30,000 of saving. If I want to find the present value for Moon, the borrowing rate is actually 11%. So if I want 1 divided by 1.11, 1, 2 and 3. So if I total up, this is approximately 2.4437. This is the present value of your benefits compared with the loss allowance, which in the first case is not there. So 30,000 into 2.4437. This is around 73,311. So if I go to say initially, my fair value is 73,311. However, has Moon paid me that? No. And hence, this is my indirect investment. So my first entry will be investment account debit to financial guarantee 73,311. Investment now will not change, but financial guarantee will be remeasured using FVTPL principles. So if I go to see my first entry, investment account debit to financial guarantee. Now subsequently financial guarantee at the end of the first year will be measured at the present value of the remaining. So if I were to go to take the guarantee at the end of the first year, only 2 years are remaining. So 1 divided by 1.11, 1 and 2, this comes to around 1.7125. You can solve using other methods as well. So this is around 51,375. I think the loss allowance is given as 1%. In line with the institute solutions, we will take 10 lakhs directly into 1%, which is going to come to 10,000. So we'll select higher of the two, which is around 51,375. However, in your ledger, you are showing this liability already at 73,311. And hence the difference between the two, that is 21,936, is a reduction of liability. Financial guarantee account debit, that is 21,936. To what? Fair value gain in the profit and loss account. Okay, perfect. Now in the second year, if I go to see, there are 2 years done and hence only 1 year remaining. So if someone were to give the guarantee at the end of the second year, that will help me in saving 30,000 of interest for one of the years, which is 1 divided by 1.11, around 0.9009. If I multiply, this is 27,000 and something, 27,027. And if you compare this with the loss allowance, probably this is 3% and hence this is 30,000, higher of the two. So if someone were to ask for a guarantee commission, they would have asked for 30,000. However, in my books, I'm still appearing at 51,000 and something for my liability. 51 and 30, the difference of around 21,375 financial guarantee account debit to fair value gain, which will be going in the profit and loss account. There are different ways. ICI does it slightly differently by preparing amortization method. Nevertheless, your ultimate answer remains the same. Whatever you are comfortable, you can kind of do that. So that probably takes care of financial instruments and the discussion over here. Next, we will go to the chapter of business combination. So we'll go to business combination, that is as per Ind AS 103. The initial part of this topic again involves some bit of theory. So what is business? What is control and what is a business combination? Basically, business combination is defined as acquisition of control over a business. So what is business? Business includes an integrated set of activities comprising of inputs, substantive processes and an ability to generate output. So there are 3 essential ingredients for a business to happen. So there is, let us say, inputs like assets, etc. Substantive processes like organized workforce. So these are processes where the integration with the inputs happens, whereby you have an ability to generate output. Now your actual output may not be a must. Even if you're a startup, you have an ability to generate output that is sufficient for you to say that there is a business. So these are the 3 essential requirements for there to be a business, though separate technical details are also there. Secondly, control. So when you look at control, control refers to the ability to direct the relevant activities. We will again discuss this at a bit of length. So when you look at assessment of business, as per Ind AS 103, you can first check for asset purchase versus business purchase by applying a concentration test, which is optional. So under the optional concentration test, what will you do? We will try to find the total value of the gross assets taken over, compare that with the single most biggest asset and see if substantially all of the value of gross assets taken over is concentrated in a single asset. If it is, concentration test is passed, in which case it's an asset purchase. If not, concentration test fails, in which case you assess for business. It does not automatically become a business. From an exam perspective, if nothing is given, you will not even test for concentration test. You will test only if the question specifically requires you to. So for assessment of business, The litmus test in business is the existence of what you call as substantive processes. But how will you gauge whether there is substantive process or not? So as per Ind AS 103, you will see whether there is existing output or there is no existing output. Like for startups or for companies which have just recently shut probably their operations or temporarily postponed their operations, in which case there is no existing output, in which case there would be a business if you have, let us say, critical processes which are taken over along with organized workforce. If both of them are taken over, then we say it is a business. If not, then it is an asset purchase. So over a critical processes along with organized workforce is a must. Similar condition is also there if you have existing output. So if processes which are critical and organized workforce is taken over, then it is definitely a business. However, even if that is not, if you have certain processes which are unique, which are so scarce that they are difficult to replicate, then even in absence of a business, even in absence of organized workforce being taken over, we will say that there is a business. So if one of the two conditions are fulfilled, that is critical processes and organized workforce, or business with processes which are so unique or scarce that are difficult to replicate, like someone like Google, for example, in which case you will treat it as a business, otherwise it is an asset purchase. Okay. So that is the first thing for business. Second, for control, which is largely defined under Ind AS 110, but control usually is set when we have more than 50% stake. However, that is not what the law mentions. The law says control comes from power which comes from the entity's from the existing rights, which give it the current ability to direct relevant activities. So this is the most important thing. Second, you have exposure to variable returns, and third, there's a linkage between power and these variable returns as a principal. So you're acting on your own account and not as an agent like a CEO or something. You're acting on your own account as a shareholder. You have exposure to variable returns, so you're not like a lender who's getting a fixed return. You are getting an exposure to variable returns. But from where do you get power? Well, power comes from existing rights. Existing rights can come from shareholding or can come from even potential voting rights. Now, potential voting rights, should they be included in the assessment of control? Well, it depends on whether they are substantive or not. What do you mean by substantive? If an entity has a practical ability to exercise these rights, that is when we will include them in the assessment of control. So when do you say that there's a practical ability? Well, usually the practical ability arises if on conversion the financial impact is positive, that is you will gain if you convert, or the economic impact is favorable, like you might get synergies if you convert. However, if it is very expensive to convert, the market price is much lower than the conversion price, and it is unlikely that you will convert. Or if you convert, there will be loss of crucial management or team, then you will probably not convert, and hence you will have to see whether it is likely to convert or not. And if it is likely, then you will include these potential voting rights which are substantive in the assessment of control. And hence your control comes from power comes from the ability to direct the relevant activities, and that comes from existing rights. Existing rights can be existing shareholding or existing potential voting rights which are substantive. Remember, protective rights are to be ignored in the assessment of control. So this is core theory. There should be a current ability to, you should be in a position to convert immediately even if you want to. And second is relevant activities. These are activities which significantly affect the return. Minor ancillary incidental activities cannot be treated as relevant activities. So for there to be a business combination, there has to be a business and there has to be control over that business for it to be a business combination. Okay, scope exclusions, what is not covered under 103? First, asset purchases covered by the respective standard, and second, joint control are covered by Ind AS 111 on joint arrangements and joint ventures. The difference between asset purchase and business purchase is if it is an asset purchase, the respective standards will apply, and typically initial recognition will happen at cost. In business purchase, initial recognition happens at fair value. Transaction cost usually is to be added along with the asset purchase, like stamp duty, etc. is to be added to the land in case of an asset purchase. However, in business purchase, you take over assets at fair value, and hence transaction cost, if any, will go to the P&L. In a pure asset purchase, goodwill will not be created, but in case of a business purchase, goodwill will be separately created. Okay, a few examples of business purchase can be, let us say, amalgamation, absorption, acquisition of a division, or even holding subsidiary relationship. In case of a holding and subsidiary relationship, in my SFS, I will show it as a purchase of investment to be accounted for as per Ind AS 27, either at cost or using 109 principles. However, when I prepare the CFS, in the consolidated financial statements, an acquisition of subsidiary is also treated as a business acquisition, because by virtue of the greater than 50% stake in the subsidiary, I do have control. In my CFS, I will take over assets and liabilities, and if nothing is given, your entries and effects are to be given in the consolidated financial statements only. Next, you have accounting for business combination. This is using the acquisition method. There are 6 steps. First, identifying the acquirer. Usually, acquirer is a person who acquires control. typically they may be the person who pays the PC. However, that is not necessarily the case. There may be cases of reverse acquisition where the person who is paying the PC may not necessarily be the acquirer. You might have to look at a lot of things like the relative voting rights post the combination, whose management is acquiring control, which is a bigger company, smaller company, etc. to determine the acquirer. Step number 1. Step number 2 is the acquisition date. Acquisition date typically is a date when control is acquired. Usually, if nothing is given, the day when the PC is paid and you get the shareholding, the closing date is the date when control is acquired. Other dates like giving the offer, etc. are not relevant. However, it is possible that the parties have mutually agreed to a date which is either earlier or later from that date, in which case that earlier or later date will be the date when actual control is passing, and that is the date of acquisition. In case of multiple stake purchases, 10%, 15%, 30% and so on, the stake where you get control is the acquisition date. It is not the date when every share stake is purchased. The date when controlling stake is purchased is the acquisition date in case of step up purchases. Secondly, there may be a possibility that your acquisition is subjected to regulatory approval. In that case, if the regulatory approval is substantive, that is, the regulator has the power to make or break the acquisition, like a competition commission or RBI, they do have the power, in which case the acquisition date cannot be earlier than the date when the regulator gives their approval. So that acquisition date is typically the date when you get the shares, unless an earlier or later date has been agreed. But even if an earlier or later date is agreed and it is subjected to regulatory approval, then that date cannot be, the acquisition date cannot be a date which is earlier than the date of regulatory approval. Every other date is irrelevant. You may have a date for the purpose of determining net assets, or the date from which profits will be kind of shared. All of that is not relevant. Acquisition date is a date when control is acquired. All other dates are irrelevant. It is important to find the acquisition date because your PC net assets, which are all to be recorded at fair value, will be based on the fair value as prevailing as on the acquisition date. So the first and the second step are not as important, but if they do come, we have kind of tried to discuss this. The steps from the third step are a lot more important in the acquisition method. Third step is calculation of PC, purchase consideration. Fourth step, determining net assets taken over. Fifth step, non-controlling interest. And the sixth step is goodwill or gain on bargain purchase, as the case may be. So if you go to the third step, which is let us say the purchase consideration, your PC refers to payment made to the owners. Owners may be equity shareholders. Owners may also be ESOP holders. Owners does not mean something like preference shareholders who are shown as liabilities. So PC refers to payment made to the owners of the selling company, and owners of the selling company are to be taken as a part of PC. So PC can be paid in what form? Well, it can be paid in cash, it can be paid in the form of shares, it can be paid in the form of debentures or anything. So basically, fair value of these instruments that you are issuing will be a part of PC. Sometimes you might also issue non-cash assets like land. Even these land has to be remeasured at fair value, and that fair value of land will be a part of PC. So basically over here, cash, etc. and fair value of equity shares, debentures, other assets transferred will be a part of PC. There are four important areas which I would treat in PC. First is deferred consideration, where the consideration is going to be paid after a few years, but this has to be paid, and hence you will record the deferred consideration as a part of PC at present value basis. Subsequent accounting for deferred consideration will be based on amortized cost. Second is contingent consideration. This is consideration subjected to certain contingent terms, which will also be a part of PC, but at the fair value, at the initial recognition. This is irrespective of whether the consideration is in the nature of equity or financial liability, irrespective of whether it is probable or not probable. If there is a fair value attached, then that fair value will be taken as a part of PC. Again, this fair value can be calculated like the expected value method, like probability based weighted average, or the most likely value method. But if there is a fair value, that fair value at the date of initial recognition, irrespective of whether it is classified as equity or financial liability, will be taken as a part of PC. Subsequent recognition for the contingent consideration will be depending on its classification. Like if this contingent consideration is going to be settled in cash, in which case the contingent consideration will be a part of FATPL, and hence it will go to the profit and loss, subsequent changes. However, if this is settlement which may happen in entities' own equity instruments, for a fixed number of entities' own equity instruments it is equity, in which case there will be no further remeasurement. However, the settlement may happen for a variable number of own equity instruments, in which case it is a liability, in which case still FATPL accounting will apply. So contingent consideration, initial recognition at fair value, and that is to be recorded as a part of PC. Subsequent recognition depending on whether it is classified as liability or equity, and accordingly FATPL accounting if it is liability, or value at initial recognition in case it is equity. And next you have fair value of the pre-combination element in replacement awards. So when you look at replacement awards, what all are there? Let us say in case of replacement awards. Now replacement awards are like ESOPs. Now for ESOPs, the employee may not have rendered the entire service. So out of the 5 years of vesting period, they may have rendered 2 years of service, 3 years are still remaining. And hence when you try to find or you try to replace these awards and give your own options, a part of this payment is towards service already rendered and a part of it is towards service yet to be rendered. So the part which is towards service already rendered, by virtue of which you have become owners of the selling company, is attributable to part of PC. So this is called as pre-combination element. How do you calculate the pre-combination element? Fair value of the original award as on the date of acquisition into the vesting period served upon the longer of the original vesting period or the total revised vesting period. This will give you the fair value of the pre-combination element in the replacement award, which will be a part of PC. The balancing figure, that is the total minus the fair value of the pre-combination element, is attributable to the post-combination period, which will be taken as a part of EB over the remaining vesting period. So as a part of PC, you will take the fair value of the pre-combination element of the replacement awards. Now, is it necessary that the awards have to be replaced? Answer is no. There is a possibility that the awards are not replaced, in which case you have what you call as a non-replacement award. Again, the workings over here are going to be the same. You will take the fair value of the original award into the vesting period served upon the total longer of the total vesting period, originally or revised. This will be a part of NCI, not a part of PC, because you're not replacing, you're not paying for them. So it will be a part of PC. The post combination element will be recorded as EB with a corresponding credit to NCI. So long story short, in case of replacement awards, pre-combination element part of PC. In case of non-replacement awards, pre-combination element part of NCI. Post-combination element in both cases will be recorded in EBE with a corresponding credit either to SBP reserve if it's a replacement award or to NCI if it is a non-replacement award. So this is regarding that working for replacement or non-replacement awards which are a part of PC. Now a very important case over here is what if there is an existing investment. As per Ind AS 103, you need to calculate goodwill, which is a balancing figure, as on the acquisition date. So every number that goes into the goodwill calculation should be based on the fair value as on the date of acquisition. So the PC that you pay, let us say you had a 15% stake, or let us say you had a 20% stake, and then you acquire another 40% stake. So the amount that you pay for the 40% stake when the control is acquired is a part of PC. But what about the existing 20%? You must have acquired it a few years back. Now, what is the fair value of that? So you will have to remeasure this investment up to the fair value. The difference can go to the profit and loss account. However, if it is measured at FEOCI, the difference can go to the fair value reserve. That is fine. But you will remeasure it, take it to fair value, and then take it as a part of PC. So if there's an existing investment prior to the time control is acquired, you will first remeasure this existing investment, take it to fair value, the difference being taken in the profit and loss account or the fair value reserve depending on the classification, and then the fair value of this investment should be a part of PC. This is one of the most important things. So in your PC calculation, in my opinion, the replacement, the replacement awards, contingent consideration and deferred consideration, as well as the remeasurement of existing stake are all important. Remember, any transaction cost that you pay as a part of the acquisition will be taken to the P&L. This transaction cost, we will discuss this over here. This transaction cost can be directly attributable cost like paying to the lawyers, bankers, etc., or it can be cost which is connected to the acquisition of asset like stamp duty, brokerage, etc. They will all go to the profit and loss. The only exception to this will be in case of new issue of shares, the transaction cost will go to equity directly like securities premium or retained earnings as per Ind AS 109. So if you are issuing shares as a part of PC and there is some transaction cost that is incurred, then subsequently after determining PC, that transaction cost will be adjusted from retained earnings or securities premium as the case may be and not taken to the statement of profit and loss account. Okay, so this is regarding the purchase consideration working. Next, you have net assets. We'll discuss the net assets in some time, but typically net assets have to be taken over, or we can discuss it right now. The net assets have to be taken over, let us say, at fair value. Secondly, assets will be taken over, liabilities will be taken over, but share capital and other equity will not be taken over. Further, it is possible that you might acquire 80% stake in a company, but do you take over 80% of the net assets? No. You will take over 100% of the net assets irrespective of the stake that you have acquired. This is because when you are taking over the company, 100% of the net assets are under your ability to direct the relevant activities, and as a result, you will take over 100% of the net assets, and That is irrespective of the fact that you have probably taken over only 80% of the company. You will still take over 100% of the net assets. So the three important points are fair value, 100% of the assets and liabilities taken over, share capital and reserves are not taken over. And lastly, sometimes it is possible that there are certain assets or certain liabilities which may not be appearing in the selling company's individual balance sheet, like contingent liability, like in process research and development, like value of certain brands or customer relationships. They may not be appearing in the books of the selling company. However, if you can ascribe a fair value to them, then the standard very clearly says that you should rather take them over at fair value irrespective of whether they appear in the selling company's books or not. Like there may be a pending lawsuit which in the selling company's books is given as a disclosure. However, if you as an acquirer believe that there is some fair value attached, then as a part of the net assets, you will take it over at fair value. There is also a possibility that you might get an indemnification for that lawsuit liability. That indemnification will also be taken over at fair value as a part of your net assets working at the time of your business combination accounting. Subsequent accounting for this will be depending on Ind AS 37. The standard says that you will record it subsequently at a value initially recorded as per Ind AS 103 or the value as per Ind AS 37, whichever is higher. Other items include in-process R&D or brands, customer lists, etc., which at the date of acquisition, if there's a separate fair value attached, will be taken over at fair value. Subsequent accounting for the same for additional expenditure will be as per Ind AS 38. Like if it is a subsequent research cost, will be taken to P&L. Subsequent development cost can be capitalized. But at the date of acquisition, if you are paying some fair value for acquiring some in-process research and development, irrespective of how the selling company has recorded it, you can record it or you should record it at fair value. The same guidance also applies to items like brands, customer relationships, etc. Another very important adjustment in case of a business combination, which the institute really loves asking you, is the deferred tax adjustment as a part of business combination. So when you look at a deferred tax, the standard over here says you go back to Ind AS 12, and Ind AS 12 says you will calculate the carrying value of the underlying net assets as per Ind AS, which will be based on the fair value of the assets and liabilities taken over. Second, you compare it with the tax base. Tax base refers to the old carrying value if nothing is given. If a tax base is given, you will take that. So there is a difference. Now remember, you're solving an FR paper and not a tax paper, and hence the difference, unless given otherwise, is assumed to be temporary. Unless a question tells you, if some questions will tell you that the difference is other than temporary, in which case you will not take it into the deferred tax calculation. But if the question says that it is temporary, well, you can take it or you should take it in the deferred tax calculation. The rule generally that you follow is for a net asset, which is an underlying asset at the end of the day, if the carrying value is greater than the tax base, the answer is opposite, that's a deferred tax liability. If the carrying value is lower, the answer is in the same direction, that is a deferred tax asset. We have also discussed the concept behind this, but from an exam perspective, you can remember this rule and determine whether there's a deferred tax asset or a liability at the stage of business combination. But when will we know that we'll have to do this adjustment as a part of net assets? Well, two things. First, fair value of net assets as well as the old carrying value of net assets should be given. If the fair value and the old carrying values are not given, you cannot calculate the difference, and in absence of difference, there cannot be a deferred tax. Second, there may be fair value and old carrying value, but there has to also be a tax rate given. So if there is a tax rate also given, both of these ingredients met, fair value and carrying value available for the selling company and tax rate, preferably of the subsidiary, being given, then you have to do a deferred tax adjustment at the stage of business combination. Your net assets taken over, or the fair value of all your assets and liabilities taken over, plus any deferred tax asset on business combination, or minus any deferred tax liabilities on business combination. So that will give you your net assets taken over. Sometimes there can also be what we say is a non-current asset held for sale in the books of the subsidiary. If the parent also intends to sell these non-current assets, then you will take over these items at fair value less cost to sell and not just at fair value. So these are a few things which can impact step number 4, that is the net assets taken over. Then you go to step number 5, which is non-controlling interest. Remember, the birth of NCI is linked to net assets. You are acquiring 80% stake, your PC is for 80% stake, but you don't take over 80% of the net assets, you will take over 100% of the net assets, and hence you have to show that 20% of these net assets are actually attributable to someone else, and hence you create an NCI. NCI is also part of equity because as per Ind AS 109, this is also evidencing residual interest, and hence it is also part of equity. It is to be shown along with the equity section, equity share capital, other equity, and then NCI, for example. Now, as per Ind AS 103, NCI can be measured at the acquisition date either at fair value, that is the market price of the shares of the selling company, or it can also be measured using proportionate net assets method. That is, you will take over the fair value of the net assets. Let's say the fair value of the net assets that you're taking over is 1000. Of that, 20% is attributable to NCI. So 1000 into 20%, that comes to, let us say, 200, which is, let us say, attributable to the NCI. So when you take over assets and liabilities, your assets and liabilities will be 1000, and let's say 200 will be attributable to NCI. So NCI can either be calculated using proportionate net assets method, which means whatever is the net assets, NCI is measured directly as a percentage of that, or it can be measured using the market value method, in which case the net assets may be 1000, NCI share may be 200, but if you go to buy the NCI in the market, that 20% stake will not cost you 200. Probably at the market price, it might cost you 250 or 300, and hence you are deciding to measure NCI at fair value. If nothing is given in the exam, you will take NCI using proportionate net assets method and not using the fair value method. If a question specifically tells you that NCI is to be calculated using the fair market price, you will take the NCI at fair market value method. Okay, next you go to the goodwill over here is calculated as PC, which is for 80% stake, plus NCI, which is for 20% stake, minus net assets, let us say, which is for 100% stake. So when you actually try to find the goodwill workings, you will say PC plus NCI minus net assets. That is going to give you the goodwill. PC for 80% plus NCI at 20% and less net assets for the entire 100%. So that will give you the goodwill. If the number is positive, that equation gives you a positive number, that is goodwill. If NCI is calculated using proportionate net assets method, the goodwill will be partial goodwill, that is only the excess payment attributable to your share. If NCI is calculated using the fair market value method, then the goodwill that you calculate is the full goodwill, because that includes the premium that you will also have to pay to acquire NCI. So F for fair value method, F for full goodwill, P for proportionate net assets method, P for partial goodwill, if you want to remember it as a simple rule. But what if the difference is negative? Now, as per Ind AS, this is extremely rare, and they say that if the difference actually comes to negative, you will have to reassess the PC, the NCI, the net assets, and see if the difference is still negative. If it is still negative, then you will further have to see that if there are any reasons which are attributable for this, if there are reasons attributable like a forced sale, distressed sale, etc., then the balancing figure will be shown as gain on bargain purchase, which will be shown in OCI and then accumulated ultimately into a capital reserve. However, if there are no reasons attributable, you will directly take the difference into the capital reserve, because it is a profit on purchase, which is very rare, and as a result, you generally show profit on sales. This is profit on purchase, and hence you will take it into the capital reserve. So this is your working for the goodwill and a possible gain on bargain purchase or capital reserve, as the case may be. So these are your 6 steps when it comes to your acquisition accounting. A few special cases like non-replacement awards can be discussed. Also, there can be certain components of consideration like composite consideration. It is possible that when you are acquiring a company, as a part of that, you are settling an existing non-contractual relationship, like for example a lawsuit which was there, intercompany is getting settled, in which case that payment for the lawsuit at fair value has to be shown separately at fair value. Similarly, there may be a contractual arrangement which may be settled, like there may be a license which may be settled, and as per the institute, the working for the gain or loss as a part of the existing contractual relationship will be done as the gain or loss will be the lower of the fair value less the carrying value or the settlement value. Remember, in a non-contractual relationship, there will be no settlement value. In a contractual relationship, there will be a settlement value. This is not something which is as important. However, the next point, that is contingent consideration versus contingent payment to employees. Now, sometimes what might happen is there may be a company who is having a shareholder who is also, by the way, a key managerial personnel. I might acquire a company and pay a consideration, by the way, to that person, that is a part of PC. However, I want that person to continue in my company, and hence I pay him another 20 contingent on that person, that is a founder, continuing with me post the acquisition for the next 2 years. So that 20 additional is contingent on additional employee service. Now, this is a remuneration cost and not linked to business acquisition, and hence it should be treated as a part of EBE over the next 2 years as per Ind AS 19 and not as a part of, for example, PC. However, in case let us say the payment is not contingent on employee service but on certain profit margins, etc., then it is linked to business, and hence it should be a contingent consideration. But what if there are multiple conditions, some of them linked to service, some of them linked to other than service? So the standard over here says that usually contingent payments The rule for contingent payments over here is if any one contingent payment is linked to service, it will be treated as remuneration cost and not a part of PC. However, if none of the contingent payments are linked to employee service, then it will be taken as a part of PC. Usually contingent payments to owners in their capacity as owners will be a part of PC. Contingent payments to owners who have to continue as employees will be a part of EB, and contingent payments to outsiders for lawsuit liabilities, etc. will be taken as a part of net assets. That is the general thumb rule. So over here, this is considering all of these. A special case over here is the existence of something called as measurement period under Ind AS 103. Now, measurement period is a period that starts from the acquisition date and runs for a period of 12 months from the acquisition date. So if there is any new information that comes within these 12 months, which pertains to conditions existing on the acquisition date, you are allowed to adjust the goodwill, net assets, even NCI if you are measuring using proportionate net assets on the acquisition date retrospectively. So usually once a goodwill is determined, you don't change it. However, if during the measurement period you have recorded the goodwill on a provisional basis and new information is available, which gives you better position of the conditions existing as on the acquisition date. Remember, if within 12 months new information is obtained which is due to new conditions developing after the acquisition date, that is not adjusting. You will take it against the P&L, for example. However, if it pertains to conditions existing on the acquisition date, you are permitted or rather required to adjust goodwill as well in this particular case. Okay. So that takes care of the measurement period and the business combination workings. Next, you have something called as common control combination, which is given in appendix to Ind AS 103. What do you mean by common control? If the two parties who are entering into a so-called business combination were prior to this business combination controlled by the same shareholder or jointly controlled by the same set of shareholders, then the combination is treated as a triple C, that is common control combination. So in a common control combination, the control continues to remain with the same parties both before and after the combination, in which case it is called as a triple C. However, the only exception over here is that the common control which was existing prior to the date of acquisition was not transitory. It was not a temporary common control, in which case you will not consider. Okay, so there are various examples like two subsidiaries merging or a subsidiary merging with the parent company, or certain cases of demerger can be treated as a common control combination. While evaluating for a common control combination, one needs to remember that there has to be control with the same party pre and post the combination if there was control, or there has to be joint control by exactly the same parties both pre and post the combination. If there was no control pre-combination between these two parties, so there was Google, there was Apple, no one was controlling Google, no one was controlling Apple. Now Apple acquires Google, for example, in which case we cannot say that there can be a common control combination, because for common control to exist there has to be control in the first place. If there's no control, there's no question of a common control. Okay, if there's a common control combination, what you will do is you will apply pooling of interest method, and your prior periods will be restated from the date the common control originally existed, like you do for bonus shares. The date when you do the common control combination is not relevant. The date from which common control was existing is considered to be relevant over here. In business combination, you will not do any past retrospective restatement, but in a triple C, you have to do a past retrospective restatement. So why are we studying for triple C? Well, if there is a triple C, you will apply pooling of interest method, and there are 4 key features in the pooling of interest method. First, assets and liabilities will be taken over at book values. No new asset to be created, no new liability to be created. Second is, since you are taking over assets, pooling, that is just joining of interest. Since you are taking over the assets and liabilities, let us say at the book values, then the consideration that you will issue will also be based on the book value. That is, you will take the PC based on the issue price, the nominal value of the shares to be issued. That is the face value. You will not look at the market value. If an issue price is given, you will take that. Otherwise, you will take the face value. The market price will not be taken for the net assets. It will not even be taken for the PC to be issued. Third, as a special feature, you are allowed to take over the reserves of the selling company in the same form, provided the selling company closes. If the selling company continues, like in case of a demerger, you are not allowed to selectively take over the reserves. And as a result, the third feature is you are allowed to take over the assets. You are required to take over the assets and liabilities at book values, consideration to be issued based on the nominal values, and reserves are also to be taken over, provided the selling company closes. Fourth, can there be a difference between the PC and the net assets, including the reserves? Well, yes. If there is a difference, that difference will be taken in the capital reserve. It is not goodwill because it is pooling, joining of interest You can't create a goodwill on transacting with your own self, and you can't bargain with yourself in the mirror and create a gain on bargain purchase. And as a result, you will show a capital reserve. Can be a debit balance, can be a credit balance. This is a gain or loss on restructuring as the case may be. So these are the 4 essential features of the pooling of interest method. Next, you go to demerger. Demerger is typically unlocking of value, where a particular division which was earlier held by a company may be demerged into a separate company, maybe for better management focus, maybe for selling it off, maybe for whatever reasons, but we are doing accounting. Here, there are 3 possibilities of a demerger. Possibility number 1, the new company issues shares to the selling company, in which case the new company acts as a wholly owned subsidiary of the original company. So in the first case, since the new company is acting as a wholly owned subsidiary, the control of the division that is getting transferred is still with the original company, because that company still continues the wholly owned subsidiary to have control over the wholly owned subsidiary, and hence there is a triple C. Second case, it is possible that the PC is not given to the selling company but to the shareholders of the selling company, and there is a controlling shareholder in the selling company. If there is a controlling shareholder in the selling company, for example, X Limited is the selling company which was controlled by a new company Y is formed which is issuing shares. By the way, they will also issue shares pro rata to A, and hence A Limited controls X, A Limited also controls Y. So the division D2 which was transferred, which was earlier controlled by X and by the way ultimately controlled by A, is now controlled by Y and by the way ultimately controlled by A, and hence it is still a common control combination. However, in the third and the last case, if division D2 is transferred to Y, Y issues PC to the shareholders of the selling company, and there is no controlling shareholder, in which case the division D2 which was earlier controlled by X, not ultimately controlled by anyone, is now controlled by Y and ultimately not controlled by anyone, and hence this is not a common control combination but a business combination, let us say in the books of Y. So 3 cases for demerger from an exam perspective: PC issued by the new company to the members, in which case it will be a PC issued by the new company to the old company, in which case it will be a triple C irrespective of who is the controlling shareholder or not. PC issued by the new company to the members of the selling company, and there is a controlling member, in which case it will be a triple C. And PC being issued by the selling company to the members, and there is no controlling member, in which case it is a business combination. So accounting in the books of the purchasing company, that is Y, will be as per Ind AS 103, because Ind AS 103 applies to the person who is acquiring control over a business. So in the first 2 cases, you will take over assets and liabilities at book value because it is a triple C. Usually you could have taken over reserves, but in this case, because it's a demerger, selling company does not close and hence you cannot selectively transfer the reserves. So reserves in this case will not be taken over, but assets and liabilities will be taken over. You will issue the shares at the nominal value, and difference if any will be taken as capital reserve, gain or loss on restructuring. In the third case, where you will take over assets and liabilities at fair value, reserves definitely will not be taken over. The PC that we will issue, consideration shares for example, will be at fair value, and the difference over here will be goodwill or gain on bargain purchase as the case may be. So this is your triple C accounting and this is your business combination accounting. Remembering that even in this case, if there's a triple C, you will not take over the reserves because the selling company continues and you cannot selectively transfer the reserves. Now the problem arises in the books of the selling company. Remember, the accounting for the selling company is as per GAAP. Ind AS 103 applies in the books of the company who is acquiring control. Here we are giving up certain assets, in which case generally accepted accounting practices would say, if you are giving up assets, you will credit the assets. If you are giving up liabilities, you will debit the liabilities. So you will credit the assets and debit the liabilities. In return, are you getting anything? Well, only in the first case you are getting shares of the company, in which case you will debit the investment in the first case. In the second case, you as a company are not getting anything. Your shareholders may be getting, but shareholders are different, the company is different. And as a result, in the first option, liability debit at book value, assets credited at book value, investment is debited over here, and balancing figure if any will go in the capital reserve. The second entry is exactly the same, just that the investment does not appear because shares are directly going to the members. Otherwise everything remains the same. But the problem arises in the third case. In the third case, what happens, and the institute had one question on this which they've deleted now, but nevertheless from an exhaustive understanding, what happens over here is there's a distribution of non-cash assets to the owners, and hence an appendix to Ind AS 10. There's a guidance on appendix to Ind AS 10 which says that if you're distributing non-cash assets to owners like cars, like shares of a demerged company, assets, whatever, then you will have to first remeasure the assets at fair value, then derecognize the assets, and the balancing figure, if any, will be taken as dividend, or not dividend necessarily, distribution to owners, which will be shown as a part of retained earnings and not as a part of capital reserve. So over here, what will you have to do? In case 3, before derecognizing the assets and liabilities, you will remeasure the assets and liabilities, bring it to fair value. The difference, if any, will be taken to the P&L. Once the assets and liabilities are remeasured at fair value, then you will derecognize them. And once you derecognize them, if there's a balancing figure on the debit side, this will be shown as a distribution or dividend, which will be adjusted against the retained earnings. This is based on the specific appendix given to distribution of non-cash assets to the owners. Sir, why are we not doing it in the first case? Because in the first case, there is no distribution. I'm giving those shares to the selling company. Selling company is not distributing it to the owners. In the second case, there is a distribution, but that distribution is in the nature of a common control combination. So the question in the appendix to Ind AS 10 says that the above treatment will not apply to shares in the new company distributed at the time of a CCC, and hence we did not apply this guidance in a CCC. But in the third case, there is a distribution happening and not a CCC, and hence this guidance is applicable, where you will treat it as a distribution which is in the nature of dividend. Okay. Next, you have reverse acquisition. For example, in a holding subsidiary case, usually when you look at a reverse acquisition, the acquiring acquirer will be different from the legal acquirer. Acquisition date is the date when control is obtained, but when you determine the PC, there will be a challenge. PC is a payment made to the owners. In a holding subsidiary case, if I were to take a reverse acquisition, the PC that you are paying will be usually payment made to the owners of the purchasing company, because it's a reverse acquisition. But that cannot be taken as PC, and hence you will have to somehow find the payment to be made to the owners of the selling company, which will be the PC. Similarly, the net assets taken over will be the net assets of the accounting acquirer, who is basically the legal acquiree, that is the target. And hence, the goodwill that is to be calculated will be based on comparison with the PC and the net assets, and accordingly goodwill will be calculated. So this is on reverse acquisition in a holding subsidiary setup. If the question says that you have to prepare the consolidated balance sheet, one needs to be remembering that the consolidated balance sheet in this case will be in the name of the legal acquirer, but it will represent continuing financial statements of the accounting acquirer. Continuing financial statements which means that if there's an accounting acquirer B, then the assets and liabilities of B will be at book values, but the assets and liabilities of A will be taken over at fair values. The reserves of B will continue, the reserves of A will not be taken over, and in the equity section you will take equity as the share capital of the accounting acquirer plus the PC. You will not show the breakup. You will directly show that as PC plus the share capital of the accounting acquirer, and that will be the total value. We will do that probably along with the sum. But because it is in the name of the legal acquirer, let us say that is A, this will represent the number of shares in A. Now this is a slightly or a lot more complex thing. One is for holding subsidiary, one is in case of amalgamation. We will discuss the two problems. You should also go through the same. But having said that, don't spend an inordinately long amount of time over here. Have a broad understanding and then proceed. We have a detailed video on reverse acquisition, which you can also find separately on YouTube. Okay, so these are the various cases based on which we can try to do a few problems. So let us go to question number 1, page 219. Okay, so first question is on demerger. Enterprise over here has two divisions. One is the laptop and mobile division, and it is demerging the mobiles division. So over here, if there is a demerger, what do you have to say? We have to say that it is demerged to a new company called as Turnaround, and Turnaround is issuing PC. To whom is it issuing the PC? If you go to see, we have been told that Turnaround, which is a new company, allotted 1 crore equity shares to the members of enterprise. So which means it is not allotting it to Enterprise Limited, allotting it to the members in full settlement of consideration in proportion to the shareholding. One of the members was holding 52% stake in the company. So PC is given to the members, and there is a controlling member, and as a result over here your control is being maintained with the same controlling shareholder, and hence this transaction is treated as a CCC. Remember, if the question remains silent, it does not tell you whether there is a controlling member or not. You will look and scan through the question for other information to figure out whether there is a controlling, whether this showcases the evidence of a common control combination or a business combination. You are required to pass the journal entries in the books of enterprise. Enterprise is a selling company, so if you pass the journal entries, you will credit the assets. So you will credit the fixed assets of 500, credit the current assets of 500. You will credit the assets, you will debit the liabilities. So what are the liabilities? Well, provision for depreciation, if you show it as a separate account, will be debited. Current liabilities will be debited, and loan funds will be debited. Now you are giving up all of this. In return, are you getting anything? No, you are not getting the investment. It is going to your members, and hence the balancing figure, if any, will be taken to the capital reserve. Over here, one can always argue that should I remove the losses? The answer is no. Remember, you cannot selectively transfer the reserves, and hence, since the company enterprise continues, you will not be able to transfer the reserves. So if you go to see, your entry will be provision for depreciation debit, current liabilities debit, loans debit. So you're de-recognizing the liabilities, fixed assets debit, credit, current assets credit, and the balancing figure is capital reserve, which is a gain on restructuring you will remove. Next, you prepare the balance sheet. So if you prepare the balance sheet of enterprise, well, at the end of the day, your balance sheet of enterprise will now be largely made up of the laptop division. So you have 25 within PP, 200 within the current assets, 25 within the current liabilities. Your share capital continues to remain at 25 rupees, and in your reserves you will have 75 of total reserves plus 100, which is a part of the capital reserve, and hence 175 worth of your reserves. So when you look at your balance sheet, so this is 175 in your other equity, 25 in the share capital, and otherwise everything else will be similar to that of the laptop division. Then you go to the balance sheet of turnaround. So for turnaround, you will take over the assets and liabilities at book value. So your entry will be, let us say, PP account debit. You will take it over at book values of 100. Current assets account debit, let us say at 500. 2, you will take over the current liabilities of, let us say, I think 400. 2 loan funds you will take over at 300, and then you will have 2 equity share capital, 2 securities premium, 1 crore shares at the rate of rupees 10 each. So this is 10 rupees, and there is a premium of 15. So this is 15, and hence if I say there will be a balancing figure on the debit side of 125 rupees, which is capital reserve. So when you prepare the balance sheet of turnaround, there will be 100 of PP, there will be 500 of where do you see 100 and 500 in the share capital. You will have 10 crore rupees. In the reserves, you will have 15 for the securities premium minus 125 debit, and hence there is a negative 110, and the other 300 for the loan funds and current liabilities, and accordingly you will have the total. So this is kind of a possible demerger question which has come in the past for around 10 marks. Next, you have this question which is on reverse acquisition, but before we do these reverse acquisition questions, we will do another question which was the May 23 question, I think. Okay, so there's, I think, question 4, and then we'll also do the May 20. So we'll do regular acquisitions first, and then we will do reverse acquisition. So we'll do one. So we have done one question on common control, that is involving demerger. Here you have existing stake. On 1st April 11, P acquired 30% of the voting power. So that gives you a significant influence, does not give you control, and hence you will account it using the equity method for 8,000, and it is accounted using the equity method as per Ind AS 28. Under the equity method, during these this 1 year, you have recorded your share of profit, your share of exchange differences, that is FCTR, and your share of the revaluation, and hence if you go to see 8,000 was the initial balance. If you add all of this, it will come to 8850. The question also tells you that 8850 is your carrying value of investment. That is perfect as per Ind AS 28. Investment account debit to bank, first 8,000, then investment account debit to consolidate PNL 700, to consolidate FCTR 100, to consolidate revaluation, let us say 50. So that comes to, let us say, 8850. On 1st April 2012, PQR acquired the remaining 70% for 25,000. So that gives you control. Earlier you had 30, now you have another 70. That gives you control. So what will you have to do? Well, you have to remeasure the existing investment which is appearing at 8850. You will have to take it to the fair value. Okay. The additional information, you have existing investment, fair value is 9,000, and the net assets are 30,000. How will the business combination be accounted for? Well, you will first remeasure the existing investment from 8850 to 9,000. So that is a gain of 150 rupees, and this gain of 150 rupees will be taken to the profit and loss account. Investment account debit to gain on remeasurement will go to the profit and loss account. Second, you will take over the assets, you will take over the liabilities. So net assets account debit, let us say 30,000. To, let us say, bank, you are paying 25,000. To investment 9,000, and hence the balancing figure, I think, of your balancing figure of 4,000 will be taken as goodwill. Typically, most of the students would say that the question ends over here. However, there is a possibility that what do you do with the consolidated FCTR of 100 and consolidated revaluation of 50, which was built because of investment. But if this investment is derecognized, then the OCI balances pertaining to the investment should also be derecognized, and as a result, you will credit. You will debit, that is remove these items, So in this particular case, you will say consolidated revaluation reserve account debit 50 to what? Well, to the consolidated retained earnings, because it is a non-reclassifiable OCI. Consolidated FCTR account debit to consolidated PNL, because this is again a reclassifiable OCI. Institute had passed all of this as a part of a single entry, but having said that, you can pass these as different entries as well. That is absolutely fine. Okay, next is question number 5. It is a fairly interesting question, a May 23 exam question. It is a combination of the professional dynamic question that is there in your book, I think question 58, and a question 59, where you have this huge question where you have a lot of contingent liabilities, a lot of adjustments. So it's kind of a combination between the two. So there is Swan and there is Duck, and 31st March 2023. You have the entire balance sheet given, and you have been told that on 1st April 23, Swan acquired 80% of the equity shares of Duck. So it acquires control. Swan agreed to pay each shareholder of Duck 20 rupees per equity share in cash, and to issue 5 equity shares of rupees 10 each in lieu of every 6 shares held by the shareholders of Duck. So this is a part of PC. So how many shares are there in Duck? If you go to see, there is 900 and shares of rupees 100. So that is 9 probably lakh shares. Are you acquiring all the 9 lakh shares? No, you are acquiring 9 lakhs into 80%, that is equal to 7.2 lakh shares, and for every share there is a cash that you are paying of probably 20. So this is 7.2 into 20 comes to I think 144. This is a part of PC. Apart from this, shares to be issued, so this is 9 into 80%, and the exchange ratio probably is 5:6. So over here this is 7.2 into 5 by 6. This comes to 6, and every share is worth rupees 100. So into 100, and hence this comes to 600, which is also a part of PC. Swan agreed to pay additional consideration, which is higher of 90 lakhs and 30% of the excess profits. If you go to see further, excess profits is 30 and 40, दोनों के बीच में का difference. So that is 40 minus 30, that is equal to 10 into 30%, that is 3, or 90, whichever is higher. This is 90. But this 90 is to be paid, let us say, after just a second, after 3 years. So into the present value factor at the rate of discount rate, somewhere over here 10% is given. So this is into 10% for a period of 3rd year. So this is 0.7513, and if I multiply 90 into 0.7513, I'll probably get 67 point something, 67.62, which will also be a part of PC. This is deferred consideration. Fair value of PP and investments of Duck on 1st April are 1200 and 300 respectively. So this will be, let us say, 1200. This will be 300. Okay. Duck owns a popular brand. That means a recognition of a business combination. Independent valuers have attributed a 250 fair value for the brand. So will you take over? Well, yes. So the brand will be taken over, let us say, 250 rupees. However, the question tells you that the brand does not have any cost for tax purposes and no tax deductions are available, which just means that tax base is 0. It does not by any means imply that it is not a temporary difference. The question nowhere tells you that the difference is other than temporary. The question nowhere tells you that there are no tax consequences. It just says that the tax base is 0, which effectively means that there will be a deferred tax which the institute has correctly calculated, and we should also do the same. So you have a statement of contingent liabilities, lawsuit filed by the customers. 5 rupees is a fair value we should take irrespective of whether it is probable or not. For this 5 rupees deduction is available. And then there is an income tax demand of 70 lakhs, fair value is 20, it is not probable, but still you will have to take this, and hence 25 is the total fair value of these liabilities. Okay, so this is a part of your net assets taken over. So apart from all of this, you will also have certain liabilities which are worth 25 rupees. For example, there are certain equity settled share based awards which were replaced. So there is a replacement award. As per the terms, the vesting period was 5 years, and on the acquisition date 2 years were served, so 3 years were remaining. And as per the new awards, the vesting period is reduced to 1 year. So your revised vesting period is going to be 2 plus 1, that is equal to 3. Your original vesting period was, let us say, 5. The fair value of the award on the acquisition date was as follows. So this is 12 lakhs and the new award is 18 lakhs. So for the PC, you will say pre-combination element will be 12 into 2 by 5, longer of 5 and 3, that is 12 into 2 by 5. This comes to 4.8, which is also a part of PC. The remaining, that is 18 minus 4.8, that is around 13.2, will be post combination, which will be a part of, let us say, future EBE. Further, Swan has agreed to pay one of the founder shareholders of Duck a sum of 15 lakhs if it stays in the company for 2 years. So this is employee benefit expense, not a part of BC, not a part of net assets taken over, will be recorded as and when the service is rendered. Okay. The acquisition cost is 26 lakhs will be taken to the PNL. So ultimately you will subtract 26 lakhs from the PNL and reduce your cash balance also by 26 lakhs overall. And the applicable tax rate for both companies is 30%. Now, what are the differences? Well, the differences arise due to PP, they arise due to investment, they arise due to the brand, and they arise due to, let us say, the lawsuit liability, customer lawsuit liability. So if I go to see in your Ind AS as well as in your income tax, if I go to see, your PP is coming at 1200, 300, brand is 250, and income tax lawsuit liability is probably coming at 5. Income tax cannot be allowed as a deduction for income tax, so we don't take 25. Tax base over here is probably 1000. This is probably, I think, 240 or something. 240. Brand, there is nothing. Lawsuit liability, there is nothing. And hence, if you go to see, this is what, 1750 minus 5. This is 1745. And this is 1240. So if I take the difference between the two, the difference is, I think, 505, and this is a difference where the carrying value is greater than the tax base, and hence your answer is opposite. So you'll create a DTL of 505 into, I think, 30% over here, which will come to around 151.5. So this will come to around 151.5. This is a deferred tax liability. So if you were to find the net assets taken over, you will find the fair value of all the net assets taken over minus 151.5. So basically, if I go to see my PC on my calculators would be, for example, 144 of cash plus 600 of shares plus 67.62 of deferred consideration plus 4.8 of pre-combination element, that is 816. So if I go to see over here, this is 816. When you do the net assets working, so all of this taken care of, we will take the PP, investments, there is brand as well, and there is a lawsuit liability as well. 1805 minus 151, and this is 1653. If nothing is given, NCI is 1653.5 into, for example, 20%, that is 330.7. And hence your goodwill is, there is a negative, so that is a good gain on bargain purchase or a capital reserve of 506.38. Based on that, you will draw up the entire balance sheet, just remembering that in the cash balance, among other things, you will subtract 26 for acquisition cost, and even while doing the reserves working, you will subtract this acquisition cost. Otherwise, you will just total up the balance sheet in the usual manner. So this is a fairly interesting question. Question number 5, I would treat this as the most important question. Individually, if you have to revise, then question 58 for professional dynamic, and question number 59 you can revise. Over here you have most of the adjustments for these questions. Okay, next you have two questions. One is pertaining to reverse acquisition in case of an amalgamation, and one is pertaining to a holding subsidiary relationship. We'll go to the more important one from an exam perspective, that is question 3, which has also come in the past in your exam. So there is A and B who have amalgamated on 1st January to form a new company AB, and there is AX, BX, the entire balance sheet is given. You are required to issue requisite number. This is the root cause of the problem. You are not given the exact number, you are told to issue requisite number of shares to discharge the claims of the equity shareholders. You are required to prepare a note showing the purchase consideration and discharge thereof and the balance sheet. So over here, assuming both the entities are under common control. So assume both of them are under common control, in which case you will say that, well, you are not being given how many shares to be issued, so that will be equal to the net assets. Net assets over here are going to be at book values, because in a triple C you do not take over the assets and liabilities at fair values, you will take over at book values. Assets, you will also take over liabilities, but will you also take over reserves? The answer is yes, because AX and BX are closing and a new company ABX is forming, and hence reserves are also taken over. So all assets 13050, 15220, 15200 minus the liabilities. So that will give you your net assets before the reserves. So if you go to see, your net assets before the reserves is 9050 and 9700. But you will also take over the reserves, because AX and BX are closing, and hence 3050 and 2700 credit balances, and then 6000 and 7000. So your total consideration will be 13,000, which is 1300 shares of rupees 10 each. The question also asks you to show a discharge. This PC will be fairly discharged between AX and BX in the ratio of the net assets before the reserves, because there is a possibility that one of the companies has huge reserves. So when you want to do a fair discharge, you will have to take the net assets before the reserves, and hence you will take 9050 is to 9700 for discharging this PC, and hence you will get 6275 and 6725. So this is, I think, 6725 6225 and 6275, and this will be your discharge. Now, because your PC is based on the net assets, there will be no separate goodwill or capital reserve that is created over here. Whatever you are taking over is exactly equal to whatever you are issuing, and hence, if I want to prepare the balance sheet, there is a lot of fair value data given, but fair value has to be ignored, and hence what you will just do is you will total up these numbers, and you total up these numbers and you find a balance sheet. Your share capital will be 13,000, otherwise everything else you will total, including even the reserves that are taken over. The second part is a more complex part. Assuming BX is a larger entity and their management will take control over the entity. So this appears to be a reverse acquisition case. There is a soft indicator that BX is a larger entity and their management will take control over the entity. So there are two transactions over here. One is AX with ABX and one is BX with ABX. So when I look at the transaction between BX with ABX, it appears that ABX is the legal acquirer, but BX continues to remain in control. So BX is the accounting acquirer, and hence in line with the institute solution, this is treated as a reverse acquisition, where it is treated as if BX is acquiring the business of ABX, though legally it is ABX acquiring BX, and hence if such a case happens, you will take over all assets and all liabilities of BX at book value. Further, it will represent continuing financial statements of BX, and as a result, the reserves of BX will also continue. Consideration over here, we will have to issue requisite number of shares. If nothing is given, we will say that, well, in such a case, we will, for BX, all assets, all liabilities will continue, the reserves are also continue, and hence the consideration must be 700 shares, which is a share capital of rupees 10 each. So earlier they were shares of BX, now there will be shares of ABX, 700 shares. So these shareholders of BX will get 700 shares of rupees 10 each in ABX. So your ABX balance sheet will nothing but be the BX balance sheet. But when you look at AX and ABX, the control of AX is getting lost, and hence this is an actual business combination where ABX is acquiring AX. Now ABX ka true acquirer is BX, and hence it is a transaction whereby BX acquires AX through ABX, and as a result the assets and liabilities of AX will be taken over at fair value. So you will take over assets and liabilities at fair values, but then when you pay the PC will also be based on the fair value. So over here you will have to pay 11,000. This is like the market cap. So you will have to pay 11,000. That is the PC. So AX will say कि भाई मेरा book value कुछ भी होने दो. You will have to pay me 11,000. That is my market cap. So ABX would say that, well, you know what? In such a case, I am holding the business of BX. The business of BX is worth 14,000 and is depicted by 700 shares, which means the value of each share is 20 rupees. So when I am giving you my share is also worth 20 rupees. So basically, if you are giving me a business worth 11,000 and I am discharging that by issuing my shares, which are worth 20 rupees, I will issue 11,000 divided by 20, that is equal to 550 shares. So basically, if you go to see in the ABX company, you will have AX ke shareholders holding 550 shares and BX ke shareholders holding 700 shares. So that means a total of 1250. Out of this 1250, 700 upon 1250 in percentage, 700 upon 1250 in percentage comes to around 56% stake held by BX and around 44% stake which is held by AX, which substantiates the fact that in the post combination entity, BX ka management is continuing. BX is having control, and as a result, this is a reverse acquisition. So over here, you will say that the PC that is paid for AX is 11,000, but when you try to find the net assets taken over for AX, you will take over at 9,500. Inventory you will take over probably at the fair value, that is 1,300, and everything else remains the same. Apart from that, you will not take over the share capital, but you will have taken over the other assets like 1050, 1800, 450. You will not take over the share capital and reserves, but you will have 3,000 and 1,000. So basically, if I go to see, this will come to 10,100. That is a fair value of net assets taken over, for which 11,000 is paid, and hence there will be a goodwill that will arise of 900 rupees on acquisition of AX. So when I prepare the balance sheet, I will total up BX and the fair value of the assets and liabilities of AX and also show a goodwill. So along with this, there would be a goodwill. So this is probably 17,000. Goodwill is probably 900. Investments are 1,600. Inventory is 4050. Trade receivables 5,800. Cash of 850. Share capital comprising of 12,500, 550 and 700, that is equal to 12,500, 1250 shares of rupees 10 each. In the other equity, there is 2,700 plus as a securities premium of 5,500, and as a result 2,700 plus 5,500 comes to around 8,200 over here. This is 7,000 and this is 2,500. Hopefully, if you have done all of this properly, your balance sheet would kind of tally. So this will be your total balance sheet for this case 30,200. It should ideally be tallying at 30,200. This is your question number 3. Institute has solved it using the reverse acquisition explanation. If it comes in the exam, you also show the reverse acquisition explanation, though you can also show that between BX and ABX there may be a possibility of common control, and accordingly the treatments will remain the same. You will pool the interest, so that is BX will be taken over at book values, reserves of BX will also be taken over, but nevertheless if you want to make peace with the institute, show this as a reverse acquisition, show that brief explanation. AX you will take it over at fair values, create a goodwill. PC will be based on the fair value, that is 11,000, and that is represented by requisite, that is 550 shares of rupees 20 each. Okay, and the last question over here is question number 2. This has never come in the exam, but if it comes, it's fairly complex, and hence we are discussing. Again, for this a detailed reverse acquisition video we have shared on YouTube, so if you want a detailed workings, you can go over there. So there is A who is issuing 2.5 shares for each ordinary shares of B. So there is an exchange ratio of 2.5 shares of A for every share in B. If you see the entire balance sheet, you will see that there are 60 ordinary shares in B of rupees 10 each, worth 600, and hence if A is issuing 2.5 shares for each share of B, 2.5 into 60, that is equal to 150 shares of A will actually and legally be issued. So all of B shareholders exchange their shares in entity B, so all of them give up their shares. Therefore A issues 150 shares in exchange for 60 shares of B. So apparently it appears that A acquires control over B because A is paying the PC. However, if you see the question, it says A is a legal parent but the accounting acquirer, B is a legal subsidiary but the accounting acquiree. So sorry, A is the accounting acquiree, the important alphabet is missing, import acquiree, and B is the accounting acquirer. It is there in the study material as well. So over here there are ways in which you can actually show that in the post combination entity. If you do these maths, you will see in the post combination entity, if A is acquiring all the 60 shares of B and issuing 150 shares to the shareholders of B, the shareholders of B are having 150 shares out of the total 250 shares of A, and hence having a 60% stake, whereas the shareholders of A continue to have 100 shares out of the 250 shares and hence have only 40% stake in the post combination A, and hence it is a acquisition whereby B is acquiring control. A's control is lost, B is acquiring control, and hence it is a reverse acquisition. In this case it is specifically given in the balance sheet, and hence you don't need to show it separately, but otherwise it is a reverse acquisition. If it is a reverse acquisition, what would be the PC? One could say your PC is 150 shares, but that is paid to the shareholders of B, but B is the accounting acquirer. PC's payment made to the shareholders of the selling company, that is shareholders of A, and hence somehow we need to find what must be the PC to be paid to the shareholders of the selling company. So we have been told that the fair value of each share of B is 40 and the quoted market price is rupees 16. So over here you can say that, well, PC is a payment made to the owners of the selling company. So if I go to see, if B Limited had to acquire A for 100 shares of A, B would pay how much? Well, 100 into 1 by 2.5, and hence they would pay 40 shares. So I would pay 40 shares of B in return of 100 shares of A. If I go to see 40 shares of B, each share of B is worth 40, 40 into 40, that is 1600, or 100 shares of A, which is a part of the same transaction, into 16, that is 1600. Either of this is a part of PC. As per the institute, 1600, that is 100 into 16 is taken as a part of PC. As per Ind AS 116, 113, because it is based on the quoted market price. So over here, your PC would be either 100 shares of A into 16, that is equal to 1600, or 40 shares that are going to be issued to the shareholders of A, each worth 40, which is equal to, let us say, 1600. This is basically PC. This is payment made to the owners of the selling company, that is A, on a reverse setup. And hence, if you take over the net assets are also going to be the net assets of A to be taken over. So the fair value is the same. It is just that the non-current assets of A will have 1500. So if I go to see the net assets, 500 plus 1500, that is 2000, minus 300, minus 400, that is 700, and hence you will have 2000 minus 700, that comes to around 1300. PC is 1600. Over here, the difference between PC, that is 1600, and net assets, that is 1300, that is equal to 300 will be the goodwill. Institute does not even discuss anything about the NCI, and hence you can take the NCI as 0. there is a fairly confusing part over here that why should the NCI be 0? Well, because in a reverse acquisition setup, B is acquiring 100% of A, and hence there is no NCI. But nevertheless, institute does not even discuss about this. From an exam perspective, you will take the NCI as 0. So PC of 1600 plus NCI of 0 minus net assets of 1300, and hence 300 will be the goodwill. So if you go to see at the end, they say find the fair value of the consideration transferred, which is 1600, measure the goodwill, which is 300, and prepare consolidated balance sheet. Now when you sit to prepare consolidated balance sheet, you will total up the assets. So basically your assets will be 1200 for the current assets, 4500 for the non-current assets, maybe 300 for the goodwill, and as a result this is coming to what? If I go to say, this is probably coming to 6000. Okay, then you look at current liabilities. This is probably 900. Current liabilities, let us say this is totaling 900. Non-current liabilities, this is 1500. And now you go to the equity section. Apart from that, what will we do? Well, this is continuing financial statements of B. So if it was continuing financial statements of B, B share capital will continue to be 600. But as per institute, on this 600, we will issue another 1600 worth of PC, and hence they have said that this is going to be 2200. Now, from an exam perspective, you will directly show equity of B plus 1600, and hence that is going to be 2200. Further, you will show continuing financial statement, so there will be reserves worth 1400. Now, technically, this 2200 is represented by 250 equity shares of A. Now this is where the confusion arises. You don't have to show the breakup. If you show the breakup, there will be a separate reverse acquisition adjustment account to be created. ICI does not show that, and hence we will also not show that. From an institute perspective, your equity balance will be 600, that is the shares of B, plus 1600, that is a PC, that is total 2200. How the 2200 is broken up, they don't really show. We will also not show. They are just saying that this 2200 is represented by 750 equity shares. Sorry, by 250 equity shares actually of A, because you're preparing it in the name of A, and it will represent continuing financial statements of B, and hence that is 1400. So if you go to see, this is a total of what? 900, 1500, that is 2400 plus 1400 plus 2200, and there you got 6000. So basically you are preparing it in the name of A, but it represents continuing financial statements of B, and hence the reserves of B appear. Assets and liabilities of B continue to be at book values, but the assets and liabilities of A are taken over at fair values. Further, the reserves of B will continue to appear, and the equity section will represent 600, which was the equity of B, plus 1600, which is the PC that is decided. So 2200, but that 2200 will represent 250 shares of A. If you want to show, then maybe there may be some reverse acquisition adjustment account that will appear, but institute does not show that, so we are not going into that. Again, you have been given some profit numbers, and you have been told to calculate EPS. Remember, EPS has been removed by the institute in its material, but if you want to calculate EPS, let us say for the year 2010 and 2011, remember the profit that is given for 2010 is 600, which is a profit of B, but ideally it should divide it by the number of shares of B, that is 60. However, now I don't have shares of B, I have the shares of A, so I'll have to convert this into equivalent shares of A. 60 into 2.5, each share of B is equivalent to 2.5 shares of A, and hence the restated EPS will be 4. Further, the consolidated profits is 800. Again, this 800 is earned by B, that is 60 shares, which is there for the entire year, but 60 is equivalent to 2.5 shares of A, and hence this is into 12 by 12 plus another 40 shares which are probably issued into 2.5 into the last 3 months, that is 3 by 12. So basically if I go to see, this is 800 upon 175, and this is 4 point something. So this is 800 upon 175, this is 4.57. If you understand this, well and good, otherwise institute has removed it, so it will not necessarily come. All you have to remember is you are doing it as if it is a continuing financial statements of B, but the number of shares are shares of A, and hence you will have to convert B's number of shares into equivalent shares of A. Like partly paid up shares, you convert into equivalent fully paid up shares. So B's number of shares, that is 60, will be converted into equivalent shares of A, that is 2.5 shares of A, and accordingly the workings will proceed. So this kind of takes care of the important questions when it comes to business combination. Next, you can go to consolidation, that is the holding subsidiary case, which is an extension of the business combination chapter. Okay, so next we go to consolidation. Now this chapter has two parts, first involving consolidation of subsidiaries and then involving joint ventures and associates. What is more important from an exam perspective is subsidiaries. From joint ventures, associates, it is just the application of equity method that you need to properly apply. So first we go to the subsidiaries part. Remember, you need to prepare two separate set of statements. One is the SFS and one is the CFS. While you are preparing the CFS, for the purpose of subsidiaries, you need to follow full consolidation. Subsidiaries are entities where you have control, where you need to follow full consolidation method. In case of joint ventures or associates, we need to follow the equity method of accounting. Joint venture is where you have joint control, and associates is where you have significant influence, where you follow the equity method of accounting in the CFS. And in case of a joint operation, we will discuss that in some time. In case of a joint operation, you follow what is called as a proportionate consolidation method. So what are the steps that you need to remember in case of a full consolidation method? Before that, one always has a question that what is the difference between the consolidation that you do in a business combination chapter versus a consolidation chapter. Maybe the steps are slightly different because the data given in the questions are slightly different, but the underlying essence remains the same. You will have to take over the assets and liabilities at fair value as on the date of acquisition. So on the date of acquisition, if you have to prepare the consolidated balance sheet, you can do it in a way that you did in the business combination chapter. However, in certain cases, you might be given the data a couple of years after the acquisition date, and hence you don't even have the balance sheet as on the acquisition date, in which case you might have to back calculate the net assets using the net worth as on the acquisition date, and considering that, you will try to calculate the goodwill or the capital reserve as the case may be and do the workings. So general rule, in case you are preparing the balance sheet as on the acquisition date, then you can solve using the method used in business combination, that is using the net assets. Whereas if you have the data a couple of years later or a year or so later, not on the acquisition date, in which case you will have to use a slightly different method, because you need to back calculate the net assets based on the net worth, where you use the method that we are now going to study for the purpose of consolidation. So when does consolidation start? It starts from the date of acquisition and it continues up to the time you have control. The important principles at the stage of consolidation is you will have to take over 100% of the assets and liabilities. Even as on the consolidation date, you will take over 100% of the assets and liabilities because you have control. However, a part of these assets and liabilities are not attributable to you, and hence you will create an NCI. So non-controlling interest can be calculated using either proportionate net assets method or the fair value method as on the acquisition date. But once you determine the NCI as on the acquisition date, subsequently NCI will change only due to NCI's share in the post-acquisition reserves. So whatever is the opening balance of NCI as on the acquisition date plus NCI share in the post-acquisition reserves will give you the NCI to be shown as on the balance sheet date. Further, when you look at goodwill, now usually when you are preparing consolidated financial statements, while preparing your consolidated financial statements, you will be given typically the SFS of the parent and the SFS of the subsidiary, and using that you will have to consolidate. So in the SFS of the parent, you will see an investment in the subsidiary. Typically, this investment will appear at cost. However, when you prepare the CFS, you take over the assets and liabilities of the subsidiary, and hence you will not separately keep on showing the investment. So you will not keep on showing the investment, and hence the investment has to be eliminated. Now this investment typically represents a purchase consideration. So you will eliminate the investment, and against that you will try to eliminate your share of the net assets or the net worth as the case may be as on the date of acquisition. So if there is a difference between the PC, that is an investment, and your share of the net assets or net worth as on the date of acquisition, that is taken as goodwill or a capital reserve as the case may be. So over here you are given certain principles on the goodwill workings, so you will have to eliminate and find the goodwill, your NCI calculation, and the most important discussion in the consolidation section is what do you do with the profits. When you have the subsidiaries profits have to be analyzed. Remember, assets and liabilities of the subsidiary are consolidated, share capital of the subsidiary is eliminated against the investment that appears in the parent's SFS. But what happens to the reserves? The reserves have to be analyzed between pre-acquisition and post-acquisition. The pre-acquisition reserves are called by the ICI as typically capital profits. You will analyze the reserves between pre and post, and then you will split this between parent and NCI. So reserves have to be analyzed. The pre-acquisition profits will go into the goodwill workings. That is, the parent share of pre-acquisition profits will go into the goodwill workings. They will not be consolidated because that is not something that you have earned. You have actually paid a consideration to acquire them. However, the post-acquisition profits, and that too parent share in the post-acquisition profits, are earned during your control, during your regime, and hence they have to be consolidated while you prepare, let us say, your working note number 1. And hence, when you look at the reserves, your reserves have to be analyzed. Pre-acquisition reserves and post-acquisition. Pre-acquisition reserves, parent share is to be going into the goodwill workings, and parent share in the post-acquisition reserves is to be consolidated along with the respective reserves. NCI share of either pre or post-acquisition reserves is going to be attributable, let us say, to the NCI. Okay, so these are the general principles for consolidation, for which we have made a stepwise working. If you have done your sums using this working, follow that. Otherwise, if you have done using any other process, you follow that process, because consolidation is a process driven chapter. So when you start this process, we typically prepare the schedule 3 balance sheet format depending on the data given in the question. Before you prepare the schedule 3 format, you have to just take care of 3 things. First, you should check if the reporting dates of the parent and subsidiary are the same. If they are different, you will have to restate the balance sheet to bring it in line with the parent's reporting date. The accounting policies of the parent and subsidiary are the same. If they are different, again you will have to restate the subsidiary's balance sheet to bring it in line with the parent's policies. Third, you will have to check if the currencies are the same. If they are different, you will have to convert it into the parent's currency and then do the working. So before you prepare the schedule 3 format, which is typically asked, you will check for these 3 items: different reporting dates, different accounting policies, or different currencies. If they are, then you will prepare a small working note to find the restated balance sheet as per the parent's policies, date or currency, and then do the workings. So that is the first step, where you prepare the schedule 3 format, blank format. Second, you prepare notes to accounts. While you are preparing notes to accounts, you will take the exact assets, exact liabilities as appearing in the parents and subsidiaries SFS, except for 5 items. Investment in subsidiaries in the parents books will not be taken over. Share capital of the parent and subsidiary will not be taken over. Reserves of the parent and reserves of the subsidiary will not be taken over in this note. Other than that, all assets, all liabilities without any adjustment will be shown as it is. Adjustments, if any, will be done later. We will have to show the parents, subsidiaries, and then make an adjustment column, or you can do the working as if for PP, parent, subsidiary less adjustment, inventory, parent, subsidiary less adjustment. Though this second format is a little more time consuming, so we can stick with this format even in the exam. Once you do that, then you will write the share capital in the consolidated balance sheet, which is the share capital of the parent only. Then you will prepare 3 crucial working notes, typically 8 to 10 lines each. Working note 1, which is on consolidated other equity, depending on the other equity items like reserves, general reserves, securities premium. You will prepare this in the columnar format and start with the standalone balance of the parent. Okay, leave around 8 to 10 lines for possible adjustments. Then go to working note 2, which is on goodwill workings. Now, goodwill workings you can do in one of the 2 possible ways, depending on whether it is a partial goodwill question or a full goodwill question. In a partial goodwill question, we can apply a shortcut where we can take the investment, which is, let us say, for an 80% stake, and compare it directly with 80% share of our net worth as on the acquisition date. Typically, we should take net assets. In business combination, you do PC plus NCI minus net assets. However, if your NCI is a percentage directly of net assets, you can directly do a shortcut where you say investment minus directly 80%, that is your share of the net worth as on the acquisition date. And then you prepare working note 3, which is on non-controlling interest, where you attribute the NCI share of the net worth as on the acquisition date. So over here, you will first start, let us say, with the standalone balance of P in working note 1. Then when you go to working note 2, you will do the goodwill working. In case of partial goodwill questions, you will take the investment from the balance sheet and you will separate your share of the net assets, which is usually not available, but your share of the net worth as on the acquisition date. Over here, you will take your share of the equity share capital, and NCI share of equity share capital is given over here. And that is about it. So at this point, the only thing that remains is the reserves of the subsidiary, which needs to be analyzed. You will analyze the reserves by preparing kind of a table where you will say the balance at the start of the year or date of acquisition as given, plus the profits during the period up to the balance sheet date, less dividends, less bonus. That is an appropriation to get the balance as at the end of the year. Now these are the balances. You will split every balance between pre and post depending on the time. Like the opening balance is pre, profit during the period can be post. However, if the acquisition date is somewhere in the middle of the year, you will have to apportion it proportionately. Dividend and bonus, which are appropriation items, you will have to look at the data in the question and then reduce it from the pre or the post section depending on the data or the assumption to be used. If nothing is given, we will assume that dividend is paid out of the post acquisition profits. If nothing is given, dividend of the current year paid out of the current year, and bonus is capitalization of reserves. So if nothing is given, we'll assume that the bonus is paid out of the oldest reserves, so that is out of the pre-profits. So this is a simple assumption if that we need to take if the question remains silent. Okay, so this is the working that you do, and then you try to analyze the reserves. Okay, while you analyze the reserves, over here you will have, as we said, balance plus profit less dividend less bonus, as the case may be, and you will attribute, and then you will make certain adjustments like fair value adjustments, upstream adjustments, etc., and find the adjusted balance, which you will attribute to the parent and the NCI. So over here, the parent share goes in working note 2, NCI share goes in working note 3, which is the NCI working. Parent share in the post acquisition profits goes in working note 1, and NCI share goes in working note 3. This is what you do in case of a partial goodwill question, and you will get the goodwill and NCI. You will total up all the items, and that will hopefully give you a balance sheet which tallies. However, what if NCI is calculated using the fair value method, in which case you cannot do a shortcut, that is investment minus your share of the net assets? No, that is not possible. In which case you will take your investment plus NCI at fair value on the acquisition date less 100% of the net assets. Because you are taking PC plus NCI both, you will have to compare 100% of the net assets. So if this is a goodwill working in case of full goodwill method, along with the PC you will have to add NCI at the fair values as on the acquisition date, and then subtract 100% of the net assets or net worth, and not just your share of the net assets or net worth. So in this working, when you start with the NCI, your NCI will directly start with the fair value as on the acquisition date. You don't have to separately attribute share capital pre-acquisition reserves to the NCI. You will directly start at the fair value as on the acquisition date, and subsequently when you do the analysis of reserves, you will do the working in the exact same way. However, because the pre-acquisition reserves typically are split between parent and NCI, but because your parent share as well as NCI as on the acquisition date, both of them are sitting in working note 2, the entire pre-acquisition profits attributable to the parent as well as to the NCI will be taken into your goodwill workings directly. So over here, the entire pre-acquisition P&L, the entire pre-acquisition other reserves, equity, share capital will be taken. And then subsequently post-acquisition balances are still going to be attributed in the same way. So this is your working. A bit of practice will really help. We'll do sums on each of these methods in today's video as well. So over here, then you will total and close. So this is a crucial process. Typically when you are planning a consolidation sum, if it's a 14-mark question, ideally it should get over in around 25 to 30 minutes. Earlier we were saying 35 odd minutes because it was a 16 or a 20-mark question, but typically we'll try to complete this within 30 minutes. Out of those 30 minutes, the first 8 odd minutes, 8 to 10 is on the upper side. We'll go in reading the question and preparing the schedule 3 format, preparing the notes, making working note 1, 2 and 3. Once that 8 to 10 minutes are there, done. After that, the remaining 10 to 12 minutes will go in working note number 4, where you are doing analysis of reserves, and working note number 5, where you are doing the adjustments. This is the most crucial part of your sum solving. And then at the end, another 4 to 5 minutes, once you are done with all the postings, you will try to total and apply the balance sheet. So this is how your target should be: around 8 to 10 minutes at the start for reading and preparing the format, around 10 to 12 minutes in the middle for let us say completing your working notes and adjustments, and then probably 5 to 6 minutes at the end for the purpose of posting every numbers, calculating and totaling up working note 1, 2, 3, totaling up the notes on assets and liabilities, and preparing the consolidated balance sheet. This is your flow that you should try to target and practice for, let us say, a 14-mark question, which can at max be asked in the revised scheme of things. Now, a few consolidation adjustments. In my opinion, there are 5 adjustments, or not even 5, okay, 5 adjustments which I would say are very important. First is a fair value adjustment. Second is the upstream or downstream inventory or PP adjustment. Third is the dividend, the pre-acquisition dividend adjustment. Fourth is the chain holding adjustment, and fifth is the NCI at fair value adjustment. So these are the 5 things that you need to be really aware of. There are close to 12 or 13 adjustments that we discuss over here, out of which 5 are the most crucial. First is the negative non-controlling interest. Can NCI be negative? Well, yes, under Ind AS, NCI can very well have a debit or a negative balance, and hence you will show it as a negative balance within the equity section. No problem in that. So no separate adjustment, just that if NCI is negative, that is very well permissible, because equity balances can be a debit balance, and hence NCI can very well be negative. Second is the fair value adjustment. This, in my opinion, is one of the most important adjustments. That is, what happens is, when you take over the assets and liabilities at Ind AS 103, you should take them over at fair values. However, when I prepare SFS of the subsidiary, in the SFS of subsidiary, it is just a change in the shareholding, and hence the subsidiary in its SFS may not have necessarily remeasured these assets and liabilities. So if you are given the SFS of the subsidiary, which you usually are a couple of years after the acquisition, in which case you will have to remember that what you are taking over from the subsidiary's SFS is actually the book value as per the subsidiary's records, and hence you will have to incorporate fair value changes. At the initial stage, these fair value changes may be fair value changes on PP. At the date of acquisition, you might have a PP, a building of 100, which on the date of acquisition was worth 150. Subsidiary will continue to show it that 100 only in its individual records, but in the CFS you have to take it at 150, and hence there is a 50 rupees fair value adjustment to be incorporated. That is building account debit. You will increase the building by 50 as compared to what is there in the subsidiary's individual records. To what? Well, this 50 appreciation has already happened up to the date of acquisition, and hence this will be adjusted against the other equity balance. Can be revaluation, can be retained earnings. For simplicity, we adjust it against the retained earnings. So this is an adjustment against the pre-acquisition. Whether it is upward or downward, you will adjust it against the pre-acquisition reserves. However, this is an increase of 50 rupees as on the date of acquisition. Now, if the building had a life of 10 years, the building would be depreciated, let us say, at 10 rupees in the subsidiary's SFS. However, in the CFS, if you are showing the building at 150, the depreciation should have been 15 rupees. And hence, for the additional 5 as well, which is arising post the acquisition, you will have to pass an adjusting entry, that is post profits of the subsidiary account debit to, let us say, the building. So over here, the fair value adjustment, when you look at a PP, the initial fair value adjustment, you will adjust the PP, the second effect going against the pre-reserves. Post acquisition adjustments like depreciation, you will adjust the post profit and loss, and the second effect against going against, let us say, the building. So this is for PP. Another adjustment is possible for inventory. Again, at this date of acquisition, you will take over the inventory at fair value. If not, you will have to make a fair value adjustment like inventory account debit to, again, pre-acquisition profits. Subsequently, this inventory may be sold or it remains unsold. If it is unsold, there is no further adjustment needed. But if it is sold, well, you will have to adjust, because in your SFS, you might have calculated the COGS based on the cost of the inventory as per your SFS. But in the CFS, your cost of inventory might be different because you have taken it over at fair value, and hence your COGS may be adjusted, which is a post-period adjustment. So post retained earnings account debit, let us say, to inventory, debit what comes in, credit what goes out. If inventory is sold, inventory is to be credited. Okay, the thumb rule that you need to remember is whenever you are doing an adjustment which is an initial fair value adjustment, you will adjust it against the pre-acquisition profits. But if there are subsequent adjustments which arise due to sale of inventory or depreciation of PP, they will always go into the post-acquisition section. Similar is the adjustment in case of payables. There may be a contingent liability which the subsidiary is merely disclosing in its notes. However, at the stage of acquisition, you have to take it over at fair value, and hence payable has to be credited, in which case the pre-retained earnings has to be debited because your net worth is lower because there is a payable existing. So that is why your pre-retained earnings is debited. If this payable is subsequently unpaid, no further adjustment. But if it is actually paid, payable account debit. So you will have to debit the payable, and credit will go to the post section because the subsidiary might have actually paid it and recorded a loss. However, for the group, that is not a loss, it is a payment of a payable, and hence that is kind of credited in the post acquisition P&L. At this stage, if you have to remember a rule, any change in the balances as on the acquisition date will be adjusted against the pre-acquisition net worth balance, and any changes in the post acquisition will be adjusted against the post acquisition. So if payable is paid, inventory is sold, or fixed assets are additionally depreciated, they will be adjusted against the post-acquisition profits. Okay. Next, there is a possibility of a goodwill impairment. Now, in case of a goodwill impairment, you will have to be careful on whether the goodwill is calculated as per the partial goodwill method or calculated as per the full goodwill method. If it is calculated as per the partial goodwill method, then only the parent will share the loss on impairment. So your entry will be consolidated P&L, which is going in working note 1 to goodwill. However, if it is a full goodwill case, then NCI also has a share in that loss, and hence your entry will be consolidated P&L account debit to the extent of parent share, NCI account debit to the extent of NCI share, and to goodwill. Usually we pass these entries directly if the goodwill impairment is directly given to us in the question, or a percentage is given for goodwill impairment. However, in case you have been given a recoverable value, in which case you will have to apply the guidance that you study in Ind AS 36, where you might have to compare the carrying value of the entire subsidiary unit with the recoverable value, whereby you might need to do certain grossing up adjustments that like you do in your impairment questions, but that is only if your goodwill is or your carrying value is to be compared with the recoverable value. In most questions, goodwill is directly, impairment is directly given, and hence you can directly adjust the impairment for the goodwill. So this is the third adjustment for goodwill impairment. Next, we have unrealized profit on intercompany transactions. This can be upstream or downstream. Remember, downstream is parent selling to the subsidiary, in which case the unrealized profit is sitting in the parent's books, and hence if you were to eliminate it, the profit and loss of the parent will be debited, which is sitting in working note 1 to the inventory. You will reduce. Whereas if it is upstream, then the unrealized profit is sitting in the subsidiary's books, and hence P&L of the subsidiary will be debited. P&L of subsidiary has to be segregated between pre and post, and hence you will have to look at the date of sale and decide whether it is pre or post. If nothing is given, institute assumes it to be a sale from the post acquisition profits. So you will adjust those profits and credit, let us say, the inventory as the case may be. Okay, what applies to inventory also applies to PP. So if there's an upstream or downstream sale of inventory or a PP, the effects are same, but just that in case of a PP, it is possible that the recipient, that is a buyer, is further depreciating the asset, and hence there may be additional adjustments which you may need to do for the purpose of adjusting the depreciation on account of this unrealized profits as well. Depreciation adjustment will be in the books of the entity who has charged the depreciation. Now, what applies for unrealized profits will also apply to unrealized losses. Like you eliminate unrealized profits, you will also eliminate the unrealized losses in the exact same way. Bring the inventory back to cost and then compare it with NRV as the case may be, but you will eliminate the unrealized profits and losses in the exact same manner. Okay, that is another important adjustment. Then the next adjustment of uniform accounting policy is not very important. Parent and subsidiary have to do consolidation based on uniform accounting policies. So if the subsidiary is following a different policy for a like-to-like similar transaction, then the subsidiary has to kind of restate its financials in line with the parent's policy. Remember, the subsidiary can continue applying a different policy for a different transaction, or a different accounting estimate is also permitted, but policies for similar transactions have to be similar. If not, you will have to restate with the corresponding effect in other equity or retained earnings as the case may be. Different reporting dates. Usually parent and subsidiary will consolidate the same reporting dates. However, if the subsidiary's reporting date is different, however, it is still within 3 months, equal to or less than 3 months within the parent's reporting date, then you can just make adjustments for material items and prepare a draft balance sheet of the subsidiary as on the date of the parent's balance sheet and do consolidation based on that. However, if the gap is more than 3 months, then you have to again prepare the entire financial statements of the subsidiary and then do the presentation. If the gap is less than or equal to 3 months, identification of material items is based on the management, and hence if a question gives 2 or 3 adjustments, then only these are identified as material. You don't have to do any further adjustments beyond what is given in the question. Intercompany elimination, debtors and creditors you will eliminate. However, there is a possibility that there may be a cash in transit if the creditor has paid but the debtor has not received. So there can be a balance for cash in transit. Bills receivable, bills payable will also be eliminated, but sometimes these bills may be discounted or these bills may be endorsed, in which case there will be no separate elimination because there is a liability to be paid to a bank in case of discounting, or to, let us say, an outsider in case of an endorsement. So bills discounted or endorsed will not be eliminated, but otherwise intercompany bills payable and receivables will be eliminated. Intercompany loans given and taken will also be eliminated. In case the question gives you that there is some interest for which adjustment has to be done, then you will do the adjustment for interest and then do the elimination. Otherwise, you will eliminate the intercompany loans given and loans taken. An important adjustment will be intercompany debentures and preference shares. So usually these are in the nature of liabilities. If nothing is given, these are in the nature of liabilities, and hence the debenture liability or preference share capital liability will appear in the final balance sheet. However, if the parent, for example, has invested in certain debentures of the subsidiary or in certain preference shares of the subsidiary, these debentures or preference shares do not give me control, and hence they will not impact the goodwill. However, I might have paid something more than what the face value or the value of these preference shares or debentures are, in which case the difference over here will go to the consolidated P&L because the parent has paid more or less as a case. Maybe this will be taken as a loss on elimination of these debentures or preference shares. In the rarest of the rare case, if the question tells you that these preference shares are in the nature of equity, in which case you will do the working similar to investment in equity shares and equity share capital. The working will be the same, but that is rare. You will usually have these preference shares or debentures to be shown in the nature of liability. So the intercompany debentures will be eliminated. The remaining debentures will be appearing in the final balance sheet. However, on elimination of intercompany debentures, there is a possibility there is a difference, in which case the difference will go to the consolidated P&L account. Next is a dividend adjustment. In case the dividend is paid out of pre-acquisition profits, remember, as of today, your P&L balance is lower, and if the dividend is paid out of pre-acquisition profits, there is a possibility that when you do your analysis in the usual way, you will only take your share of the remaining pre-acquisition profits. However, as on the date of acquisition, you already had some more profits. By the way, they got distributed later, but as on the date of acquisition, you had it. And as a result, if dividends are paid out of pre-acquisition profits, then you will have to pass an adjusting entry. That is, after you do all the adjustments, you will pass the entry consolidated P&L account or P&L of the parent account debit to, let us say, share in the net worth. So working note 1 ke andar, you will take your share of your dividend which the parent might have recorded as a part of its standalone P&L, which you have to eliminate, and further your net worth as on the date of acquisition would be accordingly higher, and hence in your net worth as on the acquisition date in working note 2 you will credit it. This is to be done if there is a pre-acquisition dividend and you are following the partial goodwill. If you are following the full goodwill, then your adjusting entry will be, for example, consolidated P&L account debit, parent share of the dividend, NCI account debit, because you must have recorded NCI at the fair value as on the acquisition date, out of which some dividend is received. So the ex-dividend value, and to goodwill over here, or to the share of, or your entire 100% of net worth. So this is the entry that you pass only if the dividend is paid out of pre-acquisition profits and you as a parent have received that dividend after the acquisition date. If the dividend is already paid and received before, if applicable, the acquisition date, you might be holding some stake and the dividend is paid before the date of acquisition, then it will have no impact, because as on the acquisition date, the net worth is actually lower because the dividend has already been paid. This is provided the dividend is paid out of pre-acquisition profits and you have received the dividend after your date of acquisition, like you will do in one of the questions, question number 1. In the November 23 questions, Institute has assumed that the dividend was paid prior to the date of acquisition, date of control being acquired, and hence in such a case, no separate adjusting entry was needed because the dividend has already been paid and your net worth is actually lower. However, if the dividend is paid out of the post-acquisition profits, then there's no separate adjusting entry needed because the post-acquisition profit is lower and the parent's proportionate share in its standalone P&L is higher, so the effects automatically get negated and hence you don't have to pass any separate effect. Concept understanding over here is a little tricky. From an exam perspective, if you have to remember, dividend paid out of pre-acquisition profit, in partial goodwill case, consolidated P&L account debit to share in net worth, your share of profits. In full goodwill case, consolidated P&L account debit, NCI account debit to, let us say, share in net worth. If dividend is paid out of post-acquisition profits, no separate adjusting entry needed. All of this is provided you are receiving this dividend after your date of acquisition. If dividend is paid prior to the date of acquisition, no separate adjusting entry needed in any case. Okay. Next is bonus. Bonus was earlier not as important. However, we were discussing bonus and it came also in the November 23 papers. There are two ways in which you can adjust for bonus. One, you can say bonus is a book entry and hence you can reverse the effect of bonus altogether. Or like what the institute said, you consider the effect of bonus. If you consider the effect of bonus, you have to first be careful in ensuring that your stake is calculated correctly. So you have to take the pre-bonus number of shares that you held divided by the pre-bonus number of total shares, or you take the post-bonus shares that you hold with the post-bonus number of shares. Also, in questions involving bonus and dividend, you have to see the date of bonus vis-a-vis the date of dividend to see whether the dividend will be received on the bonus shares or not. Further, if bonus has already been recorded, we have to see whether the bonus is paid out of the pre-acquisition profits or post-acquisition profits. If nothing is given, we assume that the bonus is paid out of pre-acquisition profits. If the bonus is paid out of pre-acquisition profits, your share capital is higher as compared to what was there as on the acquisition date, and your reserves are lower as compared to what they were there as on the acquisition date, and hence there is no further adjusting entry needed. However, if bonus is paid out of post-acquisition profits, then your share capital is higher as on the consolidation date, but your pre-acquisition reserves have not been adjusted, and hence you might need to pass an adjusting entry whereby you will debit your share of the net worth and credit, let us say, your reserves, your share of the reserves. So this is in case of bonus, though that is not very important from an exam perspective. A better way, in my opinion, would be to ignore the effect of bonus altogether if the entry has not yet been passed. But the institute in the November 23 paper has actually incorporated the effect of bonus and done. Your answers do remain the same, but nevertheless, that is one possible treatment. Okay, what if there is an additional stake purchase? Now that additional stake purchase can give you control. If you have a 30% stake and you are purchasing another 70% stake, that 70% stake gives you control, in which case business combination standard applies. You will remeasure the existing investment, take it to fair value, and then you will pass the acquisition entry, take over the net assets, eliminate the existing investment, consider the PC, calculate the goodwill, etc. So that is done in the business combination section. However, what if there's an additional stake purchase after control is acquired? Like you have a 70% stake and then you are acquiring, let us say, another 30% stake. If with a 70% stake in your CFS, you are already consolidating 100% of the assets and liabilities. Now with the purchase of another 30% stake, you can't consolidate further assets and liabilities. You're already consolidating 100% of them. So this cannot be treated as purchase of assets. It can't even be shown as purchase of investment because you don't show an investment in your own self. So what is this? Well, this transaction is treated as purchase of NCI. So you will debit the NCI, proportionate NCI, as appearing in your books to bank. You are paying for that, and the difference, if any, will go to other equity. It will not go to goodwill because goodwill is determined as on the date of acquisition. It will not further change. Sir, it will go to the statement of profit and loss. No, because it is an owner to owner transaction. It is like retirement of a partner, and hence if there's a gain or loss, it is going directly to the continuing partners and not to the statement of P&L. And hence the balancing figure goes against the other equity. So over here, this is to be treated as a purchase of NCI transaction. Your net assets will not change. Your entry will be in NCI account debit, loss on purchase of NCI, if any, account debit to other equity, to bank as the case maybe. Goodwill will not be impacted. Consolidated statement of P&L, net profit will not be impacted, though the impact will directly go in other equity. Then you come to stake sale. Now again, stake sale can result in no loss of control, or it can result in loss of control. If there's no loss of control, like for example, you had a 100% stake and you're diluting 20%, in which case this is like a creation of NCI transaction. You will not derecognize the net assets. You will not derecognize investment because in the CFS you're not showing the investment. Then what is this? You are creating NCI, and hence when you are creating NCI, you will give NCI a share in the net assets, including the goodwill that is existing as on the new NCI that gets created will also get a share of the goodwill, and hence you will create an NCI. So something account debit to NCI, well, you are getting money, so bank account debit to NCI, and the balancing figure again over here, this is like admission of a partner which will go to other equity. It will not be going to the statement of P&L. Your goodwill will not be impacted. Your net assets will not be impacted, and NCI will be created, and the balancing figure will go to the other equity as gain or loss on creation of NCI. An important thing over here is loss of control. So if the control is, let us say, lost, in such a case what will happen? At the time of loss of control, you will eliminate all assets, all liabilities, including goodwill as appearing in your books. You will also eliminate the NCI. So you will eliminate the assets, credit the assets, eliminate the liability, debit the liability, eliminate the goodwill, credit the goodwill, eliminate the NCI, debit the NCI. But against all of this, are you getting something? Yes, you are getting money, so you will debit the bank. But this is not an owner to owner transaction. This is a sale of asset transaction, and hence if there is any balancing figure, that will be shown as gain on sale, which can be taken to the statement of P&L in line with the institute solution. Sometimes what might happen is you might have a 100% stake and you sell, let us say, 80%, which means you still have 20% stake, in which case the investment is retained. So over here you will eliminate 100% of the assets, 100% of the liabilities, NCI if any, goodwill if any. However, the money that you are getting is only for 80%. However, you are also retaining 20% investment, and that investment that is retained will be measured either using the proportionate carrying value of the subsidiary just a day before the stake sale. So if your carrying value of the subsidiary before the stake sale was 1000, 20% of that will be 200, and hence your investment can appear at 200. Or if a fair market value is given, you can retain the investment at fair value as well. The balancing figure, if you retain the investment at fair value, will show the gain or loss due to sale as well as remeasurement. If you are measuring the investment directly at the proportionate net assets, then the balancing figure will directly give you the gain on sale. Okay, so this is giving you certain information regarding that. There's a special case if there's a loss of control which happens in multiple transactions which are a part of a single arrangement, then you will record the stake sale entry as if it is a single transaction and solve it accordingly, provided certain specified conditions are satisfied. Okay, this is regarding stake sale. An important adjustment that we had to discuss was chain holding. So we discussed 3 important adjustments, including 4, including the NCI at fair value. The 5th over here is the chain holding adjustment. So what happens in case of a chain of holding? You have parent, let's say P, having a stake, let us say over here 80% stake in S1, and S1 having a 60% stake in S2. So for you to assess control in S2, P can direct the relevant activities of S1, and by virtue of 80% stake, P can order S1 to vote for the entire 60% in a manner it wants, and hence P controls S2, and hence P will also consolidate assets and liabilities of S2. However, what is P's effective stake in S2? That is 80 into 60%, that is 48%, which means the remaining 52% is held by people other than P, and hence that will be taken as NCI. So first, in chain holding, you will assess for control. Second, you will determine the NCI, which is 100% minus P's effective stake, and hence that will come to, let us say, 52%, that is, let us say, NCI. Okay, so your NCI over here is, let us say, 52%. Okay, next, when you are going to the date of acquisition, the date of acquisition is the date when you have control. Typically, there is a date when P gets the ability to direct the relevant activities in S2, and that will be a date of acquisition for S2, which will be used for the purpose of splitting the reserves of S2. Now the most important part is the changes in the consolidation process. Now the first step is Schedule 3 balance sheet, no change. Second step, you prepare notes on assets and liabilities, no change. However, at this stage you will ensure that when you calculate the NCI, you will have to show a separate working for the NCI calculation, P's effective stake, and then 100 minus P's effective stake. Then when you do the working notes, working note 1 on consolidate other equity, no change. But when you prepare the goodwill working note and the NCI working note, there will be certain change. One needs to be remembered that you will need to eliminate the investment that is there in S2. Now one needs to remember that investment in S2 actually appears in the books of S1. And S1's assets and liabilities, if I were to see in this example, S1's assets and liabilities are 80% attributable to P but 20% attributable to NCI. So usually when you eliminate the investment, the entire investment goes into the goodwill workings. Here, only 80% of the investment will go into the goodwill workings. The remaining 20% will be attributable to NCI. Okay. That is one important change. Second, when you calculate the NCI of S1, that will be split 80-20 because all the assets and liabilities of S1 are split 80-20. But the share capital reserves of S2 appear in the books of S2. And these reserves of S2 will be split 48-52. So one needs to remember the investment in S2 appears in S1's books and hence you will adjust it 80-20 because it is appearing in S1's books. But the share capital and reserves of S2 appear in S2's books and hence you will attribute it 48-52. And once you are able to do that, generally you will not make a mistake in the chain holding problem. So this over here, this part where you are explaining this rule on where to take 48-52, where to take 80-20 is probably the most important part when it comes to a chain holding question. Another adjustment over here is that it is possible that your investment in the subsidiaries are shown at cost. They can be shown at cost or at fair value as per Ind AS 109 in the SFS. Usually every question that we see, investments are shown at cost. However, if they are shown at fair value, then the investment, let us say, was costing 500 rupees. There was a fair value change of 50 rupees, which was recorded in the SFS. So 50 rupees investment appears at 550 and there is a 50 rupee gain appearing either in fair value reserve or in P&L. Now, at the stage of consolidation, if you do nothing, your investment that is a part of PC for goodwill workings will go at 550, which is wrong. And hence you will have to adjust that 50. So you will have to credit the investment by 50. And debit the P&L or the OCI by 50 because this is a gain on investment. In consolidation, you don't show that investment and hence the gain has to be reversed. The only thing that you have to remember is you will reverse the fair value gain, and reversing that fair value gain, you will get your investment and the standalone P&L correct and solve the workings accordingly. So these are the crucial adjustments. A couple of exemptions that come from consolidation is especially for intermediate companies. So if there's an intermediate company, it can be exempted from preparing consolidated financial statements provided none of its securities are listed and provided the parent company is preparing CFS and it has no objection to the intermediate company not preparing the CFS. Sometimes for a wholly owned subsidiary, the parent can directly decide. However, if it is a partly owned subsidiary, you have to intimate the other shareholders, and if the other shareholders have no objection, you are exempted from preparing CFS provided your company is your intermediate company does not have any listed securities. If they have to prepare CFS. Further, your ultimate company has to prepare CFS as per Indian Ind AS. If your ultimate company is a foreign company, well, you cannot consider that. Or if an ultimate company is an individual, they don't prepare as per Ind AS. In which case, you will have to see that for the relevant intermediate companies, you can claim an exemption, not for every intermediate companies. So this is first. Second is the exemption from CFS in case of an investment entity, where an investment entity is allowed to show the investments at FVTPL instead of doing the full consolidation process. But what is an investment entity? An investment entity is an entity which is like a mutual fund, private equity fund, venture capital fund, which provides investment management services. Sole objective is to earn capital appreciation as well as dividend income or investment income, and it assesses the investments on a fair value basis. If these three conditions, core conditions, are fulfilled, we can say that an entity is an investment entity. There are a few other examples as well, like these investment entities have more than one investments, more than one investors which are not related to each other, etc. But for these investment entities, the sole purpose is to earn investment income and capital appreciation and nothing else. In such cases, they are allowed to show the investments in subsidiaries at FVTPL if they want to, rather than doing the full consolidation. However, if apart from earning solely apart from earning investment income and capital appreciation, if they have some other business interest like a technology tie-up or something, then you cannot treat it as an investment entity and full consolidation has to apply. Further, if an investment entity acquires another investment entity, in which case full consolidation has to be done, this exemption is available only for investments which you are assessing at fair value. So this is the theory when it comes to subsidiary based consolidation. Then you also have joint venture based consolidation. What we'll first do is we'll do some sums regarding subsidiary based consolidation and then go to the joint ventures. So we'll go to question number 1. This is a question where you have a fair value adjustment as well as a pre-acquisition dividend adjustment. So you have the standard balance sheet where you have 60% stake acquired somewhere in the middle of the year, that is 1st October. There is, out of an opening balance of 60,000, 10% dividend was paid, out of which 10% dividend was paid on 1st November. So this dividend was paid after you are acquiring on 1st October 11. After you are acquiring, this dividend was paid, but this dividend was paid out of the credit balance on 1st April 11. So this is a dividend which is paid out of the pre-acquisition profits. Okay, so that is the first thing that you have to be careful about. Second, we have credited the dividend to retained earnings. Fair value of plant is given as 4 lakhs. This is 4 lakhs on 1st October 11. The rate of depreciation is 10%. Okay, so if you go for this workings further, the following are the changes in fair value. Acha, for the other items you have been given the changes in fair values. For land and building, inventories, trade payables, etc. You are required to prepare the consolidated balance sheet and you've been told that the inventory is unsold and the trade payables are not yet settled. So what do we need to do? So your standard format, you prepare the Schedule 3 balance sheet, you prepare the notes to accounts, you prepare the working notes, and then you try to analyze the reserves. When you try to analyze the reserves, you'll say, yeah, at the start of the year, it was 60,000. During the year, a 10% dividend is paid. Dividend is a 10% of share capital. So if your share capital is, for example, 4 lakhs, 4 lakhs into 10%, that is 40,000, which is paid out of the pre-acquisition profits. Your closing balance in your reserves, if you go to see currently, is I think 1,64,000. So we will say that if we do the workings over here, out of the 1,64,000, 60,000 is pre-balancing figure is 1,44,000. 1,44,000 is to be split between pre and post, and as a result you will get 92 and 72. Now typically, if nothing was there, this 92 would have gone into the pre-acquisition net worth, but this 92 is after deducting the 40,000 over here. As on 1st October 11, that 40,000 was very well there. And as a result, if you want to find your share of the net worth, you would say that the appropriate net worth, you'll have to make an adjusting entry. That is, you will credit your share of the net worth and debit the profit and loss because it is already recorded in the parent's profit and loss. Well, 40,000 is the total dividend. 40,000 into 60%, 24,000 will be your effect, and hence you will pass this adjusting entry, consolidated retained earnings account debit to net worth. So over here, as you see this working, you will see your share of the pre-acquisition dividend 24,000, which is also increasing in your net worth, and you will reduce from your workings because it is not your income technically, it is intercompany in nature. And hence this is the adjustment for the purpose of pre-acquisition dividend, which is received by the entity in case of a partial goodwill question. Second, over here is the fair value adjustment. Now, plant and machinery we say is worth 4 lakhs. But 4 lakhs is compared to what? Well, we can compare it with 2,70,000. No, 2,70,000 is a balance as on 31st March 12. So we need to somehow back calculate and find the WDV as on 1st October 11. So we'll say that, well, at the end of the day, if the rate of depreciation is 10%, then the PP plant at the start of the year is 100, 10 is the depreciation, end of the year is 90. So if 90 is equivalent to 2,70,000, then 100 is equivalent to how much, sir? It is 3 lakhs. So 3 lakhs is on 1st April 11, your date of acquisition is 1st October 11. So 3 lakhs into 10%, that is 30,000 for the entire year, 15,000 for the first 6 months, 15,000 for the last 6 months. And hence your carrying value comes to 2,85,000. So the difference between 2,85,000 and 4 lakhs, that is 1,15,000, is a change in the fair value of the machinery. So as on the date of acquisition, your machinery increases by 1,15,000. Apart from that, your land also increases by 2 lakhs. Inventory also increases. So all of these are debit balance and payables also increasing. So over here, you can say plant account debit, land account debit, inventory account debit, to payables, and whatever is the remaining will go to the pre-acquisition retained earnings. So when you do this working, this will be an initial fair value adjustment within the pre-column. However, later we don't know about any depreciation on land. Inventory and payables are not sold or paid, and hence no further adjustment, but the building would be depreciated. 4 lakhs ka building at the rate of 10% for 6 months, that will be 20,000 for 6 months as compared to 15,000 that has been recorded earlier, and hence the difference over here is 5,000. This is the additional depreciation between 1st October 11 to 31st March 12, and hence that is a post period. So post depreciation account debit 5,000. Over here you will have 5,000. to, let us say, the machinery. So when you're looking at your notes, you will have, let us say, your plant and machinery increasing by 1,15,000 and reducing by 5,000, and that is about it. Once you are done with these adjustments, you will just try to total up the numbers posted at the appropriate place, and that is it. So the two adjustments, pre-acquisition dividend as well as your fair value adjustments, are discussed accordingly. Okay, next you have question number 2, which is a January 21 question. It is a one of its type question where you have a combination of financial instruments, business combination as well as consolidation done over here. So here we had acquired an 80% stake and you had the share capital and reserves as on that date, which was given. You paid a cash consideration of 10 lakhs. Should that be a part of your investment? Yes. But you also issued 2 lakh shares with a nominal value of 1 per share at a current market value of 1.8, that is around 3,60,000. Should that also be a part of PC? Well, yes. It also agreed that A would pay a further sum of 5 lakhs after 3 years. Okay. That is deferred consideration. Should that also be a part of PC? Yes. Cost of capital is 10%. And for you, the appropriate discounting factor, if I go to C, is 0.75. And hence we will take, for example, 5 lakhs into 0.75, that is around 3,75,000. So ideally your entry should have been investment account debit, to bank 10 lakhs, to share capital 2 lakhs, to securities premium 1,60,000, to deferred consideration payable 3,75,000. So if I go to see, I think 17,10,000 should have been your total. 17,35,000 should be your total value of investment. But what does the question say? Shares and deferred consideration have not yet been recorded by A. But that is wrong. In A's SFS also, you have to show the investment. And investment is not just 10 lakhs. 10 lakhs, if everything is in thousands, like over here, 10 lakhs is 1,000 in thousands, but that is incorrect. So the below statements are on 31st March 19. Achha, your date of acquisition, if you go to see, was actually 1st April 17. So this is a balance sheet given 2 years later. Achha, within 2 years, will the share capital change? No. Securities premium change? No. But will the deferred consideration change? Yes. It will change due to the application of amortized cost method under Ind AS 109. So if I start at 375 to start with, just a second, 500 into 0.75, just to be clear, yes, 375, on which you will apply, let us say, 10%. So this is around 37.5. Your closing comes to, let us say, 412.5, and then in the second year 412.5, so this is 41.25, and your closing, let us say, comes to around 453.75. So actually your deferred consideration should be 453.75, and this 37.5 and 41.25 should have ideally been recorded as finance cost. So this is 78.75 should have been recorded as finance cost over the 2 years. But that is not done in the balance sheet of A. So before you proceed to your regular consolidation, you will have to rectify the balance sheet of A. So in your regular balance sheet of A, you can see investment in S. Now this investment is appearing at 1,000. Ideally to this, you will have to add 360 for the equity issue and 375 for the deferred consideration, and hence ideally this will appear at 1735, but I have to give double effects. So to the share capital I will add 200, to the securities premium I will add another 160, and then for the deferred consideration payable, to the deferred consideration payable I'll add 375. So there will be a 375. To this I will separately add 78.75 over the next 2 years, because the deferred consideration will change, and I will reduce my retained earnings by 78.75 for giving effect to that. So my retained earnings will also be reduced by 78.75, and that will give me at the end of the day a rectified balance sheet which I should use. So basically my rectified balance sheet of A will have investment at 1735, it will have share capital at 2200, retained earnings of 1400 minus 78.75, which is coming to, let us say, 1321.25, securities premium of 160, and deferred consideration payable of 453.75. So these are the adjustments you will have to do before you do a proper consolidation in the first place. On the date of acquisition, the fair values of S plant exceeded the book value by 2 lakhs. So this is a fair value adjustment of 200,000, and it had a remaining life of 5 years. So basically for this, at the time of analysis of reserves, you will increase the plant by 200 and credit the pre-acquisition reserves by 200. Apart from that, there will be an additional depreciation of 200 into, let us say, 2 by 5, which comes to, let us say, I think 80 rupees, which will be recorded from the post acquisition P&L, and you will adjust the plant for that. So you will increase the plant by 200, reduce it by 80 for the additional depreciation, increase the fair value pre-acquisition reserves by 200, the net worth, and reduce the post acquisition profits by 80. The consolidated goodwill has been impaired by 258. Again, this is goodwill reducing by 258. Okay, but we don't know whether the goodwill is calculated using the fair value method or proportionate net assets method. The A group values the NCI using the fair value method. Okay, and at the acquisition date, the fair value of 20% NCI was 3,80,000. So basically, when you do the goodwill workings over here, just a second, when you do the goodwill workings over here, where is this? Yes, in the goodwill workings, you will start with your investment. That is the correct investment, 1735. After all the adjustments, again, when you start with standalone A, 1400, from this you subtract the finance cost of 78.75 and get the rectified balance. Next, when you look at the share capital, well, we directly take our share, that is 80% of the share capital. No, here we will add the NCI. So we will add the NCI of 380, and that will be the starting point even of your NCI working. Let us say that is 380. To this, you will subtract 100% of your net worth. So your 100% of the net worth will have 100% of the equity share capital. Further, when you are doing these workings, we will say that okay, we have 125 which is given. There is fair value adjustment on the plant of 200 which is there, 80 rupees of depreciation, and the entire 325 will be going into the pre-section because this is NCI at fair value, and from the post section of 95, 76 and 19 will go at the appropriate places. But sir, have you considered the impairment of goodwill? No, not yet. However, 358 now is not just going to be shared by the parent. So 358 into, let us say, not 358, I think, what was the goodwill impairment? 258 into, let us say, 80%, that is equal to around 206.4 will be shared by the parent, and the remaining, let us say, 51.6 will go to the NCI. So over here there will be some attribution given to the parent and some attribution going to the NCI. So over here there is a goodwill impairment coming to 51.6 on the NCI, and there's also a goodwill impairment from the parent share coming at 206.4. So these are the three crucial adjustments over here. First is NCI at fair value, second is goodwill impairment in this case, fair value adjustment for property, plant and equipment, and the new adjustments for the deferred consideration as well as your shares not being recorded accurately. Okay, so this takes care of question number 2. Next you will go to question number 3, which is on chain holding. So this is a very standard question that has come multiple times in your main exams, where you have the balance sheet of P, S and SS, and you have been told at the end that P holds 80% in S and S owns 75% in SS. So P's effective stake in SS, if you go to see, is 80 into 75, that comes to around 60%. That means the NCI for SS is going to be 40%. Even though S owns 75% of SS, the NCI over here will be 40% effectively. Okay, on 1st April 11, you have been given various balances. However, the date of acquisition is 30th September 11. You have to be careful in these dates. In one of the questions that had come in the exam, P acquired in S on 1st April and S acquired in SS at 30th September. In which case for SS, the date of acquisition was 30th September, but for S reserves analysis, the date of acquisition was 1st April. So you need to be a little careful over there. So you have various balances which are given. Then there is 10 lakhs, which is an upstream inventory adjustment, cost plus 25%. So this is 10 lakhs into 25 upon 125, and that probably comes to around what? 2 rupees. This is recorded in the profits of SS, sold by SS. So you'll have to make the adjustment for 2 rupees in the profits of SS. If nothing is going, we'll assume that this is a sale happening in the post-acquisition period. And you have been told that the parent has adopted the policy of measuring NCI at fair value, which is a quoted market price, which is the same as the face value. So when you do the workings, to start with, you'll have the Schedule 3 balance sheet. Then you will prepare that what is the NCI stake. P's effective stake is 60. So NCI is around 40. And accordingly, you will prepare the workings. But when you are preparing the workings, you will do your regular workings for assets and liabilities. No change over here. Consolidated reserves. When you start with the goodwill workings, two things. First, NCI is at fair value. So that is why you will have to add NCI and subtract 100% of your share capital and reserves. And second, there is a chain holding. In chain holding, when you go to see the investment of P in S is appearing in P's books. All assets and liabilities of P are attributable to P only. So the entire 340 will go. But the investment of SS is appearing in S Limited's books. And hence, if you have to eliminate this investment, you cannot say that this 280 is only attributable to parent. Out of this 280, this is appearing in S Limited's books. So everything over here is going to go 80-20. And everything over here is going to go 60-40. This is a habit you should have कि भाई ठीक है, we will mention S का whatever asset, whatever liability, whatever share capital, whatever reserves in S will be 80-20 and in SS will be 60-40. So over here, if I try to eliminate the investment, 80% of this, I think this is around 224 and this is around 56. So when you go to see, the crucial adjustment over here would be, well, when I look at the goodwill workings, my investment will be 218 to 80%. That is only 224 that will come over here. The remaining 56, in line with the institute solutions, you will have to debit, that is reduce from NCI. Institute reduces it from the S limited NCI. We will also do that for consistency, though an alternative presentation can be possible here. So over here, you will reduce from the NCI. Over here, the NCI value would reduce, let us say, by 56 rupees. So this is done. But now when you look at the NCI working, we will say, dekho, NCI is at fair value. So we will, because NCI is at fair value, you will separately add the NCI. Whatever is the fair value of the NCI, 80 and 128, as I guess, maybe you will add. No problem in that. But then going forward, so when you look at the NCI working, where is the NCI working? Yes, you will start NCI at the acquisition date 80 and 128. In this case, NCI will all be 20% over here, and here everything will be at the rate of 40%. Okay. Now, when you try to analyze the reserves, first for S, it is very easy. You will analyze the reserves, date of acquisition is somewhere in the middle of the year, and as a result, you will do some working, but then you go to SS. Again, the date of acquisition is in the middle of the year, but at what ratio will you split? Well, we will split 60-40 because these are share capital and reserves appearing in SS books, which will be split in the ratio of 60-40. So, if you split this in the ratio of 60 and 40, one needs to remember that if NCI is calculated using fair value method, there will be no adjustment in the pre-acquisition reserves because it is already gone. Post-acquisition reserves you will take to the NCI 4 rupees, 6 rupees will go in the PNL, and both of this 7.8 as well as 5.2, that is the entire 13 rupees will be adjusted against working note 2, that is a goodwill workings only because NCI is at fair value. So this is a slight discussion that we do in case of chain holding. The important adjustment over here is the splitting. Investment appearing in the books of S split in the ratio of 80-20. But share capital and reserves appearing in the books of SS split in the ratio of 60-40. This is the crux in my understanding. Okay, next we have question number 4, which is the ICI November 23 infamous question. Over here, it's a 20 mark humongous question. We have had a detailed question solving over here. You can refer the November 23 suggested answers video that I've shared. You can refer that for detail. Over here, I'll just do a brief discussion on what are the adjustments. So you have been given the balance sheet on 31st March 2023 for Hammer and Sleek. You have been told that Hammer acquired 20,000 equity shares on 1st April 22. This 20,000 is out of 50,000 and hence that comes to around 20 out of 50 comes to around a 40% stake, but that does not give you control. And then another 17,500 acquired, which gives you again out of 50 35% stake, which now gives you control. So your control is acquired on 1st of October 2022. If you look at your investments appear at 2,40,000 plus 1,92,500. However, if control is acquired on 1st of October 22, you will have to remeasure the investments, the existing investments at fair value, and the gain or loss will go to the PNL. If you go somewhere at the end, you have been told that the parent company of Hammer has adopted the policy to measure NCI at fair value. Assume that the fair value per equity share was 11 on the date when control was acquired. So we know that the fair value was 11, which means these 20,000 shares into 11 will come to around 2,20,000. However, you have shown your investment at 2,40,000 and hence there will be a 20,000 loss. So when you are doing your workings, you will first say something that is PNL account debit 20,000 to investment. So when you do your first workings, we will say, dekho yaar, we will start with working note 1, which is standalone profits of the parent. However, fair value remeasurement will result in a 20,000 loss, and when you do the investment workings, you have shown the investment at 2,40,000 minus a fair value adjustment will give you the fair value at 2,20,000 plus 1,92,500, which will go into your goodwill workings. Because your NCI is measured at fair value, you will also add the NCI. So out of the 50,000 shares, you can say that 37,500 are held by the parent, that is the remaining 12,500 will be held by NCI into rupees 11, and hence your NCI comes to 1,37,500. This is your NCI, that is 12,500 into 11. This will also be taken as the starting point for your NCI workings. So these are a few points that you need to remember. Second, you have 8% debentures of Sleek include debentures held by Hammer of a nominal value 35,000. They were acquired by Hammer at a cost of 84. Now these are intercompany debentures. they don't give you control, and hence if you have to eliminate them. So over here, when you prepare the balance sheet, the debentures out of this 35,000 are intercompany, so you will eliminate debentures account debit to investment, but the investment is actually 84,000, and hence the investment will be eliminated by 84, but there is a difference of 49,000. That 49,000 is a loss which will be adjusted in working note 1. This is a loss which will be borne by the parent. So if I go to say there is loss on elimination of debentures, this is 49,000 which will be eliminated from the workings for the parent. So this is the adjustment for intercompany debentures. Next we have the retained earnings having 75,000 balance and general reserve of 50,000. This is on 1st April 2022, which is pre-acquisition. Okay, Sleek had paid a dividend of 10% on the paid up. This is a controversial adjustment. Sleek has paid a dividend of 10% on the paid up share capital out of the balance of the retained earnings on 1st April 22. So this is very clear that this is paid out of the pre-acquisition profits. But when is it paid? We don't know. If it is paid between 1st April 22 to 30th September 22, that is dividend before control was acquired, and hence for that you don't have to pass any separate adjusting entry. But if it is paid after 1st October 22, then it is paid after you have acquired control, in which case an adjusting entry may be needed. The ICAI over here has assumed that if nothing is given, that dividend is paid between 1st April 22 to 30th September 22, and they have solved accordingly. We have in the printed solution also given an alternative possibility that what would have been the case if the dividend was paid after. We don't know, but let us assume, to keep it consistent with ICAI, that the dividend is paid between 1st April to 30th September 22. For the financial year, the entire dividend received by Hammer was credited in the statement of P&L. So whatever was the dividend must have been credited to the P&L. This is dividend prior to the date control is acquired, and hence this must be dividend on the 40% stake, and hence there will be no separate adjusting entry needed. So there will be no separate adjusting entry needed, at least in line with the ICAI solution. As per the resolution dated 20th February, Sleek allotted bonus shares of 1 equity share for 10 shares held out of its general reserve. You've been clearly told that this is out of the general reserve. So Sleek had 50,000 shares. So 50,000 into 1 by 10, that is 5,000 shares will be issued as fully paid bonus shares. Each share has a face value of 10, and hence 50,000 will be the quantum of bonus. So your journal entry for bonus should be the general reserve account debit to share capital. The accounting effect for the same has not been given. One option is you ignore the effect and do the workings, that is fine. Or the second option is you adjust the entry. You say that your adjusted share capital should ideally be 5,50,000 and your adjusted general reserve over here will ideally be 1,25,000 minus 50. Now we don't know whether this 50,000 is paid out of the pre-acquisition or post-acquisition profits. So in line with the ICAI solutions, we assume that this is paid out of the pre-acquisition profits, and if they are paid out of the pre-acquisition profits, you don't need to make any separate adjusting entry for these bonus shares. Trade receivables of Hammer include bills receivable of 2 lakhs drawn upon Sleek. Out of this, bills of 50,000 have been discounted, which means the intercompany elimination will only be done for the 1,50,000 because the 50,000 are discounted, which means Sleek has to pay it to the bank, and hence there is a liability. For the remaining 1,50,000 you will eliminate. During the financial year, Hammer purchased goods from Sleek. So that is an upstream sale of 25,000 at a sale price of 30,000. There is a 5,000 profit. 40% of these goods remain unsold. So 5,000 into 40, 5,000 profit into 40%, which comes to I think 2,000. So there will be an upstream sale if nothing is given, that is assumed to be out of the post acquisition profit. So that is inventory you will credit, and when you do analysis of the profits, you will adjust, let us say 2,000 in the post section. As you can see, unrealized profit on the upstream, this is 2,000. Okay. Next, where is this? Okay, there was one more adjustment. I think on 1st October, machinery of Sleek was overvalued by 20,000, for which necessary adjustments are to be made. Depreciation rate is 10%, so it is overvalued by 10,000. So your machinery has to reduce. The second effect will go in the pre-acquisition P&L. So over here, it is a fair value reserve, initial fair value change 20,000, and depreciation on that institute has done it directly at the rate of 10%, which is 2,000. For 6 months, it will be 1,000, and hence this will be a 1,000 saving in depreciation, and accordingly you will prepare the entire workings. Because NCI is at fair value, your entire pre-acquisition balance will be taken against the goodwill working, and the post-acquisition balance you split. This is your and we have done a few extra workings that what if the dividend was after 1st October, what if the bonus, you ignore the effect, and we have given this in the solution. So it's a fairly detailed question. If you want to do it in all of its depth, you can refer the November 23 suggested answers video. The first, I think 30-40 minutes we have discussed that. Okay, so that takes care of consolidation. Joint venture, I would say, is also an extension of this. So we'll quickly discuss joint venture and associates. Two standards covered over here, Ind AS 111 as well as Ind AS 28. So there is something called as the joint arrangement. Joint arrangement over here can be that of arising out of a joint control. When is there a joint control? As per the standard, there is a joint control if there's collective decision making, which will result in you having a unanimous decision making. So control arises if you have the unilateral ability to direct relevant activities. Joint control arises if you have the joint ability, where you require unanimous decision making for parties who have agreed to vote together. Remember, joint control can be expressed, can be implied, like 50-50% stake. There's only one way in which a decision can be taken, that is implied, or it can be expressly agreed. It can be oral, it can be written. It can even be informal, like a cartel. If it is effective in practice, it will be a joint control. For there to be a joint control, the decision making should happen in unanimity by only one combination. The minimum voting rights should be attained by minimum one combination, in which case, like 50-50 stake, there's only one combination in which the decisions can be taken, and hence that will result in a joint control. So over here, this is assessment of joint control. If there is joint control, there is a joint arrangement, but a joint arrangement can be a joint operation or a joint venture. When is it a joint venture? Well, if there's an entity in the middle, like you have a company where two parties have invested and the company holds assets and liabilities, typically that is when there is a joint venture. If there's no entity in the middle, it is almost always a joint operation. However, even if there's an entity in the middle and the arrangement is such that all the assets, all the liabilities are indirectly exposed by the partners, or the revenue, the output of this entity is exclusively to be given to the partners, then these co-venturers have a direct interest in the assets and liabilities, in which case, even though there is a separate entity in the middle, you can call it as a joint operation. So the rule over here is, if there's no separate entity, it is always going to be a joint operation. But if there is a separate entity, in general it is a joint venture, unless the contractual terms are such that the venturers get a direct interest in the assets and liabilities, or they will get all the output that is generated from the assets and liabilities, in which case it becomes a joint operation. In all other cases, it is a joint venture. But sir, how does it matter? Well, if it is a joint operation, the standard says that you will have to follow the proportionate consolidation method, but in case of a joint venture, you will have to follow the equity method, and hence this is important. So in case of a joint operation, proportionate method. In case of a joint venture, you will record the investment using the equity method. Assets and liabilities will not be taken over. If there's a joint operation where you hold a 30% stake and you acquire another, let us say 5% stake, then that 5% stake, you will proportionally take over assets and liabilities for that 5% only. You don't need to remeasure the existing stake. For joint operation, no NCI is created because you're recording assets only to the extent of your share. But there can be a possible goodwill because you are paying something and you are recording proportionate assets and liabilities. If there's a difference, that can be attributable to goodwill as well. Okay. Next, we have significant influence. This is now Ind AS 28. Till now, what we have discussed is Ind AS 111. Now we go to Ind AS 28, where there is a significant influence. If there is a significant influence, that is, you have the ability to participate in policy making. You may not be controlling, you may not be jointly controlling, but you have the ability to participate in the policy making, in which case there is a significant influence, and the relationship that we discuss is an associate relationship. For there to be an associate, generally the thumb rule is anywhere from 20% up to 50% is a significant influence, but that percentage is not mandatory. If you can show participation even at less than 20% stake, like you are participating in the board, you have a board seat, you have interchange of managerial personnel, etc., then there can be a significant influence even at less than 20%, or even at greater than 20%. If you are not allowed to participate, then there may be no significant influence, but if nothing is given, 20% is your barrier. Now the important discussion, in my opinion, over here is the equity method. The entire possibility of something coming from this chapter largely comes from the equity method. Equity method is a method used for accounting for associates as well as joint ventures. Remember, ventures, not operations. In operations, you will solve using the proportionate method. For joint ventures, you can solve using the equity method of accounting. So this is for investment in associates as well as joint ventures in the CFS. Now, what are your core features of the equity method? Core features involve all assets and liabilities not to be taken over. Usually, we take over assets and liabilities, that is in case of a subsidiary. In case of an associate or a joint venture, they are actual genuine third parties. You will not lift the corporate barrier and you will say that these are separate entities and hence I will not take over the assets and liabilities of these entities. However, these are entities which should not even be shown at cost in the CFS, nor should it be shown at fair value, because this is a business investment and I will measure the business by how well the business is performing and not how the market price is changing, and hence you should not follow the FVTPL, etc. or you should not even keep it at cost. In fact, you will follow a separate method called as equity method, where you will add your share of the equity changes in the associate. So if the associate earns a profit of 100, you have a 30% stake, you will record investment account debit to consolidated profit and loss 30 rupees. In fact, this is not just for retained earnings. The associate might earn some OCI or other reserves like a revaluation FCTR, in which case your entry will be investment account debit to consolidated FCTR or investment account debit to consolidated OCI, as the case may be. So this is your equity method, where okay, assets and liabilities are not taken over. You will add your share in the post acquisition profits or equity, as the case may be. So this is investment account debit to, let us say, these consolidated other reserves, not to be taken at fair value, not to be kept at cost. But sir, what if dividend is received? Well, dividend can be received. This is treated as recovery of investment. You have already added your share of the post acquisition profits, and hence dividend is not a further income. In fact, dividend is a recovery from the investments, your bank account debit to investment. In fact, even if dividend is paid out of pre-acquisition profits, your entry is bank account debit to investment. It's like the amortized cost method, where you start with the opening balance, add to that your share of the profits, and subtract from that whatever is recovered, whether from the coupon or principal. That is, whatever is recovered from the pre or post acquisition section, you will always deduct. Okay. So that is dividend. Intercompany debtors and creditors will not be eliminated, predominantly because you're not taking over the debtors, you're not taking over the creditors. In fact, it is payable to a third party, which is an associate, and hence there will be no intercompany elimination of assets and liabilities. However, you are taking over profits of the associate, your share of the profits, and hence if there is an upstream or downstream sale of inventory or machinery, then the unrealized profit, rather your share in the unrealized profit in an upstream or downstream transaction, should be eliminated. So your journal entry will be consolidated P&L account debit to, as per the ICI solution, you will credit the investment in case of a downstream sale, because you don't take over the inventory of the associate and profits are sitting in the inventory of the associate, so you credit the investment. Or in case of an upstream sale, you are showing the inventory of the parent and profits are sitting in the inventory of the parent, so you remove it from the inventory. So basically, intercompany unrealized profit in stock, your share. Remember, in a holding subsidiary case, you will eliminate the entire profit, because even if a part of it is attributable to NCI, you are showing the NCI. Here there is no NCI. So consolidated P&L account debit to investment to inventory, depending on whether it is upstream or downstream. If it is downstream, adjust against investment. If it is upstream, adjust against inventory. Your share of the profits. Goodwill is very interesting over here. Typically, goodwill gets created if you eliminate the investment and instead take over assets and liabilities. Here, you're not eliminating the investment, and hence you're not taking over the assets and liabilities, and hence you do not need to separately show the goodwill. However, this goodwill, as per Ind AS, has to be separately disclosed. It has to be identified. So you will do the working for the goodwill in a manner similar to that you do for business combination or for consolidation. That is, you will compare the investment, that is PC, to your share of the net worth or net assets, and whatever is the goodwill as on the acquisition date, you will identify. So you will say cost of the investment into bracket including goodwill, and accordingly solve. So goodwill has to be identified, though it should not be shown as a separate line item in your balance sheet. Losses. Well, if there are losses in case of an associate, like you add your share of profits to the investment. If there are losses, you will deduct your share of the losses from this investment. However, while you are deducting these share of losses from the investment, one needs to remember that these losses cannot make your investment negative. You will restrict it to 0. But after that, if there are any share in losses, you will ignore them in general, unless you have some other long-term interest in the associate. Other long-term interest in the associate can include irredeemable preference shares with discretionary dividend, or loans where settlement terms are not planned, in which case there's a special guidance which is given, for which we have done a separate sum and solved and uploaded separately. Loss-making associates, you can refer that, but not very important. It's a very complex adjustment, where what you have to do is, we have to say that, well, in such special cases, well, typically investment in preference shares or loans given are accounted for as per Ind AS 109. However, if these are a part of the permanent investment in the associate, after equity investment becomes 0, you are allowed to attribute your share in the losses to the preference shares first, to the loans later, after doing Ind AS 109 adjustments. And even after all of that, if everything becomes 0, then no further losses can be attributed. You will have to recognize unrecognized, you will have to keep unrecognized losses separately, unless you have entered into a contract to share those losses. Later, if the tide changes and you actually start making profits, then you will first reverse the unrecognized losses, then loans, then preference shares, and then give the allocation to equity shares. There's a separate video for this, you can refer, but otherwise, from an exam perspective at this stage, if you have not done this earlier, you can kind of take a chance of kind of skipping this or just glancing through this. Exemptions in the application of equity method. similar to that of subsidiary. In case there is an investment entity, that investment entity is permitted to show the investments at FVTPL or follow equity method. Sometimes it is possible that you hold the investments directly as an investment entity, or sometimes you might be a company Reliance, there may be a Reliance mutual fund, and through Reliance mutual fund, which is an investment entity, you are holding certain investments. So the method is still the same. If you are holding investments through an investment entity, whether directly or indirectly, you get a choice to show those investments at FVTPL or using the equity method. However, if you are a non-investment entity and there is a significant influence, you have to follow the equity method necessarily. Okay, so this is regarding the exemption. There is a separate standard or a chapter, a subpart which is given over here in the CFS section, which is for SFS. Ind AS 27. There are only 2 points that you need to remember for Ind AS 27 SFS. That is, in the SFS, investments in either subsidiaries, associates or joint ventures should be shown at cost or using Ind AS 109 principles. This choice has to be taken for a class, that is category of investments. That is, if there are 5 subsidiaries, all 5 of them you can decide to show at cost, or all 5 of them using Ind AS 109. You can't take 3 subsidiaries at cost and 2 at 10. So that is a category of investments, but merely because you're showing subsidiaries at cost does not mean associate, which is a different category of investment, also has to be shown at cost. Associates can very well be shown at fair value using Ind AS 109 principles in the SFS. So this is the first point. And second, in case there is a reorganization, that is, a new holding company comes, let us say, in the middle, and the overall assets and liabilities of the group remains the same, your consideration is paid in shares, voting rights remains the same, then the cost of the investment for that new holding company will be the carrying value, your share of the carrying value of the net worth. That is the 2 pointers that you need to remember, for which there are 2 separate problems. Not very important, those problems, but nevertheless in your entire section they are there. It's not there in your super 99 questions. Over here in joint arrangements, we have 3 questions. One is on equity method, one is on proportionate consolidation, and one is a stake sale question where you have some good interesting OCI angles, which is similar to that of the May 24 RTP question as well. So first you have question number 1, where there is a joint operation where you have to do proportionate consolidation method. You have been told that we establish a joint arrangement through PQR, but the legal form does not confer separation between parties and the separate vehicle, which means it's like a non-incorporated partnership firm. Thus both parties have assets and obligations of the PQR, and hence the arrangement is a joint operation. That is absolutely correct. There's nothing wrong in that. Both parties own 50% of the equity interest in PQR. However, PQR is However, as per the terms, AB has a right to all the buildings of 1. So this is the entire 240, 100% is attributable to AB. An obligation to pay all the debt owed by PQR to lender XYZ. 100% obligation, which is another 250. AB and BC have rights to all other assets and liabilities in the proportion of 50-50. So this is 50%, probably 20. This is also 50%, probably 100. 50% of the employee benefit plan, 50. So PQR's balance sheet is given. How will AB record the financial statements in pertaining to PQR? Remember, because it is a joint operation, we will do proportionate consolidation, and hence we will have cash account debit 20, building 1 account debit 240, building 2 account debit 100, 2, let us say, debt 240, 2, let us say, employee benefit plan 50. Now out of this equity of 140, we have been told that 50% is contributed. So 50% of that is equal to 70 must be contributed. So 2 cash bank or 2 investment, if you have shown it as investment, will be eliminated. And if there's a difference, that will be taken. But here I think there is no difference. If you go to see over here, this will come to 70 only. The above assets and liabilities will appear in the books of AB. That is your share, AB share. The AB's entities, AB share in PQR will be eliminated against the investment that is done by AB. So equity will not be joined. Other items will be. Second is question number 2. B acquired a 30% interest in D. Okay, so that is a significant influence. The cost of the investment was 2,50,000. So will that be a part? Well, yes, 2,50,000. The associate has net assets of 5 lakhs at the acquisition date, and the fair value is 6 lakhs. So the fair value of PP is 1 lakh higher. So for the purpose of goodwill calculation, I will say that I'm having a 30% share of net assets worth 6 lakhs and hence 1,80,000. So for something worth 1,80,000, I'm paying 2,50,000, and hence there includes a goodwill of 70,000. So if you go to see goodwill of 70,000 and you start at 2,50,000. The PP has a remaining useful life of 10 years, and after acquisition, D recognized profits of 1 lakh. Now D recognized profits as per its own individual record. So if I were to add D share of profits, this is 1 lakh into 30%, that is equal to 30,000. But this 30,000 has not considered the depreciation based on the fair value of the PP. The fair value of the PP is 1 lakh higher, and hence there will be an additional 1 lakh divided by 10, that is 10,000 of depreciation, on which we have a 30% stake. So over here there will be 10,000 of additional depreciation, of which we have a 30% stake, so that is 3,000. Basically your adjusted profit is 1 lakh minus 10,000, that is 90,000, into 30%, that is equal to 27,000, and paid out dividend of 9,000. So this is 9,000 into 30%, this is 2,700. We'll subtract the dividend. D also recognize exchange losses of 20,000 directly in OCI. So these are exchange losses like FCTR. That is a part of equity, and hence 20,000 into 30%, that is 6,000, which is also a part of our losses in equity method. And hence if you consider all of this, you will probably get 2,68,300, which is the carrying value of investment as per the equity method. You will have to do the workings for the goodwill in a manner similar to that of subsidiary. Subsequent adjustments like depreciation also that of manner similar to the subsidiary. And you don't just take the profit and loss, you also take items like OCI. So the OCI balances will also be taken. Okay, next you go to question number 3. This is more of a stake sale question and other OCI adjustments on whether they are reclassifiable or non-reclassifiable. So this is stake sale resulting in loss of control, more of a consolidation type of a question. So at the beginning of the current year, AB owns 90%. During the financial year, AB sells 70%, which means it still retains 20% of BC to PQR for 56 crores. So your entry will be bank account debit 56 crores and consequently loses control over BC. At the date of disposal, the fair value of 20% interest retained is 16 crores. So you are selling the 70% stake, getting 56 crores, bank account debit 56, investment which is retained will be at 16 crores. So investment account debit 16, and the net assets of BC are fair valued at 60 crores. So you will credit the net assets by 60 crores. However, you had a 90% stake and hence 10% is attributable to NCI. So 60 crores into 10%, that is 6 crores will be NCI, which will be debited or eliminated. So if I go to see the journal entry, bank account debit 56, investment account debit, that is a fair value 16, NCI debit 6, nothing is going regarding goodwill. So you will credit the net assets, we don't know about goodwill, and then the balancing figure is again on sale as well as the remeasurement. Okay, these net assets include debt investments classified as FVOCI of 12 crores. Acha, when I credit the net assets of 60 crores, within that this 12 crores has already been credited. But the FV reserve is 6 crores. One needs to remember that if I am losing control, I am eliminating the assets. If I am eliminating the assets, I will also have to eliminate the OCI items which are pertaining to those assets. And hence, fair value reserve, FVOCI debt has to be eliminated. How much will be eliminated? Remember, NCI, it's a reserve. Reserve is not 6 crore entirely to you. 6 crore may say 10% is attributable to NCI. The remaining 5.4 crores is attributable to you. And hence your share is 5.4 crores. So your entry will be, acha, fair value reserve account debit 5.4 crores to what? Well, depending on whether it is reclassifiable or non-reclassifiable. This is reclassifiable OCI, and hence to fair value reserve, this will be 5.4 crores. So over here, this will be, let us say, FVOCI to consolidated P&L, you will transfer it to the profit and loss. It is a part of reclassifiable OCI. Okay, net defined benefit liability of 6 crores and a reserve relating to the remeasurement of 3 crores. Your share of that is 90%, that is 2.7 crores. This is losses. So losses, if you have to eliminate, you have to credit. So remeasurement reserve will be credited. It is a part of non-reclassifiable OCI as per Ind AS 19, and hence you will debit the consolidated retained earnings. So this is 2.7 consolidated retained earnings. Third, equity measurements not held for trading of 10 crores, which are irrevocable choice of recording it as FVOCI has been related. The reserve is 4 crores, your share is 90%, that is 3.6 crores. You will remove the reserve, so you will debit the consolidated fair value reserve, credit the consolidated retained earnings because this is a non-reclassifiable OCI. FVOCI equity is non-reclassifiable and hence goes to retained earnings. And last is FCTR, foreign currency translation reserve, which is a part of a reclassifiable OCI. FCTR is 8 crores, your share is 90%, that is 7.2 crores, transfer to the profit and loss account, FCTR account debit to the profit and loss. So there is a stake sale, investment being retained, at the same time it is OCI adjustments. To be honest, it is not more of a joint venture or a joint arrangement case, it is more of a stake sale and an overall understanding of the standards. So that takes care of joint ventures and joint operations as well. Next, we will go to the two other big standards, that is Ind AS 116 and Ind AS 115. So let us start first. Kya khulta hai? Let us say we first start with what is this? Let's say we start with Ind AS 116 first, and then we will go to Ind AS 115, which will cover at least all your passing marks, almost certain questions in your exam. So let us go to Ind AS 116 now. So Ind AS 116, the youngest standard that you have, an important standard. This is on leases. So when you look at leases, when do you say that there is a lease? For lease, there are 4 essential ingredients. A lease is a contract which conveys the right to direct usage. So there has to be a right to control usage, direct use of an identified asset for a consideration and for a specified period of time. So you have the right to control the usage, as you see over here. Control usage of an identified asset for a specified period of time in exchange for a consideration. So these are the 4 essential ingredients. So what is an identified asset? Identified asset is an asset which is typically considered to be physically distinct. When do you say that an asset is considered to be physically distinct? Well, an asset is physically distinct if you can actually it can be explicit, it can be implicit, it can be something which is yet to be manufactured, but it has to be physically separate. However, if it is an asset which is linked to capacity, then it is treated to be physically distinct if only substantially all of the capacity is agreed to be taken. That is, more than 90% of the capacity is agreed to be taken. Only then can be considered to be physically distinct. For there to be a lease, there is a necessity that there has to be an identified asset that is physically distinct. But merely because it is physically distinct, does it mean that it is an identified asset? Well, another requirement is that the supplier who is giving you the asset should not have a substantive substitution rights. So a supplier cannot, at his or her whims and fancies, substitute this asset. So if nothing is going, we will assume that the supplier does not have a substantive substitution rights. However, if the facts show that it is easy for the supplier to substitute, and on substituting they can get an economic benefit, then it can be considered that the supplier has a substantive right to substitute, in which case you do not have an identified asset as such. So 2 things for an identified asset: it has to be physically distinct, and supplier should not have a substantive substitution right. Then you have to see whether you have a right to control usage. Now, when do you say you have the right to control or direct usage? If you get substantially all the benefits directly or indirectly from using the asset, like the direct benefits like revenue from the asset, output of the asset, indirect benefits like subletting, subsidies from using the asset, all of this should substantially come to you. And you should be able to take the important decisions like how and for what purpose the asset is going to be used, when and where is it going to be used. If these decisions can be taken by you, you are directing the usage of the asset. However, in certain cases, the terms are such that the usage of the asset is predetermined as per the terms of the contract, in which case you will see who is actually operating the asset or who has designed the asset. But this is to be done only if the terms and conditions are such that you cannot identify that who is taking those decisions. In which case, you will look at additional factors like who is actually operating the asset, like who has designed the asset. Like in a solar panel, the person who designs the asset and decides the location of these assets has predetermined the usage, for example, and as a result, they can be said to be directing usage. So over here, an asset has to be physically distinct, that is, it has to be an identified asset, and secondly, it should have a right to control use. That is, the important decision of for what purpose and how the asset is going to be used should be taken by us. That is a lot of theory pertaining to leases. Again, we will look at the lease term, lease consideration, etc. in some time. Mere protective rights over here should not be considered. You will only look at substantive rights in general. Second is the separation of lease and non-lease component. This is a little interesting. So what is a lease component? A lease component would mean that there is a underlying identified asset. So if I were to take a furnished flat on rent, then there are 2 lease components. One is a flat and second is the furniture. So should I show them separately? Well, it depends. If they are highly interrelated or interdependent, you should not separate them out. However, if they are not highly interrelated or interdependent, in which case you should separate out and show them, provided they give benefits, which is a general assumption. This is a lease component. What is a non-lease component? Let us say this is a flat that you have taken on rent along with maintenance and cleaning, for example. So cleaning service is basically a service. There is no underlying asset, but you still get some benefit, and hence that is a non-lease component. So there are 3 components over here: the building, the furniture, and the cleaning and maintenance, out of which the first 2 are lease components, the third one is a non-lease component. Should you separate the non-lease component as well? In general, yes. However, you have a choice. which is called as a practical expedient or a conditional shortcut, where you may decide that you don't want to separate the non-lease component, and that is permissible. But remember, if the question remains silent, we will also separate the non-lease component. But if the question says that we take a choice of not separating the non-lease component, then there will be only two components that you will consider. Some questions also give some items like administrative charges or insurance, etc. These are costs that the lessors incur, which do not give any separate benefit to the lessee. Like insurance, if something happens to the asset, the compensation is going to go to the lessor, and hence if the lessor is charging anything from the lessee pays it as a part of your overall arrangement. The lessee is not getting any separate additional benefit out of it, and hence that administrative cost or insurance is neither a lease component nor is it a non-lease component. So when I'm looking at the lease as well as non-lease components, we will consider whether there is a separate lease or the non-lease component, and accordingly you will separate. So over here, the separation of if there are multiple lease as well as non-lease components, you will have to separate the lease components. If considering they are not highly interrelated or highly interdependent, you will have to separate them. Non-lease components, you have a choice. If you want to separate, you can. Otherwise, you may not separate it. But again, non-lease components are components which don't have an underlying asset. However, there's some benefit which is being passed on to the lessee. If there's no benefit being passed on to the lessee, it is just a cost which is going to increase your overall transaction price, but not a separate lease or a non-lease component. The standard says your overall transaction price should be attributable between the lease and the non-lease components in the ratio of their individual standalone prices. If standalone prices are available, you will allocate in the ratio of standalone prices. But if these standalone prices are not available, then you will take the fair values and allocate it in the ratio of fair values. Remember, the agreed prices are not relevant. It is the allocation to be ratio of the standalone prices, or if not available, then the fair values. Now, a few crucial terms. First is inception date and commencement date. Inception date is a date when you principally agree to the terms of the lease or the lease agreement is executed. This is a date which is relevant for figuring out that whether the lease whether an arrangement contains a lease or not. Second is the commencement date. This is a date when you actually get the right to direct usage, when you actually get possession. This may be a date when you start paying rentals, or it may be a date before or after that. It does not really matter. The date when you start getting the right to use, you get the possession, is the date which is a commencement date, and your journal entry that you will pass, the right of use asset account debit to lease liability, the entry that you will pass will be the entry that is passed, let us say, on the commencement date. So over here, that is the inception and commencement date. Lease term. Lease term would include the non-cancelable period and the period which is covered, let us say, by a renewal option or a termination option. That period can only be covered if there is a significant economic incentive for the lessee to continue. If we believe that there is no incentive for the lessee to continue, you will ignore the period covered under the renewal option or the period covered under the termination option. So this is regarding the lease term. The assessment has to be done initially and then at each subsequent date. At a later date as well, if you want, you can change the lease term, and accordingly there will be guidance regarding remeasurement which will be applicable over here. If there's a termination option which is available with the lessee only, you will include the period under the termination option if there's a significant incentive with the lessee to continue. But if the termination option is with the lessor, the lessees in the lessee's books, the lessee does not have a choice. If the lessor continues, lessee will have to pay, and hence lease term will include the period covered under the termination option if the lessor has the option to terminate. If the lessor does not terminate, the lessee will continue. The most common case is with the lessor and lessee both have an option to terminate, in which case the standard says that you will never include this period, irrespective of whether you think there's an incentive or not. If the option is there with both the parties, you will not include that in the calculation of your lease term workings. Okay, that is on lease term. Next is lease payment. Now, lease payment has 5 things. The first 2 are the most important. Fixed lease payment. Fixed does not mean equal. Fixed lease payments minus lease incentives. So if you are a lessee, you are paying the lease payment, sometimes you receive the incentives. So minus lease incentives, that will be your net fixed lease payment, will be a part of your lease payment calculation. Fixed lease payments, one need to remember, is also including any in substance fixed lease payment. So they may on the form appear to be variable, but minimum if something has to be paid, that is in substance fixed. So your lease payments include the fixed lease payments, including in substance fixed lease payment minus lease incentives after the commencement date. Second is variable lease payment, the most important part. Variable lease payments are in a way contingent. However, if these variable lease payments are linked to rate, like inflation or interest rate, or index like a CPI or inflation index, then they will be included into the calculation of lease payment working? Sir, but these rates might change. Okay, so the standard gives you guidance that for the purpose of initial lease liability determination, you will take the rate or index as on the commencement date, and at a later date you will change that rate or index when the cash flows actually get reset. At each balance sheet date or at each date when these rates change, you don't have to necessarily reset. However, when your cash flows get reset is when you will remeasure considering the revised rates. So you will include the variable lease payments which is linked to rate or index only. Other variable lease payments that is linked to sales, number of students, etc. will not be taken into your lease payment or lease liability workings. Third, exercise price in case of a purchase option. So in case you have a purchase option where it is reasonably certain or likely that this purchase option will be exercised, in which case you will have to make that payment and hence you will include it. Similarly, in case of a termination option, you are saying that if it is quite certain that you are going to terminate, then the payments under termination option will also be included. And lastly, there is a residual value guarantee. This depends on the terms and conditions of the guarantee. Like if at the end of the term, if the lessee is guaranteeing that it will have to pay something to the lessor, that is called as a residual value guarantee, which will also be included. So the 5 things that will be included is fixed lease payment, including in substance fixed lease payment minus lease incentives after the commencement date. Second, variable lease payments which are linked to a rate or index. Third, exercise price in case of a purchase option which is highly likely to be exercised. Termination penalty in case of a termination option which is highly likely to be exercised. And lastly, residual value guarantee which is given by the lessee. So you will not include the variable lease payments which do not depend on a rate or index. That will not be a part of lease payment calculation, and thereby it will not go into the lease liability calculation. And payments which is attributable to the non-lease component, let's say maintenance, etc., will not be a part of lease liability working unless you have taken a choice of not separating the non-lease component. Okay, a few key points have been discussed over here. What is fixed lease payments, variable, when does in substance fixed lease payment come, etc. Okay, next we have initial direct costs. Now these are costs which are incremental in nature. There is cost which will be incurred if you were to enter into a lease, which will be saved if you do not enter into a lease. So these are costs which are incremental in nature. So something like brokerage will only be entered if you enter into a lease, otherwise no. But traveling expenses will be entered irrespective of the lease. So traveling expenses or advertisement expenses are not treated as initial direct cost. However, brokerage, stamp duty, etc. are treated as initial direct cost. Okay, discount rate. You recognize the lease liability at the present value of your future lease payments, and while calculating lease payments, you will have to find the present value. Discounting rate will be the interest rate implicit in the lease if available, that is the lessor's IRR if available. You are in the books of the lessee, so you might not know the lessor's IRR. If you can infer the lessor's IRR, you will take that. If not, you will have to take the lessee's incremental borrowing rate. So the first preference is the lessor's IRR if available, and if not, then the lessee's incremental borrowing rate. So this has taken care of the key terms. Next, you go to the accounting. You're just about touching upon the accounting, but before that, what should be the accounting? Well, in general, we will say that you will have to create a right of use asset and a corresponding lease liability for every lease. However, the standard allows you recognition exemptions in 2 cases. First, if there's a short-term lease, that is a lease of less than or equal to 12 months, and that lease should not have any purchase option. So if there is a short-term lease, that is a lease of less than, let us say, or equal to 12 months, and without any purchase option, you call this as a short-term lease. And in case of a short-term lease, you have a choice of either recognizing ROU asset and lease liability, that is doing the regular working, or recognizing expense as and when it happens, rent account debit to bank, P&L account debit to rent. So there will be no need to create an ROU asset or lease liability because it is just a short-term lease, considering materiality. This choice has to be taken for a class of the underlying assets. Second is the lease of a low value item. Remember, a building, car, etc. are not low value items. Low value items are not been defined, but these are items which, even if they are brand new items, are treated as low value from an overall entity perspective. Like office equipment like telephones, mobiles, maybe printers, etc. can be treated as low value items, in which case the entity is given a choice that if it wants for these low value items, it can show rent account debit to bank and P&L account debit to rent. It need not create an ROU asset or lease liability. These choices are available. However, one needs to remember that if you are subleasing something or you have an intention to sublease it, it cannot be treated as a low value item. That is a requirement over here. So that is one. And secondly, if there's an item which is highly interdependent, like a tire is highly interdependent on a car, and if car is not a low value item, then the tire cannot be treated as a low value item as well. So recognition exemptions, when I say recognition exemptions, what does it mean? It means that for short-term leases or leases for low-value items, you need not recognize the ROU asset or the lease liability. Instead, you can directly recognize rent account debit to bank and P&L account debit to rent. However, for all other cases, that is other than short-term leases and other than leases of low-value items, you have to mandatorily create a ROU asset and a corresponding lease liability. Now, how do you create a lease liability? A lease liability is created as or credited as present value of future lease payments. So when you credit or create a lease liability, you credit it as the present value of future lease payments. That will be your lease liability. Sir, future lease payments based on the definition of lease payments over the lease term and discounted at the interest rate implicit in the lease or the lessor's IRR or the lessee's incremental borrowing rate. That will give you a lease liability. But what do you okay, why would the lease liability change at a later date? Well, it will change as payments happen, so your liability falls. As each year passes, time passes, so interest is going to be recorded. And lastly, there might be certain remeasurements, there might be certain changes, like for example, there might be certain remeasurements. You might have to account for those remeasurement items and accordingly solve as well, like lease term might change, variable lease payments might change. So considering that, your lease liability might change. So what about ROU asset? Well, ROU asset is typically equal to the lease liability. However, there may be certain additional adjustments in the ROU asset. That is, if there's an initial direct cost that is added to the ROU asset, if there is any payments made before the commencement date or any lease incentives before the commencement date, that will also be adjusted. If there's a site restoration obligation, that will also be adjusted in the ROU asset. Your ROU asset starts with the lease liability working, and making certain adjustments will give you the ROU asset. Subsequently, ROU asset will change due to depreciation or impairment as the case may be. Again, there may be a possible remeasurement or a modification due to which your ROU asset can also possibly change. Okay, ROU asset is typically depreciated over the lease term. However, if there's a purchase option and that purchase option is highly likely to be exercised, then the ROU asset will be depreciated over the entire life, because if the purchase option is highly likely to be exercised, the asset is going to be with you for a entire period. Sometimes what happens is your lease is denominated in foreign currency, in which case Ind AS 21 will also apply, and you will have to convert the lease liability, which is a monetary item, at the closing rate. ROU asset is a non-monetary item, will continue to remain at the historic rate, and the workings will be done similar to a financial liability at amortized cost in the foreign exchange chapter. A controversial point over here is, if nothing is given, what do you assume? Lease payments are made at the beginning, at the end, when are they made? Ideally, if you have been told that lease payments are made in arrears, that is, they are being made at the end of each year, or you have been told that lease payments are made in advance, that is, they are made at the start of each year. But if the question does not tell you, then you will scan through the question and see if there are any hints. Like if the question tells you that there are certain incentives that are coming at the start of the year, or the question tells you in certain examples that lease payments, for example, lease payment to be made on 1st January, that is start of the year. So if it gives you certain hints, then in line with the institute solution, you will make the assumption in line with those hints. However, if no hints are given, then you can assume either of the two. You can write a note. If nothing is given, we will solve considering lease payments at the end of the year, because that is the most common way the institute usually solves it. So this is the working, let us say, for lease payments. Next, you go to the lessor accounting. Remember your creation of ROU asset and lease liability. There is no operating or finance lease concept for the lessee. However, for the lessor, you still have the operating and finance lease concept. So for the lessor, when is it an operating lease? When is it a finance lease? When substantially all the risks and rewards incidental to ownership are transferred to the lessee, it is treated as a finance lease. Operating lease is a lease other than the finance lease. When will you say that there is a finance lease? If, let us say, there is an option to transfer ownership automatically at the end of the lease term, or there is a purchase option which is at a very concessional price, or if the lease term covers a major part of the economic life, that is more than 75%, or the present value of minimum lease payments substantially cover, that is more than 90% the fair value initially, or the asset is of a highly specialized nature which can be used by the lessee only. If any one of these 5 points is triggered, it will be a finance lease. If none of them are fulfilled, then it becomes an operating lease. Now what happens in case of accounting in the books of the lessor? If it is an operating lease, you will not derecognize the asset. In fact, you will recognize the rental income, bank account debit to rent income, and rent income goes to the P&L. The only special case over here would be if the rental incomes are not equal. The standard says that you should recognize rental income on a straight line basis unless any other systematic basis is more evident. So over here, if there's a systematic basis, like the rents are 10, 20, 30, 40 in each of the 4 years, because more area is given in each year, then you'll record rent of 10, 20, 30, 40. However, if there's no other reason, I mean, this is not inflation, there is no more area, and hence you will say that on an average your straight line lease rent is 25, and hence your entry will be in the first year bank account debit only 10 to rent income 25. The balancing will go in deferred rent 15 rupees. Second year bank account debit, let us say 20 to rent income 25, balancing figure 5 rupees in deferred rent, and so on. In each of these years your rent income will be recorded on a straight line basis. This is in case of operating lease. In case of finance lease, you will de-recognize the asset. So you will say lease receivable account debit, like in lessee books you create a lease liability, here you create a lease receivable. The lease receivable is created at what you call as net investment, which for simplicity is nothing but the present value of lease payments for simplified terms. So this is to be recorded at net investment to asset, and if there's any gain or loss, you will record that gain or loss. So lease receivable account debit, you will de-recognize the asset and recognize a gain or loss on that. Going forward, the asset is no longer there. So for finances, there will be no further depreciation, but the lease receivable is there, for which you will have to recognize an interest income. So there will be lease receivable account debit to interest income, and then when you receive the money, bank account debit, let us say, to lease receivable. Now, there are a few important lesser specific terms that you need to be aware of, that is gross investment, net investment, and unearned finance income. Now, what do you mean by this? Well, net investment is typically the present value of lease payments. Lease payments include the fixed lease payments, variable lease payments linked to rate or index, etc. Also, the residual value guarantee. However, what if there is any unguaranteed residual value? Remember, for lessee, you will not look at the unguaranteed residual value because lessee does not have to pay for it. However, for the lessor, one can say in a true capital budgeting process, when you determine the IRR, when I do capital budgeting, I don't just look at the cash flows that I get, I also take the salvage value, whether it is guaranteed or unguaranteed. And hence the lessor's IRR will always include the unguaranteed residual value. And hence, if you want to correctly measure your lessor's lease receivable, should also include the unguaranteed residual value. So the UGRV, unguaranteed residual value, is to be included while determining the net investment. So your net investment, when you calculate, is the present value of your lease payments, including the residual value guarantee, plus the present value of unguaranteed residual value. Remember, this is only to be included in the case of net investment calculation. When you go earlier to assess for lease, when you want to find the PV of minimum lease payments, that is excluding UGRV, as we have mentioned. This is because the lessee is not going to pay you the UGRV. However, the lessor is going to receive it. There's no guarantee for that. But if you are taking the IRR and the workings, you should consider the UGRV as per the Institute of Working. So net investment will be the PV of the lease payments plus the PV of the UGRV. Gross investment is nothing but your total lease payments, ignoring present value calculation, plus the UGRV. The difference between gross and net investment is like unearned finance income. It is like saying the difference between the higher purchase price and cash price is attributable to, let us say, interest income. This is like the unearned finance income. So these are a few lesser specific terms, and UGRV is nothing but the expected residual value minus whatever is guaranteed, that is the unguaranteed element. So there's a 50 rupees expectation, out of which 30 is guaranteed by the lessee, the remaining 20 is the unguaranteed residual value. Okay. Next is a straight lining requirement, that is in case of operating lease. Now, a challenge might arise specifically in case of lessor accounting when you do a manufacturer or a dealer lessor case. So, if you are a manufacturer, let us say, or a dealer lessor, then what happens in case of a manufacturer or a dealer lessor? In which case, you will recognize the revenue, not just sale of a PP, you will recognize the revenue and corresponding COGS. So, your lease receivable will still be recorded at your lease receivable will still be recorded at net investment. Your asset will still be de-recognized at your carrying value. However, you will not directly show the gain. Instead, you will show, let us say, revenue, and revenue is to be recorded, let us say, usually at your fair value or present value of the cash flows minus the PV of UGRV. And because revenue, as per Ind AS 115, will say till the time you sell, you cannot recognize revenue for UGRV. Matching concept says, while recording the cost, that is COGS, you will also not record the UGRV. So basically, your journal entry in line with the INCI solutions will be debtor account debit to sales. So lease receivable account debit to sales, and let us say COGS account debit to inventory, that is asset. So they combine and pass the entry. Lease receivable will be recorded at net investment. Sales will be recorded at net investment minus PV of UGRV. COGS will be recorded at cost minus PV of UGRV, and your asset will be credited at cost or carrying value. Here, if there is any initial direct cost, there will be a 2-bank entry, and that will also go to the P&L. Initial direct cost in case of a manufacturer lessor is to be taken to the profit and loss account. Okay, a few special cases that you should be aware of. First is sublease. Then is sale and leaseback, which is a little more important. Sublease is not as important. In case of sublease, there is going to be an original lessor who gives the asset on lease. This is a head lease. So for original lessor, you will do the working as if it is an operating or finance lease. But then there's an intermediate. So there's an intermediate lessor who is the original lessee. Now he is wearing two hats. One, when he receives the asset, recognizing ROU asset and lease liability in general. And when he gives the asset out, that is the intermediate lessor on a sublease. Now, for determining whether the sublease is finance or operating lease, you are given certain guidance that you will compare the sublease term not with the original life of the asset, but you will compare the sublease term with the remaining life of your right of use. So if it's a 40-year life of the asset, but your head lease is only for 5 years, and you are giving a sublease, let us say, for 3 years. So out of 5 years right of use that you have, you are giving it out on lease for 3 years, and hence that is 60%, not a major part of economic life, and hence the sublease is an operating lease. Okay. So over here, this working is some guidance which is given for sublease. If your original head lease, you have taken a ROU asset and lease liability, and a sublease is a finance lease, you will de-recognize the ROU asset and create a lease receivable. If the sublease is an operating lease, then you will not de-recognize the asset, not create a lease receivable, but just record a rental income. One needs to be remembered that if the head lease, if there is a sublease, the head lease cannot be a lease of a low value item. And second important point from an MCQ perspective can be that if the head lease is a short-term lease, in which case you might not have recorded an ROU asset or lease liability, the sublease will always be an operating lease. You will not treat it as a finance lease, irrespective. Okay, so this is the guidance. Next comes sale and leaseback. Now this is something which is a little or very tricky. So when you look at sale and leaseback, we first say that okay, you are selling the asset, so ideally there will be a gain on sale. But then you are leasing it back, so you are retaining back certain rights or having certain rights back for the asset. So when there is a sale along with the corresponding lease back, over here, if the sale and lease back is, let us say, over here something where the control of these goods are coming back to us, in which case we will treat it as a sale and then a creation of a ROU asset and a lease liability. However, if the rights are not going, the control is not passing, then it is treated as a pure loan transaction. So over here you are just giving, let us say, a collateral or a security. So over here, in case of a sale or leaseback, if the control is actually transferred, which it usually is, then you account it as a sale. If the control is not transferred, then you are accounting it as a loan. Most of the guidance is given if the control is actually transferred. Now what do you have to do? A few steps that you have to remember. First, you will see if there is any hidden off market element. So if you are selling, for example, something at 110 whose fair value is 100, we are saying that 10 rupees extra, why am I getting? Probably there is a hidden loan that I am taking. Or I am selling something at 90 whose fair value is, let us say, 100. Why am I not charging 10? Maybe I am prepaying for rent. So over here, you will look at the off market element by comparing the selling price with the fair value or the present value of the agreed rents with the present value of the fair rents. And the difference over here will give us the off market element. Second, we will try to find whether what is the present value of dedicated lease payments. So we'll say that we'll try to find the present value of the agreed lease payments, whatever is agreed. If there's a loan, we'll say a part of these lease payments is attributable to the loan, and hence you will subtract the loan value. That will give you the present value of dedicated lease payments. If there is, let us say, a hidden lease payment, then I will add to the agreed lease payments the payment on account of the lease. So that will give you the present value of dedicated lease payments. Now remember, when you sell, your entry is bank account debit, okay, perfect. To the asset, you will credit the carrying value. However, the balancing figure cannot directly be shown as sale gain because you are retaining back certain rights. So you have to record an ROU asset. At what value will you recognize the ROU asset? Proportionate carrying value. So you will recognize the ROU asset at, you will say that a day before you had the WDV into the rights retained. So over here, the PV of dedicated lease payments upon the fair value of the asset. So that will give you your ROU asset to be recognized, and correspondingly your lease liability will be credited at the present value of the dedicated lease payments. Remaining balance can be shown as a loan, for example. So over here, your balancing figure. So if you look at the steps, first you find the off market element. Second, you find the PV of agreed lease payments, then PV of dedicated lease payments, where you add or less as the case may be. And then ROU asset is the proportionate carrying value, WDV, into the PV of dedicated lease payments upon the fair value. At this stage, even if you don't find the gain or loss to be recognized, you can pass the journal entry. You have everything: bank account debit, sale proceeds, to asset the carrying value, ROU asset proportionate carrying value, to lease liability, let us say PV of dedicated lease payments to loan if you want to show it separately, or you can combine it and show the combined liability, and the balancing figure will be gain or loss. But this gain or loss is only on the part which is transferred, which you can also calculate. We can say that okay, at the end of the day, the gain on sale is fair value minus WDV, but a part of this is attributable to rights retained, a part of it is attributable to rights transferred. So you can find the gain attributable to the rights transferred, and only that will be recorded in the P&L. Okay, so this is your overall working. Next, you have lease modification. So there are two things before you go over here. There's something called as lease modification, and then there is something called as lease remeasurement. So when you look at a lease modification or a lease remeasurement, what is the difference between the two? In case of a lease remeasurement, as you see over here, remeasurement is not a renegotiation. Your lease terms have already been agreed. Maybe you thought that there was a renewal option that you will not exercise. Now you think you are going to exercise. Maybe there was a variable lease payment which was linked to a rate. Now that rate changes and the cash flows get reset. Maybe there was a purchase option which you thought you will not exercise. Now you think you are exercising. So this is a remeasurement. There's no negotiation which is happening. The terms which were already there are still there. You are just renegotiating. You are just remeasuring based on your revised estimates. In case of a remeasurement, what will you do? You will find the revised lease liability based on the revised possibilities, taking the discount rate as either the original rate or the revised rate. In certain cases, you will take the original rate, certain cases you will take the revised rate. When will you take that? Well, there are two factors. If the remeasurement happens due to a change in the renewal option or the termination option, or it happens due to a possibility of a purchase option, then you will take the revised discount rate. But in other cases like changes in insubstantial fixed lease payment or variable payments which is linked to rate or index or residual value guarantee, in these cases you will continue with the original rate. Sir, what if both changes? Like in one of the questions that we will do, you will have a change in the lease term and at the same time you will also have a CPI reset, in which case you will take the revised discount rate. Basically, you will find the revised lease liability, compare it with the lease liability appearing in your books. The difference over here will be adjusted against the ROU asset. This is a remeasurement case. What happens in case of a lease modification? Even in case of a lease modification, this is a renegotiation. Due to renegotiation, there can be one of the 6 possible changes. There can be either an increase or a decrease in lease, increase or decrease in tenure, or an increase or decrease in scope or area. The standard over here says that if your renegotiation results in you getting an additional right of use, that is additional area or scope, at the standalone selling price, then you treat it as a new lease, create a new ROU asset, create a new lease liability. However, if there is no additional right of use, or if that is not at the standalone selling price, then it is treated as a modification of the existing lease, and the rules for modification of existing lease still continue to remain the same. That is, you will try to find you will first try to find the existing liability initially, prepare amortization table, come to the liability in your ledger, find the revised lease liability. That is, you will take the PV of the modified cash flows always, in this case of modification, always at the revised discount rate, find the lease liability. The difference between these two is typically to be adjusted against the ROU asset. Now usually that is the case. So these are 3 steps. First, find the existing carrying value of the lease liability. Second, find the revised lease liability based on the revised terms. And third, the adjusting entry. That is, you will adjust the ROU asset to the lease liability if there is a change. However, in 2 specific cases, that is if there is a decrease in tenure or if there is a decrease in scope or area, you are giving up certain right of use. And if you are giving up certain right of use, you will have to find the gain or loss. And as a result, there will be a certain gain or loss adjustment. So you will have to find a proportionate carrying value of the ROU asset to be derecognized. Against that, how much is the proportionate carrying value to be of the liability to be derecognized, and hence that will give you a gain or loss. So out of the 6 possibilities, if there's an increase or decrease in rent, if there's an increase in area or increase in scope, this is like additions, for example, where there's no gain or loss calculation, you will directly adjust the ROU asset and lease liability, 3-step working. But if there are these 2 cases where there's a decrease in tenure or there's a decrease in scope, in which case you will have to calculate a gain or loss on this sale as well. How do you do that? You will find proportionate carrying value using an appropriate proportion of the ROU asset to be derecognized, the proportionate carrying value of the lease liability to be derecognized, and accordingly you will try to find the gain or loss of the ROU asset which is getting derecognized. Okay, best if you understand this through a couple of problems. We will do a problem or 2 on this for a better understanding. Okay, this is lease modification in the books of the lessee. What if there is a lease modification in the books of the lessor? This can be due to COVID-19, other than COVID-19. Achha, even if you have taken an earlier class where you had the practical expedient for COVID-19, now that is to be skipped. It is not relevant. You can safely skip that from an exam perspective. Now, if you look at the lease modification from the lessor's books, again the concept remains the same. If there is an additional scope or area at the standalone selling price, that is treated to be a new lease. However, if there is no additional area or additional scope, then it is not treated to be a new lease. In fact, it may be a possibility that there is a modification. For there to be modification, there has to be some changes in the terms. If there are no changes in terms, there is no modification. But if there is a modification of a lease which was currently a finance lease, then the standard says you check that if the modified terms were in existence at initial, would it still be a finance lease? If yes, then you will remeasure the lease receivable with the corresponding adjustment to the P&L. If no, if it were to become an operating lease, then you will have to derecognize the lease receivable and bring back the asset. So if the modified terms were originally present, you will say that if this was an operating lease, then you will have to show it as an operating lease, which means you will have to derecognize the lease receivable, whatever is the carrying value, and the asset will be brought into your books, and that is going to be your deemed carrying value. Okay, so that is for the asset. However, if there is operating lease which gets modified, the standard keeps it very simple. It says if operating lease is modified, you treat it as a termination of the existing operating lease and creation of a new operating lease. And while creating of this new lease, you will also consider the deferred rent balance, if any, which was remaining. Okay. Last part is transition approaches. Not very important. It was only there for the 1920 workings, but it is there in the study material, so you can review that. If you originally had a lease, you will not now at the time of transition see whether there is a hidden lease element. If it was originally a finance lease, now you will continue to show that as the same balance. However, it was an original operating lease and now it has to become a finance lease, then or now you have to show ROU asset or lease liability. There are three approaches: a full retrospective approach where you will go back and retrospectively find the ROU asset, lease liability and do the workings. Modified retrospective, alternative one, where you retrospectively go back and find the ROU asset, but lease liability you do based on the remaining cash flows on 1st April 19. And lastly, modified alternative 2, which is the most common and popular, where you take the PV of remaining cash flows at the discount rate on 1st April 19, and that is the same as the ROU asset. So these are the transition approaches, not very important from an exam perspective. Next, you will go to the section where we are discussing, let us say, the questions. So let us go to the questions for Ind AS 116. Let us go to the first question over here. Let us review this. We have a case where there is an EFG who is entered into a property lease. The term is 10 years with a 5-year renewal option. So should you take the renewal option or not is also something that you should consider. Economic life of the property is 40 years and the fair value of the property is 50 lakhs. EFG has an option to purchase the property at the end of lease term for 30 lakhs. So there is a purchase option also available over here. The first annual payment is 5 lakhs with increase of 3% every year thereafter. So 5 lakhs plus 3%, that is 5 lakh 15 plus 3% and so on. This is fixed payment. This is not variable, this is fixed. The implicit rate of interest is, let us say, 9.04%, and there is an incentive that is given of 2 lakhs which is payable at the beginning of year 2. Now, the institute has updated and modified this problem, but otherwise this gives you a hint that if one of the lease incentives is happening at the beginning of year 2, we can also say that the other payments may be happening at the beginning of each of the respective year, and hence this is a question which the institute has solved considering the payments are at the beginning of the year. Going forward, if it is clearly mentioned, then nothing like it. If not, we will assume that at least considering one of these lease incentives or payments is happening at the beginning of the second year, that means the other payments may also be happening at the start of the year, though alternative assumption was possible. Which is used for normal tenant improvement. It is reasonably certain to exercise the purchase option, in which case a payment under the purchase option of 30 lakhs will also be a part of your lease liability calculation. How would EFG measure the right of use asset and lease liability over the lease term? So your initial recognition will be at the present value of the future cash flows. How will you calculate the future cash flows? Well, you will go from year 0. See, the first payment happens at year 0. It is the beginning of each year, in which case it happens at the start of year 0. That is it happens at the start of year 1, that is year 0. The second payment happens at the start of year 2, that is end of year 1. Third payment happens at the start of year 3, that is end of year 2, and so on. So over here you have year 0, then you have lease payment, it is 5 lakhs. Then at the end of the first year, that is start of the second year, you pay the next payment, that is 5 lakhs plus 3%, that is 5,15,000. However, there is also a lease incentive that is received of 2 lakhs, and hence 5,15,000 you will pay, 2 lakh you will receive, and hence net 3.15 lakhs. Next, at the end of the second year or start of the third year, you will have 5,15,000 plus, let us say, 3%, and hence this comes to 5,30,450, and so on. So this will keep on going till the end of the 9th year or the start of the 10th year, when you will make the last payment as agreed. However, at the end of the 10th year, there is also a purchase option, and the question says that it is reasonably certain that you will exercise the purchase option. And hence, apart from the 10 payments, that is from year 0 up to year 9, the 10 payments that you will make, over and above that, you will also have 30 lakhs of payment. All of this will be discounted at the rate of 9.04%, and if you do that, the present value, so as you can see over here, the first payment is, I think, 5,05,000. This is not 5,50,000, this is 5,15,000. Sorry, this is 5 lakhs only. The first payment is 5 lakhs, then it is 5,15,000 minus 2 lakhs, and so on. This keeps on going from year 0 to year 9, end of year 9, that is start of year 10, the final payment. And then, because there is a purchase option which is likely to be exercised, at the end of the 10th year, you will take that, and hence your lease liability is approximately 50 lakhs. Your ROU asset will also be 50 lakhs because there is no other initial direct cost or a site restoration or any other item, and hence your ROU asset will also be 50 lakhs. This ROU asset will be depreciated over the remaining 40 years. Remember, there is a purchase option which is likely to be exercised, and hence the depreciation will be over the 40 years. ROU asset will be depreciated over the 40 years to ultimately go down to a nil balance after 40 years. Your lease liability will be applied using the amortization method, where, because the payment is happening at the start, your amortization table will be starting with year, let's say 0, or let's say year 1. Your opening balance will be, let us say, 50 lakhs. Now, before you charge interest, the first payment will be paid off. So, you will have a lease payment at the start, that is 5 lakhs, and hence your adjusted opening will be 45 lakhs. On 45 lakhs, you will have an EIR at the rate of 9.04%, and accordingly, you will get the closing balance, and you will keep on making the table. In the second year, the payment will be 3,15,000, and so on and so forth. If you make the table right up to the end of the 10th year, not just end of 9th year, end of the 10th year, you will come down to a balance which is approximately equal to 30 lakhs. So, this is regarding question number 1. Next, you go to question number 2, which is manufacturer or dealer lessor. Over here, there is a 10-year lease. The equipment is not specialized in nature and is expected to have alternative use at the end of 10 years. So, the lessor receives an annual payment of 15,000 payable at the end of the year. Now, there are 10 such payments, so 15,000 at the end of each of the years. The lessor expects a residual value of the equipment to be 50 at the end of the 10th year. So, this is the expected residual value. Lessee provides a residual value guarantee that protects the lessor from the first 30,000 of loss from the sale price below the estimated residual value at the end of the lease. So, even if you were to sell at zero balance, zero value, then the lessee guarantees that they will pay you 30,000. If it is sold for, let us say, 0, still the lessee is guaranteeing 30,000. So, 30,000 out of the expected 50,000 is guaranteed, which means you can say that the unguaranteed residual value is a difference, which is 20,000. 50 minus 30, that is equal to 20, unguaranteed residual value. The equipment has a remaining life of 15 years and a carrying amount of 1 lakh and fair value of 1,11,000. Now, if I'm in the books of the lessor, I need to determine whether it is an operating lease or a finance lease. One of the things is, does the lease cover a major part of the economic life? So, this is 10 out of 15, and hence it covers around 2/3, that is 66.67%, which is not a major part of the economic life. The lease does not transfer ownership to the lessee at the end and does not contain even an option, and hence the first two conditions for finance lease are also not met. The third condition of major part of the life is also not met. So, your assessment is based on whether the PV of the minimum lease payments substantially cover the fair value. The fair value is 1,11,000. If you try to find the PV of the minimum lease payments, that is the present value of 15,000 for 10 years plus 30,000, that is a residual value guarantee at the end of the 10th year, UGRV will not be taken, and you will try to find the present value. The interest rate implicit in the lease is 10.078%. So, over here, if you try to find the present value of the minimum lease payment, that is 15,000 into the PVAF at the rate of 10.078% for a period of 10 years, plus a residual value guarantee, that is 30,000 into the present value factor at the rate of 10.078% for the 10th year. So, over here, 1 divided by 1. So, this is 1 divided by 1.10078. If you do this for 10 times, and then you take the total. If you adjust all of this, this comes to approximately 1,03,000 and something, 1,03,345 approximately, and 1,03,345 upon 1,10,000, which comes to around 93.95%, and as a result this is treated as a finance lease. So this lease would be a finance lease. How should the lessor account for the same in the books, assuming the lessor is a dealer lessor? A point to be noted is ICI over here is not specifically mentioned whether it's a dealer lessor or not, and hence ideally they should have been clear. But if a similar question comes, you will assume that you are going to solve as it is a dealer or a manufacturer lessor, as a case may be. So over here, if it is a finance lease, in case of a finance lease, you will have to derecognize the asset. The asset in your books is carried at 1 lakh, and you will have to record a lease receivable. Now, at what value will you record a lease receivable? At the net investment. So if you want to find the net investment, that is the present value of minimum lease payments plus the present value of UGRV. So that is 1,03,345 approximately, plus another 20,000 into the present value factor at the rate of 10.078% for the last year. So that is 0.3828, and as a result over here this will come to approximately 1,11,000. So if I were to look at the net investment in this particular case, the lease receivable will be recorded at 1,11,000. So your journal entry will be lease receivable account debit 1,11,000. You will derecognize the asset. So lease receivable account debit, what you will credit over here is going to be the asset at 1 lakh rupees. So your journal entry, let us say, will be your lease receivable account debit 1,11,000. 1,11,000 to, let us say, you will credit the asset. So the asset over here will be credited, let us say, at 1 lakh. Apart from this, you will credit the sales, and you will also credit the COGS. So your sales over here is 1,11,000 minus the PV of UGRV. So this is, I think, 0.3828 into 20,000, and hence this is 7656. So over here, if you adjust this, what you will get is 1,03,344. This is sales, and then the COGS, you will again have 1 lakh minus, so this is 1 lakh minus, you will have 7656, and hence this is 93,000. Again, I think 93,344, and that is about it. So in your P&L account, you will take a sales of 1,03,000, COGS of 93,000, and by default there will be a gain of around 10,000 in your profit, and 10 or 11,000 in your profit and loss account. So this is, I think, 92,000, sorry. So this is 92,344, and if there was some initial direct cost, you will say to bank separately, and that will be shown either separately or added along with the COGS to be taken to the profit and loss. So this will be your entry at year 0. At year 1, your lease receivable will be recorded using amortized cost method. So 1,11,000 into 10.0, 1,11,000 into 10.078%, and you will get 11,187 as 11,187 as your finance income. So this would be a finance income of 11,187, and so on. So a fairly interesting question, I would say. Question number 2. Question number 3 involves a sale and lease back. So over here there is a entity who is selling a building for cash of 30 lakhs. So this is like your actual selling price, and the building has a carrying value of 15 lakhs. So this is your WDV. So you are entering into a contract with the buyer for 20 years with annual payments of 2 lakhs payable at the end of each year. So this is 2 lakhs payable at the end of each year for 20 years, and the terms are such, as this paragraph mentions, that this results in transfer of control, and hence this is not a mere loan. There is a sale as well. The fair value of the building is 27 lakhs. So over here is a transaction at market or off market. Well, the selling price is 30, whereas the fair value is 27, and hence you are getting more than the fair value. How much more? 3 lakhs. And hence that 3 lakhs is a hidden loan because you are getting more than what the fair value should be. So it is assumed that there would be a hidden loan probably of 3 lakh rupees. Initial direct cost can be incurred, it can be ignored, and the discount rate is 12%. The buyer lessor is showing it as an operating lease. How would the transaction be accounted for? So first you will look at the off market element. The off market element over here is 3 lakhs. The difference between the selling price and the fair value. Second, you will try to find the PV of the dedicated lease payments. So PV of ALP, that is agreed lease payments, is 2 lakhs into the present value annuity factor. I think this is 7.4694. If I multiply, this is around 14 lakh 93,880. But out of this 14 lakh that you are paying, if I had to pay 2 lakhs over a period of 20 years, that would have been the payment. Instead of that, if I have to pay today, I would have paid 14 lakhs. Similarly, the loan of 3 lakhs that is taken had to be repaid. I don't know how much is repaid for the loan. However, if I were to be told to repay the loan immediately, that would be 3 lakhs. So out of this 14 lakhs, in today's terms, 3 lakhs is attributable to the loan, and hence the remaining 11 lakh 93,880 is attributable to the PV of the dedicated lease payments. Okay, after this, if I were to find the ROU asset, we will say that, see, at the end of the day, the ROU asset is at 15 lakhs today. If I get all the benefits back, I would have paid 27 lakhs, but I'm paying approximately 11 lakh 93,880, which is towards the asset purely. So 15 lakhs into 11 lakh 93,880 upon 27, and you get around 6 lakh 63,267. This is your ROU asset to be recognized. So if you go to see your ROU asset to be recognized will be 6,63,267. Now you have enough data to find the journal entry. However, if you want to find the gain, you could have found the gain as a balancing figure, but if you want to find the gain, you would say that, see, at the end of the day, the gain is calculated as a fair value minus the WDV. So that is around 27 minus 15, that is equal to 12. That is, provide all the rights were given up. However, there are certain rights that you are retaining and certain rights that you are transferring. Now the gain attributable to the rights retained will again be 11 lakh 93,880 upon 27. So this is the gain. So 12 into 11 93,880 upon 15. So one can say that around 12 lakhs into 11 93,880 upon 27. So this comes to around 5 lakh 30,613. So this is attributable to the rights retained and hence should not be recognized, and hence the remaining, if I go to see, this is 6 lakh 69,387 or something would be attributable to the part which is transferred, and hence again should be recognized. So if you look at this, you will have 6,69,000. Now if I had to pass the journal entry, debit what comes in, credit what goes out. What is going out is the asset. So you will credit the asset. For example, at 15 lakhs, debit what comes in, money is coming in. Let us say 30 lakhs is coming in, debit the bank. So you'll have bank account debit 30 lakhs to asset, let us say 15 lakhs. However, so this is recording the sale. You also have to record the lease back. So if you record the lease back, there will be a lease liability which is recorded at 11,93,880. Along with that, a financial liability on loan which is recorded at 3 lakhs. ICI combines and shows both of these together. Having said that, we can show them separately as well. So ICI is combining and showing them together because ultimately for both of them, you have to record as per amortized cost only. Further, you will also recognize an ROU asset which is to the extent of 663, and hence the balancing figure of 669 will be the gain which is attributable to the part transferred. In the books of the buyer ledger, you will take over the asset, for example, at 27 lakhs, and 3 lakhs will be treated as a loan given to bank. So asset account debit 27 lakhs, loan given account debit 3 lakhs, to bank let us say 30 lakhs, and going forward, because the buyer gives it out of as an operating lease, you will record rental income. So that 2 lakhs that you are receiving will be split between partly rental income and partly, let us say, recovery of loan in the ratio of 11.93:3, for example. So this will take care of this sale and lease back question. Then we have question number 4. This is on remeasurement. So there are two things that will change in this particular question. First, there will be a reassessment of the lease term, and second, there will be a CPI reset. There is no renegotiation. If you see over here, there is a contract for lease on 1st January 11. The lease term is 5 years with the renewal option of 3 years. So this 3 years is already there in the contract, and the payments are 1 lakh for the first 5 years and 1,10,000 respectively for the next 3 years. The annual lease payment will increase based on the annual increase in CPI. So these payments will change based on the CPI, and for the purpose of CPI, you have been told at the end of the preceding year. For example, the payment due on 1st January 12 will be based on CPI on 31st December. So here the question very clearly tells you, for example, the payment due on 1st January 12, which means the payments are happening at the start of each year, and hence you will do the working based on lease payments which are happening at the start of the year. Now entity W's incremental borrowing rate at inception is 5, and then at January 14 is 6%, and the CPI at starting is 120 and then is at 125. So basically, ideally, if I knew the CPI as on 31st December 11, then I would reset my cash flows of 2012. I don't know the CPI. Similarly, I don't know the CPI on 31st December 12. Technically, I don't even know the CPI on 31st December 13. However, I know the CPI on 1st January 14. For all practical purposes, the CPI on 1st January 14 is the same as the CPI on 31st December 13. And hence, my cash flows will be reset on 1st January 2014. So, the first year cash flow will be at the start of the first year. That will be 1 lakh. Second year will be at the start of the second year. Third year will be at the start of the third year. So this will be 1 lakh only. However, from the fourth year onwards, starting the fourth year, you will reset the cash flows based on the CPI of 125 rupees. In the intermediate period, we do not have any CPI, hence we cannot reset. We will reset from the start of the fourth year. Let us say the question ends over here, in which case there is no renegotiation. This was originally agreed, and hence if the question ended over here, if you have to find the revised lease liability, you will say that there is a lease payment which is changing due to rate or index, and if this was the only change, we would say that we will find the revised lease liability at the original discount rate. Remember, you take the revised discount rate only if there is a change in the lease term or possibility of exercise of a purchase option. In other cases like in substance fixed lease payment, residual value guarantee or variable lease payments linked to rate or index, we continue with the original discount rate only. So if that was the only case, we would have continued with the original discount rate, for which we have a separate sum as well if you would have done that. However, in this question, at lease commencement, W did not have a significant economic incentive to renew, but in the first quarter of 2014, W installed some improvements, and hence these improvements have an estimated 5-year life. So now it is likely that you will renew. W determined that it would only recover the cost of improvements if it exercises the renewal option, creating a significant economic incentive to extend, and thereby you will revise the lease term as well. So what will happen is, at year 0, if I were to find my lease liability, I would say that your lease payments are 1 lakh into CPI at the beginning, 120 upon 120, and hence this is 1 lakh. Now this is 1 lakh to be paid over 5 years, because initially we did not expect that there will be any renewal. So this is into, let us say, the PVAF at the rate of, I think at the commencement date it is 5% from years 0 to 4. So at the end of 4th year, that is equivalent to the start of the 5th year as well. So at this we will say 1 divided by 1.05, 1, 2, 3, 4, and to this you will add 1. So this is around 4 point. So this is into 4.5460, and hence this comes to 4,54,600. This will be your lease liability initially, and also your ROU asset. Now this lease liability will be changing in each year due to the amortized cost working. So we'll prepare the amortized cost table for 3 years, where each year the payment is 1 lakh. Remember, the payment is happening at the start of each year. So over here, initially 4,54,000 minus 1 lakh gives you adjusted 3,54,000 into 5%, and you will get closing. So over here, this is, I think, 1,95,000. You will get this on 31st December 2013. This is 1,95,000 in your ledger. However, on 1st of January 14, technically there are 2 years remaining. However, now you expect the renewal to happen. So 2 plus 3, that will be a total of 5 years remaining, and your CPI is also reset. So basically at the start, so basically, for example, on 1st of January 2014, now you are at year 0, then 1st January 15, that is year 1, and then 1st January 16, year 2, 1st January 17, and 1st January 18. This is year 3, and this is year 4. So if I take each of these values, you will say that, okay, 1 lakh was a payment into 125 upon 120. Again 1 lakh into 125 upon 120. However, going forward, it was 1.1 lakh into 125 upon 120. Remember, when the payment was 1 lakh for the original period, it was 1,10,000 for the renewal period, but that was based on the CPI of 120. Now if the CPI gets reset, 1 lakh gets reset. At the same time, if the CPI gets reset, 1,10,000 also gets reset. So over here, this is 1 lakh into 125 upon 120, which will come to around 1,04,000. 167, same case, and this is 1,10,000 into 125 upon 120, and hence this is what, 1,14,583. And hence if I were to do these workings, I will then take a discounting factor, let us say at the rate of I will take the discounting factor, let us say at the rate of 6%. Sir, but why are we not taking 5%? Because there is also a change in the lease term. Because there is a change in lease term, you will take the revised discount rate, that is equal to 6%, and accordingly, based on that, if you do the workings over here, you will get 4,91,346. In your ledger, you are having 1,95,000. Now that changes to 4,91,000, and hence your liability increases. It increases by around 2,96,113. If your liability increases, that is making your right of use asset more costly, and you are getting more right of use. So as corresponding effect, we'll go to the ROU asset. You are adjusting it is ROU asset account debit 296,113 to your lease liability 296,113. Going forward, your ROU asset will be adjusted and will be spread over the remaining, I think 5 more years are remaining. There were 2 years plus another 3 years, so it will be spread over the next 5 years, and you will do amortization of the revised lease liability of 491,346 using an EIR of 6%, and accordingly your workings will progress. Okay, next you go to question number 5. Here there is a modification whereby there is a reduction of your lease term, and there is also increase in scope. So there are 2 or 3 things which are changing here. So there's a lessee who has a 10-year lease for 2,000 square meters. The annual lease payments are 1 lakh payable at the end of each year. So this is 1 lakh payable at the end of each year for a 10-year period. The interest rate implicit in the lease cannot be readily determined, so the discount rate was 6%, and hence if you had to find the lease liability initially, you would have taken 1 lakh into the PVAF at the rate of 6% for a period of 10 years. If I go to see, I think this was 7,36,000 or so. You can check the calculations. At the beginning of year 6, which means 5 years have gone by and you are now at the start of year 6, lessee and lessor agree to amend the original lease. In question 4, there was no amendment. Here, there is a change. There is an amendment. They agree to amend the original lease to include an additional 1,500 square meters. That is from 2,000. You are getting another 1,500. That is, you are getting an additional right of use in the same building starting from the year 6. Remember, if this additional right of use is at the standalone price, then this will be treated as a separate lease altogether. And reduce the lease term from 10 years to 8 years. The annual fixed payment for the 3,500 square meters is 1,50,000 at the end of each year from year 6 to 8. And now the revised rate is 7%. Okay. So the consideration for increase in scope is not commensurate with the standalone price, and as a result we will not treat it as a separate lease. In fact, will be treated as a modification of the existing lease. How will the modification be accounted for? So first of all, you will try to find your lease liability initially, that is 7,36,000, and then you will prepare an amortization table and come to your lease liability balance at the end of year 5. So what will be the lease liability balance at the end of year 5? You will prepare an amortization table. Let us say that comes to 421,225. So over here, let's say 421,225. At the same time, you will try an ROU asset. This is 7,36,000 to be depreciated over 10 years, out of which 5 years have gone by. So 7,36,000 divided by 10 into 5, and hence this comes to around 3,68,000. So your ROU asset will appear at 3,68,000. So you have found the ledger balances as on the date of modification. However, what does the modification entail? There is a reduction in tenure. Earlier you had a term of 5 years. Now you have a right of use of only the remaining 3 years. Remember, the depreciation is going to be equal each year. So if the last 2 years are not there, proportionately, if I have to derecognize the ROU asset, the ROU asset that will be derecognized will be, let us say, to ROU asset, proportionate, appropriate proportion. We will say, dekho yaar, 3,68,000 is to be depreciated over 5 years, equally, of which the last 2 years, let us say, if it is not there, then what is derecognized is 1,47,200. Okay. However, when you look at lease liability, technically we still have an obligation to pay 1 lakh for the next 5 years, out of which we can say that 1 lakh of the last 2 years need not be paid. So one can also say that, okay, that means into 2/5 payment not to be made. Institute does not agree with this, and rightly so, because the last 2 years of 1 lakh which are foregone is not similar to the first 2 years of 1 lakh foregone. It is not the same. Depreciation is same each year, but the liability values will be different. So 1 lakh in the last 2 years is different from the 1 lakh in the first 2 years. So what is foregone is your lease liability. So this is 1 lakh of the last 2 years. So that is 1 divided by 1 point in your ledger. The discount rate was 5%. So 1, 2, 3 and then 4 and then 5. So probably this is around I think 6%. So 1 divided by 1.06, 1, 2, 3, then 4 and then 5. So this is around 1.5394. So this is basically the last 2 years of liability. For giving up this right of use, I will give up the last 2 years of liability, which is now approximately 1,53,935 or so. So this is your liability foregone, and as a result there would be a gain over here. This is 1,47,200. So there would be a gain of around 7. Just a second. There would be a gain 153,935 minus 147,200 of 6,735, and this is a gain on the partial derecognition which will go to the P&L account. Now going forward, you can actually take more steps as well, like the institute finds a revised lease liability, changes the effect due to the discount rate, then due to the increased scope. If for the timing, if you were to do it directly, you will say that, well, after this transaction your lease liability will appear at what? Well, it was earlier, I think 421, 225. From this you will subtract 153,935, and hence you will have 421, 225 minus 153,935, and hence this is around 2,67,290. When you look at your ROU asset, let us say, was 3,68,000, from which if you subtract 147,200, so this is 368 minus 147,200, and this is 2,20,800. This is your ledger balance. Now your revised lease liability will be based on the revised lease payments. What is your revised lease payments? Well, your revised lease payments is 1,50,000 to be paid over the next 3 years. So this is at the discounting rate of 7%, the revised rate, because there is a modification. 1 divided by 1.07, 1, 2 and 3. So if I were to take the total, this is around 2.6243, and hence if I multiply this, it's around 3,93,000 and something. So your lease liability will be 3,93,645. However, in your ledger it is currently appearing at 2,67,290, and hence the difference between the two is the additional right of use you are getting, for which you are agreeing to pay the additional value of 1,26,000. So your ROU asset account debit to lease liability will be adjusted for this remaining balance. So this is one question on remeasurement, this is one question on modification, and then you have question number 6 and probably question number 7, which deals with identification of lease, separation of lease and non-lease components. So if you look at question number 6, this involves separation of lease and non-lease components. Over here you have taken a property on lease where there is a first floor along with facilities. So the floor represents the lease component, whereas the facilities represent the non-lease component. So the entire floor for 9 years, the lease rent is 70,000. There is also some facilities, and for the facilities you are paying 1 lakh rupees. So you are totally paying 1,70,000, and the discount factor is 10%. But out of that 1,70,000, as per the agreement, 70 is for the floor and 1 lakh is for the facilities. The question really tells you that the standalone price is 1,20,000 for the lease agreement, and for facilities it is 80. So if I have to do the allocation, you have been taught that the allocation has to be in the ratio of the standalone prices. So for the lease component, that is a floor, whatever is the agreed payment is not relevant. For the facilities, which is a non-lease component, again whatever is the agreed payment is not relevant. What you are totally paying is 1,70,000, and this 1,70,000 will be attributed in the ratio of the standalone price, that is 120 upon 200, and again 1,70,000 into, let us say, 80 upon 200. So if you do these workings, 1,70,000 into 120 upon 200, which probably comes to 1,02,000. And the remaining, I think 68,000 is attributable to the facilities. This is the non-lease component, and facilities expense will be recorded as and when these facilities or services are utilized. So over here, you will try to find the present value of the lease. So basically, the question says, how will be the lease liability? So your lease liability will be 1,02,000 into, you will take the PVAF. The PVAF over here will be at the rate of 10% for a period of 9 years. And accordingly, you will get 5,87,000 and something. So this is around 5,87,316 or so, which is going to be your lease liability for your facilities, as we can see. So this is 1,02,068. Lease liability is 587, and 68,000 is to non-lease component, will be recognized as and when it is incurred. So this is regarding separation of lease and non-lease component. Now question 7 is a November 2023 exam question. We have discussed this at length again in your November 23 suggested videos. If you want to see the detailed video, you can refer that. But otherwise, if we quickly discuss this again, over here there would be some separation of lease and non-lease component, but there are 4 things which are asked. You are required to identify the lease and the non-lease component over here. If you read the question, you are taking a property and you are also giving some job work. So basically, if there's an identified asset which is there, that will be the lease component, and the job work will be the non-lease component, okay, at the commencement of lease. Then compute and allocate the consideration into the lease and the non-lease component. So whatever is your total transaction price, you will segregate between lease and non-lease component. Compute the lease liability with the present value factor at the rate of 10% per annum at 2.49, and then discuss the treatment of the lease and non-lease component. So if you go to review this, you are an entity A where there is an agreement with B for dedicated production line. So the question very clearly tells you it's a dedicated production line, and hence there is an identified asset which is physically distinct to manufacture one of its household products for a period of 3 years. So we are taking the right of use on this production line and we are telling them to probably manufacture certain products. We have agreed to a minimum 1 lakh units per month and to make a payment at the following rates: 240 per unit if the ordered quantity is between 1 lakh to 2 lakhs, 1 lakh 20 and 246 above. So as per the terms, A has the exclusive right to use the production line. So there is a clear identified asset where you are going to get substantially all the benefits. B cannot use the specified production line for any other customer. The type of product is specified in the contract. A issues instructions to B about the quantity, timing, etc. If the production line is not producing the household product for A, it remains idle. All of this is kind to show you that you have a right to direct the usage. B operates and maintains the production line on daily basis. A has estimated that the manufacturing each unit, B incurs an average cost of 195. This is the cost for B that it will incur. Further, the observable standalone price for rent is 60 lakhs per month. Entity A's incremental borrowing rate is 10%. So for the production line, if I go to see, I am not paying anything specifically, but I am paying 240 per unit, and there is a minimum order quantity of 1 lakh. I have to pay how much? 240 into 1 lakh, that is 240 lakhs. I have to pay 240 lakhs. I don't have a choice. So that is in substance fixed, and hence beyond 240, whatever is there is actually variable. We don't take the variable payment in the calculation of lease liability, but this 240 lakhs, which is in substance fixed, has to be taken. But this 240 lakhs, as per agreement, nothing is attributable to the dedicated production line. The entire 240 per unit is attributable to the job work. However, if you look at the standalone prices, in the case of standalone price, the standalone price for the lease component over here is 60. However, for the job work, that is the non-lease component, it is 195 per unit into, let us say, 1 lakh units. So this will be 195, and hence if I say this will be 195. So what is your payment in substance fixed? I will say that for 1 lakh units I have to pay 240, and hence 240 is my payment. Now ideally I should have paid 60 plus 95, that is 255. However, there is probably some combo discount, and hence I am paying 240. But out of this 240, how much is attributable to the lease component? I can say 60 upon 255 into 240 is attributable to the lease component, and 195 upon 255 into 240 is attributable to the non-lease component. So if I go to say 60 upon 255 into 240, which is around 56.47 lakhs, and 195 upon 255 into 240, which is around 183.53 lakhs approximately. So this is going to be your allocation. So if you go to see, when you look at your allocation, this is 56.47 and 183.5. So this is your allocation. Now this is point 1 and point 2. Point 3 says compute the lease liability. While you want to find the lease liability, this is 56.46 payment to be paid per month. So if it is 56.47 per month into 12, this will come to approximately 677.64 per annum. Now ideally you have to take the present value factor for each month. However, the question tells you the present value factor for 3 years together, and hence you will say per annum you are 77.64 per annum into 2.49, and if you multiply this into 2.49, you will probably get around 1687.32. So this will be your lease liability. If I go to see, this is, you will take the per annum value, and then the lease liability, it's 1687, which is what we have found. And lastly, determine the recognition and treatment of the lease component and non-lease component. For the non-lease component, you will recognize expenses as and when they are incurred in each year. But for the lease component, you will create an ROU asset and a corresponding lease liability at probably 1687.32. ROU asset will be depreciated over 3 years. Lease liability will be amortized using the effective interest method. So this is what has been mentioned. So job work charges would be recorded in the P&L for each year. This is like the non-lease component. Okay, so this kind of takes care of Ind AS 116, including the important problems. Next, you will go to the next important and the last of these major topics, your favorite Ind AS 115, which is revenue recognition. So let's go to Ind AS 115. This is on revenue recognition, tier 1 category standard. So the core principles that need to be followed for Ind AS 115 is, first, you will have to recognize revenue when the performance obligations gets discharged, and second, at a price that an entity expects to receive, that is typically the standalone selling price. For incorporating that, the standard gives a 5-step revenue recognition framework, which is first identifying the contract, second determining the performance obligations, third determining the transaction price, fourth allocating the transaction price to the performance obligations, and lastly, finally going into the revenue recognition. So when we look at identifying the contract, typically for an accounting contract to exist, the standard features of a contract should be there, like there should be parties who are committed to the terms, who are clearly aware of their responsibilities. But apart from that, it is necessary that this contract has commercial substance. If it does not have commercial substance, step 1 is not met. If step 1 is not met, you don't go further into the revenue recognition framework. Further, it is necessary that the consideration that is expected to be received should be probable. It should be probable that you will receive consideration on account of this, and hence in such a case will you treat it as an accounting contract. Sometimes it is possible that the consideration is received, like a token money is received, however later the contract kind of is cancelled. That is, you don't have any further performance obligations to be discharged and you don't have to refund the money. In such a case, at such a time when this token money is what you call as forfeited, is when you recognize the revenue, when the entity does not have any further obligations and the money that is received is non-refundable. A couple of other things that you need to be aware of is, if there are multiple contracts which are entered at or around the same time, will you treat them as separate contracts or will it be a part of a single contract? Well, it depends. If they are entered into around at the same time and this is a part of a single, let us say, profit margin or a single overall arrangement, then you can combine them and treat it as a single contract. Otherwise, you can separate it and show them separately as well. The contract tenure, term or etc. may in some cases be asked, in which case you will take only that tenure or term where there are enforceable obligations. Like there is a gym membership you have kind of sold for 12 months. However, out of that 3 months is non-cancelable. After that, any party can cancel in the remaining 9 months without any significant penalty, in which case the enforceable tenure is, let us say, 3 months only. Okay, so that is the first part. The second step over here is identifying the performance obligations. What is a performance obligation? Well, performance obligation is basically a promise to perform a certain or promise to do a certain task which is agreed as per contract. So performance obligations we will recognize revenue as and when performance obligations are discharged. And what is a performance obligation? A promise to deliver a single good or service that is distinct. Sometimes there can be a series of distinct performance obligations where, let us say, you are giving similar goods and services, in which case that entire series can be treated as a single performance obligation. However, we first need to figure out over here that what do you mean by the words distinct. We said that a performance obligation is a promise to deliver goods or services, let us say, that are distinct. When are they distinct? Well, when the customer gets a separate benefit from each of these, they are treated as distinct. And secondly, they should be separately identifiable. Here the definition is negative, so we say they are separately identifiable if they are not a part of a single integration exercise, or they are not a part of a significant customization exercise, or they are not highly interrelated. That is, if they are a part of a significant integration activity, if they are a part of a significant integration activity like construction of a power plant, then all the promises are a part of a single performance obligation, a single promise, that is construction of a power plant. If it is a significant modification or customization exercise, then all the promises to customize or modify, like a renovation contract, would be a part of a single performance obligation. And if they are highly interrelated, again they will be a part of a single performance obligation. So over here, for them to be distinct, they should not be highly interdependent, they should not be a part of a significant integration activity, or they should not be a part of a significant customization or modification exercise. A few special cases over here is determination of whether we are acting as a principal, in which case we will recognize a gross revenue, or an agent, in which case we will just recognize a commission or the net revenue. So in case of a principal, you are primarily responsible for discharging that obligation. The inventory risk is typically on you. Even the pricing discretion is on you. So these are typically the features of the entity acting as a principal. Further, sometimes you might end up receiving an upfront non-refundable fee, like on gym membership, you might get an admission fee, or in case of let us say activating a particular service, you might get a fee which is upfront. In case that fee is linked to certain performance obligation to be discharged, like a welcome kit to be given, then the revenue will be recognized as and when the welcome kit is delivered. However, if it is other than that, like for example, if the entity over here, let us say this something like this: if the entity is activating an international roaming package, in which case there is no performance obligation initially. However, the fee that you are receiving initially is a part of that international roaming plan, and hence is to be recorded as and when the international roaming revenue is to be recorded. So this is the second step, which is on performance obligation. The third step is transaction price. Transaction price refers to the amount that the entity is expecting to receive for discharging the performance obligations. Again, this is excluding GST or taxes which you are collecting on behalf of the government. So your transaction price will definitely include the fixed transaction price. But what about the variable consideration? The variable consideration will be included if it is not constrained. What do you mean by constraints? Constraints over here mean that if I include the variable consideration and at a later date, if there's a possibility that I'll have to reverse it, that means it is constrained. However, if I include it and it is not probable that a reversal will happen at a future, then I will say it is not constrained. In simple words, I can include the variable consideration which I'm confident about receiving in the future. And when I say it is, when I'm not confident, I would say that it is constrained, and hence I will not include it as a part of the transaction price till the time I'm confident enough. So when do I say that there are constraints? Well, if my experience is limited, I would say that if there's a bonus linked to completion, but I don't have experience in completing similar projects, that means there are constraints, or the time horizon is very long, or the variable consideration is linked to something which is beyond my control. In all of such cases, I would say that the variable consideration is constrained, in which case it should not be included into the transaction price calculation. However, in other cases where variable consideration is not constrained, you should include them in the transaction price calculation. But at what value will you include it? Well, it depends on how you measure the variable consideration. The variable consideration can be measured using what we call as the expected value method, which is the probability based weighted average method, or the most likely value method. Now, in practice, either of these methods can be selected, but from an exam perspective, from a student angle, we will take the variable consideration into the calculation depending on expected value if there are more than two possibilities. then you will take the probability weighted average of all these possibilities. But if there are exactly 2 possibilities, then you will take the most likely outcome. That is what the institute typically does, unless the question tells you the other way around. So this is using the expected value method or the most likely value method. Again, if there's a penalty is also a variable consideration, maybe a negative variable consideration. It can reduce the transaction price. We will also consider the penalties in the determination of transaction price if the penalty is inherent in the determination of transaction price. Mere protective penalties should not be considered. Constraints we have discussed. Then there are a couple of special cases like sales on return basis. If you are selling goods on a return basis, as per the old standards, we would wait till the time the customer communicates their acceptance or till the time the return window closes. As per Ind AS, you don't need to wait for that. So if, for example, you have sold goods which is subjected to return, at the balance sheet date, these are goods which are still subjected to return, but based on your past experience, you believe that 80% of the goods will not be returned, and hence revenue should be recognized at least for 80% of these goods. For the remaining 20% of these goods, you will say that you will show a recovery asset or an asset which you are expecting to recover from the customer, because these are not sales. So over here, revenue should be recognized to the extent the entity expects to be entitled to the consideration. So 80%, then you will recognize revenue to the extent of 80%. You will, for the remaining 20%, you will create a refund liability, and at the same time you will say that yes, I will have to pay the refund. However, I will also get those goods back, and hence you will create a recovery asset by a corresponding adjustment against the COGS. Okay, next you have warranties. There are 2 types of warranties over here. One is what you call as an assurance type warranty, which is highly interrelated with the goods. You are not selling those warranties separately, or a service type warranty, which is not highly interrelated goods with goods. You are planning to sell it as a separate service. So if it is a service type warranty, that is, you are selling it separately, you're not bundling it necessarily with the goods, then it is like a separate service. It's a separate performance obligation, and you will recognize the revenue on account of that service warranty as and when that warranty period is passing. However, an assurance warranty is highly interrelated with the goods, and as a result, you will not treat it as a separate revenue stream or a separate performance obligation. Instead, it will be highly interrelated with the product, and hence you will not record it separately. However, any expenses that are incurred for the purpose of that assurance type warranty, you will create a provision for that expense to be incurred for meeting the assurance type warranty. So over here, when you look at warranties, if the customer has an option to purchase separately, it is treated as a service type warranty. If it does not have an option to treat it, purchase it separately, it is like an assurance type warranty. So if you go to see, in case of a service type warranty, you have 2 performance obligations, one for the product, one for the warranty. But in an assurance type warranty, you'll have only one performance obligation, that is a product. Okay, next you look at revenue. You will recognize revenue for a service type warranty as and when the service is rendered. For assurance type warranty, you do not recognize any separate revenue. For a service type warranty, you will recognize expenses as and when the expenses are actually incurred during the warranty period. But in a assurance type warranty, you will create a provision for these expenses. So this is a slightly important discussion when it comes to warranties. Next, we have a fairly detailed discussion on what we call a significant financing component. So usually what happens is, when you are, let us say just a second, when you are selling goods, there may be a time gap between the time the consideration is received and the performance obligation is discharged, that is, goods are delivered. Usually they will go hand in hand. Like a cash sales, you will give the goods and you will receive the money. However, if there is a time gap, it is possible that you give the goods and money is received later, like a credit sale, or money is received in advance, like an advance collection, and goods are delivered later. If the gap is more than 12 months, the standard believes that there would be a significant financing component. If a significant amount has been received or has been delayed, there would be a significant financing component, in which case you will recognize revenue based on, let us say, the present value, or the revenue will be recorded based on what you are expecting for the goods per se. For the time value adjustment, if money is going to be received later, then I'll probably recover some finance income. Or if the money is received early and I'm going to give the goods later, then there may be a hidden interest cost. So you'll have to make that interest adjustment. The hidden interest adjustment is to be made if the gap is more than 12 months. However, will I have to make that adjustment always? The standard says no. There are 3 exceptions given. Sometimes the gap of more than 12 months is for a reason other than time. Like there may be some performance guarantee, or there may be some other reasons like retention for early or timely completion. why you are delaying beyond 12 months, in which case there's no time value adjustment needed. Sometimes the payment is done at the discretion of the customer, like a prepaid card can be used whenever the customer wants. And third is if there's a sales based royalty, variable consideration like a sales based royalty, and you will not know how much to pay till the time the actual sales happen. In such cases, we would say that, well, the time gap, even if it is more than 12 months, is attributable to a factor other than time, in which case there will be no financing adjustment needed. However, if it is not attributable to any of these exceptions, if the gap is more than 12 months, then you will have to do the adjustment, and this adjustment will typically be done by calculating interest as a rate on a separate financing arrangement. However, if a separate financing arrangement rate is not available, then as a second preference you will take the IRR. Now remember, this hierarchy is different as compared to what you study in Ind AS 116 for leases, where under 116 the first priority was always given to the IRR and second was given to the separate financing rate. Here the first priority is given to the separate financing rate and the second priority is given to the IRR. So this is for a separate financing, and second, if that is not available, then you will look at the IRR. Again, a few exceptions. If they are covered by the exceptions, you don't need to do the time value adjustment. In case there's a non-cash consideration or a barter, if the barter lacks commercial substance, then there is no revenue recognition at all. You'll just adjust the inventory balances. But if the barter has commercial substance, then Ind AS 115 says that you will recognize revenue based on the fair value of the consideration that you are expecting to receive. Not based on the fair value of the goods given. It is based on the consideration. Revenue is based on what you are receiving. So the first preference is the fair value of the consideration received. And the second preference, if that was not available, is the standalone selling price of the goods given up. Remember, if the barter involves you giving your own goods, then Ind AS 115 will apply and not Ind AS 16, etc. And as per 115, the revenue will be measured based on the consideration that I am receiving. And if that is not available, then based on the goods given up. Okay. So there are a few examples discussed, and the last part over here is the consideration paid to the customer. This is relatively rare. Usually in case of a revenue transaction, consideration is received from the customer. But will you pay consideration to the customer? Yes, sometimes in an arrangement, you might have to pay consideration to the customer. If that consideration is paid for a distinct goods and service, then we will recognize the revenue based on the agreed transaction price, and for the distinct goods and service, up to the extent of fair value, you can recognize a cost. Like for example, advertising cost. So for you are selling goods to a customer, but the customer is also going to advertise your product, and hence you are also receiving money from the customer, but you are also paying for the advertising. If that advertising is a distinct good or service that you are receiving, then to the extent of fair value, you will recognize this expense for advertising. But beyond fair value, if you are paying anything, then you will reduce it from the transaction price. A more common case would be if there is no distinct goods or services that are received from the customer, in which case I will directly deduct whatever I am paying from the transaction price. So maybe I am selling some mobile phones to you for 100 rupees and you are charging me 10 rupees for some advertisement which I don't control. In which case I am saying that okay, I am getting 100 from you and I am paying 10 to you. So net transaction price is, let us say, 90. There is no distinct goods or services that I am receiving. Advertisement cannot be shown as a separate expense because you are not going to necessarily advertise for me. So over here, if there is no distinct goods or service, then you will deduct the entire amount will be reduced from the transaction price. But if there is a distinct goods or services and the consideration is less than or equal to fair value, then you account for the expenses separately. But if the consideration is greater than the fair value, then up to the fair value you record distinct expenses, and excess, if any, we will reduce from the transaction price. Okay. That takes care of step number 3. You go to step number 4. This is allocation of the transaction price. One needs to remember that the transaction price needs to be allocated in the ratio of the standalone selling prices. So how do you determine the standalone prices? Well, standalone prices is typically the observable price that at which an entity sells the goods or services. However, if the data regarding observable price is not available, then you can use certain valuation methods, like you can take the comparable companies and make adjustments if required, or you can look at your cost plus add a reasonable profit margin, or you can follow the residual, that is a balancing figure approach as well. But remember, the best way is to find the observable price. So usually the allocation of the transaction price to each of the performance obligation should be in the ratio of the standalone selling prices. However, there are even exceptions to this rule. There are two exceptions. First is in case of discounts, and second is in case of variable consideration. In these two cases, it is possible that you may not necessarily allocate blindly in the ratio of the standalone prices. Like, it is possible that there are 3 goods that you are selling. However, the discount can be more reasonably allocated to a relatively smaller bundle of 2 goods or services. Then you will first allocate the discount to that smaller bundle, and excess, if any, will be attributable to the larger bundle. Okay. This is for discounts. Even for variable consideration, ideally, your variable consideration, if it is for a particular performance obligation, it will be allocated to that performance obligation only. However, while doing so, one needs to be carefully evaluating and be sure that after all of these allocations, you should get an amount which an entity reasonably expects to receive. That principle should be followed. If not, then you will have to allocate in the ratio of standalone prices only. So over here, a residual approach, that is a balancing figure. If you are following that approach, one needs to ensure that while you are doing the balancing figure approach, you will first allocate the discount to all obligations to the extent possible, and then find the balancing figure. And second, once you find the balancing figure, you try to compare it with an amount that the entity usually expects to receive. It should be within the amount what an entity usually expects to receive. Okay. Now, a very complex case is if customer options for additional goods or services, like a customer loyalty point. What happens in such cases is when an entity sells goods, let's say it sells shirts, along with shirts, it is also going to give, let us say, certain loyalty points. So over here, against those loyalty points, a customer or a discount voucher, the customer can come back into the future and redeem those points or the vouchers, as the case may be. So at the time of initial sale, you have 2 performance obligations: one to give the goods, that is a shirt, and second is to give the points. So you will allocate it in the ratio of the standalone prices for the shirts as well as the points. You will somehow try to find the fair value of the points and allocate in the ratio of the fair value or the standalone prices. Your journal entry will be bank account debit, what you are receiving, to sale of goods because you have sold the shirts, to a customer loyalty point or a discount liability, CLP liability. So over here, why is it a liability? Because if a customer comes at a later date and demands, let us say, bags, against those bags, you are selling the bags, you are not going to get any money. He will redeem those points, and as a result, your entry will be CLP liability account debit to sale when those bags will be sold. So for the timing, you will create a customer loyalty point liability, which will be, let us say, utilized as and when the actual sale happens. While measuring this, one needs to consider various things: the probability of these points actually being redeemed, considering what the true material discount, if any, is. So let's say you have a 40% discount voucher to be exercised in 30 days. However, during the 30 days, there's a flat 10% discount going on. You cannot club the two, in which case the true discount is actually 30% only. So if you are measuring the discount voucher, it should be measured based on 30% only. So that is a few points that you need to remember. And last step number 5, is revenue recognition. You should recognize revenue as and when performance obligations are discharged, that is, control of the goods are transferred. Control can be transferred when the buyer can do what they want to do with the asset, or the buyer can prevent other entities, including the seller, from doing what they want to do with the asset. So if the control is transferred, revenue should be recognized, but control can be transferred in one of the 2 ways. Control can be transferred over a period of time, or it can be transferred at a point of time. So if the control is transferred over a period of time, then revenue will be recognized based on the stage of completion. But if it is transferred at a point of time, then revenue will be recognized as and when the control is transferred. How will you determine whether the control is transferred over a period of time or at a point of time? So the standard gives you 3 criteria. It says that if there's a simultaneous transfer, you are rendering service and the customer is getting benefit. You are rendering service and the customer is getting benefit. In which case, we will say that in case of this simultaneous transfer, the revenue recognition should be over time. But how do you know whether there's a simultaneous transfer or not? The standard over here says that you will have to see that if hypothetically, if the supplier would stop supplying these services midway, the new supplier will continue from where the old supplier left. Like in case of a gym membership of 12 months, after 3 months, if the existing gym closes, the new gym will provide services for the remaining 9 months, in which case there was a simultaneous transfer happening. However, in case of an audit assignment, if just before signing, if the partner decides not to sign and withdraws from the engagement, a new CFM will have to redo the entire work, in which case there was no simultaneous transfer happening. So first, for over the period of time recognition, you will recognize revenue over time if there was a simultaneous transfer of goods or services. Second, if the entity was doing some work on the customer's asset, like a renovation, etc., which was done, or a construction that was done on the customer's asset only, in which case the revenue recognition will be over the period of time, like you do for construction contracts in AS7. And lastly, if the work that is done by the entity has no alternative use, either because of legal stipulations, you cannot use it for someone else, or contractual limitations like this is very unique to this company only and there is no other benefit for anyone else. If there is no alternative use for the work being done, and secondly, you are entitled to compensation which is based on the work done plus a reasonable profit margin. If both of these conditions are fulfilled, then the standard says you don't need to wait till the time the work is complete, because you are entitled to a compensation which is based on the work done and including a reasonable profit margin, in which case you can recognize revenue over time. So one of the three has to be triggered. If one of these 3 points is actually triggered, then revenue recognition will be over time. The revenue recognition will be at a point of time if none of these are triggered. So if none of these points are fulfilled, then revenue recognition is at a point of time. At a point of time would typically mean when the legal ownership is transferred, risk and reward is transferred, etc. So there are these 3 criteria. You can review that. Now let us say we focus on the revenue recognition at over the period of time, in which case you will have to measure progress, because revenue recognition will happen at this depending on the stage of completion. So how do you measure progress? Your progress will be measured using an input method, that is cost incurred upon the total estimated cost, or an output method where you will probably take the fair value of the goods or services which are done upon the total fair value of goods and services. If nothing is given, we will follow the input method. However, if you have specifically been given a valuation done by an architect or a valuer, in which case you can possibly take the output method. If you take the input method, a few things that you have to remember is sometimes there may be abnormal cost or abnormal loss. Abnormal loss does not result in progress, and hence it should not be considered in measurement of progress for cost incurred calculation. Secondly, sometimes it is possible that there are certain costs that you are incurring, like let us say there is a building that you are constructing. In that building there's certain a major cost which is for, let us say, installing a lift. Now that is not a separate performance obligation, it is a part of the overall performance obligation, but you are not going to incur any specific thing. You are just going to buy the lift and get it installed, in which case you are not doing any major material work, in which case the standard says that you will try to split the input method, where you would say that if there are certain inputs that you are merely going to buy and install and you are not going to do any further work, and these are major items, in which case you will try to segregate the input method where you will recognize revenue for these items to the extent of cost incurred and do the stage by stage revenue recognition for the remaining cost. So over here, so this is a fairly important thing where you will say that when the cost incurred is not proportionate to the entity's progress, it is suitable to adjust the input method and recognize revenue only to the cost incurred. Like for lifts, there was a question, I recognize the revenue to the extent of cost incurred for these lifts. Goods do not represent a distinct performance obligation, like lift is not a separate performance obligation. Customer is expected to control the goods. So that is, the lift is going to be in the control of the customer, and cost of such goods is significant relative to the total expected cost, and the entity procures these goods from a third party and does not significantly involve in any designing or manufacturing work. Okay, further you will exclude the abnormal losses. Unused materials also are not consumed and hence they will not be considered into the stage of progress. If costs are incurred evenly, you can use the straight line method for working as well, and in certain businesses where you're just providing standby services, again you can recognize the revenue on a straight line basis. So these are various cases. If the control is transferred at a point of time, the entire revenue will be recognized at that respective point of time. Next, you will look at certain special cases like a sale and repurchase arrangement. If there's a sale and repurchase arrangement, or if there's a sale and repurchase option like a call option or a put option, in that case we will see whether the control of the goods is actually transferred. Like if there's a sale and there is going to be necessarily a case of repurchase, in which case we would say that, well, I am physically transferring the goods. However, if these goods are going to come back to me at a fixed price, that means the control of the goods are not transferred. The benefits of the goods are going to accrue to me only, and hence this is not a sale transaction. Rather, it can be taken as a loan transaction. If I am selling at 100, so-called selling at 100 and agreeing to buy back at 110, the additional 10 rupees is interest. And the 100 rupees is not a sale, it is like a loan. Instead of bank account debit to sales and then purchase account debit to bank, you will say bank account debit to loan, that is 100, interest account debit to loan, that is 10, and loan account debit to bank, that is 110. But what if I'm selling at 100 and then buying it back at 90? Then this is not a loan. However, then probably you are giving the asset out on rent, where 90 rupees is a deposit and 10 rupees is like the rental income that you are receiving in advance, in which case your general rental will be bank account debit, let us say 100, to unearned rental income, let us say that is 10, and to security deposit liability, which is 90. Over the course of the tenure, you will record lease income. So that is, let us say, unearned lease income account debit to lease income, and then security deposit will kind of be paid. So this is security deposit account debit, let us say, to bank. This is in case of a sale and a repurchase. If there's a repurchase option, call or put as a case maybe, then you will see if there's a significant economic incentive to exercise the option. If yes, your accounting will be same. If no, then you will treat it as a genuine sale, and then if required, you will treat it as an actual purchase. Okay, then there are a few other arrangements like a bill and hold arrangement. In case of a bill and hold arrangement, you are selling the goods. However, the buyer does not take delivery of the goods. In fact, he requires the goods to be warehoused with you for a significant period of time, in which case your performance obligation is delivering those goods as well as keeping a safe custody of these goods, in which case there's a hidden performance obligation for even the custody services, for which you will recognize revenue over time depending on the standalone prices. Okay, next you have license of intellectual property. So when you look at intellectual property over here, there are two types of services, or there are two types of licensing. There can be a licensing of what we call as a dynamic IP or a static IP. So if you are giving a IP license over 3 years, and the value of this IP can keep on change, like you are giving license to an active franchise of IPL, let's say like a Mumbai Indians, in which case, if let us say this is a functioning franchise, there might be some things that might happen, like as we speak today, there is a lot of negative publicity happening because of, let us say, the change in captaincy, the way it is handled, etc. That is taking a lot of toll on the value of the franchise. Now, I might be a company who is responsible for manufacturing shirts of that franchise. I will be exposed to that. I will be exposed to the positive and negative changes. If I kind of win, let us say, a league, there will be some positive impacts. Now, for the franchise, this can keep on changing. So the IP's value is changing, and I don't get control over the IP at a particular point of time, and hence the revenue recognition. If Mumbai Indians is giving a 3-year franchise contract to, let us say, Madura Garments to manufacture t-shirts, there is a dynamic IP involved. Mumbai Indians does not have a specific performance obligation for winning leagues, etc. However, it will keep on doing some work which can impact the value of this IP, and hence the Madura Garments does not get control of the IP at a point of time, and hence revenue recognition for Mumbai Indians will happen over a period of time. However, there can be a franchise which is defunct, like a Kochi Tuskers, and let us say it is quite popular in Kerala still, and if we are looking at, let us say, licensing that, now Kochi Tuskers is not going to do any work, and hence you get control over the IP as it exists as on a point of time, and hence the entire revenue will be recognized at a static point of time. So you have to see in license of intellectual property where you get the right to access IP, or you get a right to use IP as it exists at a point of time. A right to access IP if the entity is required or reasonably expected to undertake activities which can significantly affect the value of the IP, like dynamic IP. It exposes the customer to positive and negative impacts, and the activities of the entity are not performance obligation under the contract. If these three conditions are met, it's like a dynamic IP, in which case revenue will be recognized over time. If these conditions are not met, it is static IP, in which case revenue recognition will happen at a point of time. One needs to remember that IP over here, the value that changes would happen if there's a change in the functionality of the IP. Like mere advertising, etc. does not change the functionality of the IP. However, the actual change over here, mere advertising or routine updates, does not make the IP dynamic. An expected change in IP's value due to activities of the licensor makes the IP dynamic. There are a few problems. Again, there's a separate video on license of intellectual property, around a 30-40 minute video along with sums. If you want detailed understanding, you can actually refer that. Okay, then there is a special case in case of service concession like toll roads. So what happens is, if you are an entity who is responsible for constructing a toll road, the toll road is the government's asset. You are not going to get ownership of the toll road, and hence you cannot show it as a PP. However, there are two ways in which this asset can be operated. Either there is a EPC type of a contract, engineering, procurement and construction, where you will just construct the toll road, the government will give you money, and end of story. In which case, you are having a financial asset, a contractual right to receive a fixed or determined amount of cash, and hence a financial asset. Or the government says, I don't have money, but I will give you a license to collect toll for a period of, let's say, 30 years. In which case, you will get a license on construction, which is an intangible asset. So over here, service concession will not be a PP. However, if there's an unconditional right to receive cash, it's a financial asset. If it's a right to operate or collect toll, then it is an intangible asset. Okay, what if there is a contract modification? So we are done with the 5-step revenue recognition framework. Two special case. What if there's a contract modification? Similar to leases, if the contract modification is for additional goods or services which are distinct at the standalone price, it will be treated as a separate contract. So if the increase in scope, that is additional goods or services which are distinct at the additional standalone price, in which case, if both the conditions are fulfilled, you treat the additional claim as a separate contract. You will not change the existing. However, if they are not, if any of these conditions are not fulfilled, in which case you will treat it as modification of existing contract, and while treating it as a modification of existing contract, you will see that due to this modification, are there distinct goods or services? If there are distinct goods or services, what you will treat is termination of the existing contract and creation of a new contract. However, if there is no distinct goods or services, like it's a modification of a larger renovation contract where you are probably changing something, there's no distinct goods or services, in which case you will do what you call as a cumulative catch-up adjustment. That is, you will say that as per the modified terms, what is the revenue to be recognized till date minus whatever is recorded, and make the adjustment. So if one or none of the conditions are fulfilled, if the modified performance obligation is distinct from the existing, you will treat it as a termination of the existing and creation of a new. However, if the modified performance obligation is not distinct, then you will do what is called as a cumulative catch-up adjustment. And the last part over here is contract cost. Contract cost can be of two types. There's a contract acquisition or procurement cost and a contract fulfillment cost. So a contract acquisition cost is a cost that is incremental in nature, which will be incurred if you get the contract, which will not be incurred if you don't get the contract. So here the guidance is that if theoretically, if the parties to the agreement move away at the point of signing, will that cost still be incurred? We will say no. If they don't sign, cost will not be incurred. Okay. If they sign, the cost will be incurred. That is a contract acquisition cost, like for example brokerage. However, if the cost is going to be incurred, like traveling expenses, which is irrespective of you signing or not, in which case this is not a contract acquisition cost, and hence it will be taken to the P&L. Sir, but what if it is a contract acquisition cost? Then it is allowed to be capitalized and amortized over the contract tenure, provided the tenure is more than 12 months. If it is less than 12 months, then every cost is taken to the P&L. Further, contract fulfillment costs, these are costs which are to be incurred specifically to fulfill the terms of the contract. In this case, if these costs are covered under a specific standard, like computer under Ind AS 16 or a software under Ind AS 38, the accounting will be as per those respective standards. However, for certain costs like designing or something else, you will not, if you like data migration or testing, if you don't have a separate standard attached, then contract fulfillment costs will be capitalized under Ind AS 115 and again amortized over the expected contract tenure. Within this expected contract tenure, you will also include the expected tenure under the renewal period as well. So covered under other Ind AS, then you will account as per the respective Ind AS. Not covered under the standard, then you will capitalize. So basically, contract acquisition as well as fulfillment cost, if the contract tenure is more than 12 months, can be capitalized and amortized over the expected contract tenure, including the renewal period, which is expected to be exercised. So this is regarding the theory for Ind AS 115. Now if we can go to the questions over here. So let us say we go to the questions. A lot of these have been solved separately as well in a video which we have uploaded, I think, for the past exam questions of Ind AS 115, but otherwise we will refer a few questions over here and take this further. So let us go to question number 1. This is a November 20 question. It's a slightly tricky question over here. So you have a company who is selling some plastic buckets, and you have a price which is based on the volume. So there are 3 slabs on which price is given, and you are asked over here to show how the revenue would be recognized as per the expected value method. Point 1 says expected value method, point 2 says most likely value method, and point 3 says you pass the journal entry. So we'll first focus on how do you recognize revenue. So over here, considering a probability of 15, 75 and 10% for a sales volume of 9,000 units, 28,000 and 36,000. So basically if I go to see, your units can possibly be 9, they can possibly be 28 or they can possibly be 36. The price at 9,000 units would probably be 90 only, at 28,000 units will be 80 and at 36,000 units will be 70. So this will be your adjusted price. And hence if you want to find the total sales, remember there are all the three possibilities are there. So 9 into 90, that is probably 810, 28 into 80, that is around 2240, and 36 into 70, that is around 2520. So these are the three possibilities. And if you want to find the average sales, the probability has to be considered. This is a 15% probability, there's a good 75% probability, and last me there's a 10% probability. So if I look at the sales, this is 810 into 0.15 m plus, 2240 into 0.75 m plus, and 2520 into 0.1 m plus. If I total this is around 2053.5. So this is your expected value of sales. The question says expected value method. You can't just follow the expected value method for units. You'll have to follow the expected value method overall. And hence you would say, well, you know what, that is 20 lakh, I think 53,500 or something will be your expected value of sales. Now you have been told that assume that the ABC achieved the same number of units to sales during the year as initially estimated using the expected value. So you are using the expected value also for the units. So if I look at the expected value for the units, this is 9 into 0.5, 28 into 0.75 and 36 into 0.1. So if I go to see, that will probably, so this is 20,53,500 of sales and around 25,950 for units, which means if I want to find the selling price per unit, so this is divided by 25.95. So this is divided by 25.95, everything is in 1000, 2053.5 upon 25.95, and you get approximately 79.13 per unit. So considering the expected value method as done by the institute over here, you will calculate the selling price per unit at around 79.13, and in the first, let us say 10,000 units that get sold, you will receive, let us say 90 actually, and then the price gets adjusted, so your bank account will be debited. So this will be for 10,000 units, bank account debit 9 lakhs to sales, that is 79.13 into 10,000, that is 7,91,300, and the balancing figure will be shown as a contract liability. So if I go to see the journal entry over here, bank account debit 9 lakhs to revenue is 7,91,000 and to contract liability 1,08,700. Later, when you actually sell the remaining 15,950 units, this 15,950 units will be sold, and you will ideally get, you should have ideally got 80 rupees. So into 80, so you should have ideally got 12,76,000. However, you have already paid 1 lakh more, that is 10 additional for the 10,000 units, and hence there will be an adjustment. You will pay minus 1 lakh or you will receive minus 1 lakh, that is 11,76,000. But the sales would still be recorded as 15,950 into 79.13, and hence this sales would be 12,62,124. The balancing figure, you will adjust it against the contract liability. However, after all of this, your contract liability still continues to have some balance of 22,576. Now all the sales have been done, and hence whatever is remaining in the contract liability will be transferred to revenue. So contract liability account debit to revenue as per the expected value method. This will be booked and the entries will be recorded accordingly. Now this is a slightly more complicated part, the expected value method. The second version over here is to take the most likely method, in which case you will take the most likely output as well as the most likely revenue. So the most likely output over here is at 28,000 units because there's a 75% probability, and hence the most likely selling price will be 80, and hence at 28,000, if I were to say 28,000 is the most likely output into rupees 80, and hence 28,000 would be your expected units as per the most likely method, and 80 will be the price. So if I go to the second point, you would say that 28,000 units is the highest probability in the most likely method. So your total sales would be 28,000 into 80, that is 22,40,000. Your transaction price is going to be 80. Initially, if you were asked to pass the journal entry, you will say bank account debit 9 lakhs to revenue 10,000 into 80, that is 8 lakhs, and 1 lakh will be contract liability. Remaining you will recover, let us say I think 18,000 into 80, that is around 14,40,000. However, 1 lakh was additionally paid, so that will be adjusted. So this is bank account debit, maybe 13 lakh 40. To sales, you will record sales at 80 rupees only. So this is sales at 80 rupees. So 80 into the remaining 18,000, that is 14 lakh 40, and hence the contract liability will be settled. So there's no other adjustment. It is a fairly easy working if the contract liability was to be settled using the most likely method. And lastly, you are asked to pass the journal entry if the revenue is accounted for as per the expected value method. We have also briefly discussed what will be the case of most likely value method as well. So this is your question number 1 from the November 20 exams. Question number 2 is similar to past RTP as well as exam questions, but it is more from the study material. This is allocation of transaction price. Here you have 3 products and the total price is 1,20,000. However, if you go to see, it is said that the entity regularly sells products X and Y together at 50,000. If I go to see, there is a smaller bundle. X and Y together is having a total standalone price of 70,000. However, you are selling it together at 50,000. So there's a 20,000 discount. This 20,000 discount will be allocated only to X and Y. So over here, if I were to kind of look at the allocation, so in the first case, what if your total transaction price is 1 lakh? How will you allocate? We'll say that, well, 1 lakh, the total of standalone selling price is 1,20,000, and if your contract price is transaction price is 1 lakh, there's a 20,000 discount over here. This discount is almost entirely, or rather in this case entirely attributable to Y and Z. Don't blindly allocate it to X, Y and Z. It is allocable to Y and Z. So if I were to go to CB, we'll say, okay, there's a 20,000 discount which will be attributable 25:70. 20,000 discount which will be attributable only 45:70. So whatever is the discount element, so this is, let us say, 20,000 into 25/70 comes to, let us say, 7143, and 20,000 into 45/70 comes to, let us say, 12,857. So if I were to subtract this, the allocated transaction price for X, there would be no discount allocation, and hence the entire 50,000 will be a part of the transaction price. In case of, let's say, Y, you will have 17,857, and in case of Z, you will have 45 minus 12,850, I think 7, in which case this is 32,143. This is your allocation. So if I go to the first case, this is 50,000, 17,857 and 32,143. This is the allocation in case A. In case B, along with X, Y and Z, you also have a product alpha. So there are 4 products and the total consideration is 1,30,000. The standalone prices for alpha is highly variable and you are selling to different customers in a broad range, and hence you are not able to find the standalone selling price for alpha, in which case you can find the balancing figure, that is a residual approach. Determine the standalone price of X, Y and Z and alpha using the residual approach. So you will, before you take the balancing figure, you will first allocate the discounts. The discount over here is attributable to Y and Z, and hence this will be the case. However, ideally the total over here should be 1 lakh, but my transaction price is 1,30,000, which means the remaining 30,000 is attributable to alpha. Now this is within the range of what the entity usually charges for alpha, and hence this is a reasonable price. So over here, if I go to see, 30,000 is attributable to alpha. And the last case, the residual approach, if my total price is 1,05,000 instead of 1,30,000, and if I take this balancing figure at based on 1,05,000, the balancing figure over here is going to be 5,000. Now 5,000 is not what an entity reasonably expects to receive for alpha, and hence this method is inappropriate. In fact, you will now have to take some other method, somehow try to find the standalone selling price for alpha and do the allocation. That data is not available, but we can say with confidence in the third case that the residual approach is not appropriate in case 3. Okay, so this is question number 2. Third, you have this question on customer loyalty points. It does not come in the exam. However, it is an interesting question, at least from an RTP, which can come in your exam. So over here, you are a departmental store who is awarding 10 points for every 500 rupees, which can be discounted for further shopping. Now, each point is redeemable within 3 years and the value of the point is 0.5. So over here, for every 500 rupees, you are allotted 10 points. And each point can be redeemed. The value of each point is 50 paise. Okay. So if I just look at this data and look at point A, they say how should the recognition be done for sale of goods worth 10 lakhs on a particular day? So if there are goods worth 10 lakhs which are sold on a particular day, what are your performance obligations? Sir, my promise is to deliver goods which are worth 10 lakhs, standalone selling price of 10 lakhs and points. Now these points have some fair value. So this is 10 lakhs divided by rupees 500. So if I look at 10 lakhs entirely divided by rupees 500, against this 10 points are allotted. So for 500, if there are 10 points, then 10 lakh divided by 500 into 10, that will be 20,000 points, and the value of each point is 0.5. So into 0.5, and hence this is 10,000. So 10 lakhs in lakhs, so this is 10,000. So it is 0.1 lakhs, let us say. Am I getting 10 lakh 10,000? Ideally, if I were to look at only points, I should have received 10,000 against the points and 10 lakh against these products. However, for both of them together, how much am I receiving? For both of them together, I am receiving 10 lakhs. And as a result, I will allocate the transaction price. So 10 lakhs will be allocated. So this is 10 lakhs into 10 upon 10.1, which is around 9,90,100 approximately, 9,90,100, and then 10 lakhs into, let us say, 0.1 upon 10.1 comes to around 99,000 approximately. So this is okay. If I look at these numbers, approximately you have found 9,90,100, and then this is 9,900. Sorry, not 99,000. This is 9,900. So your entry will be bank account debit. I am actually receiving 10 lakhs to sale of products. I will record at 9,90,000. Nice, sir, but I'm receiving 10 lakhs. No, that is towards the products that I'm delivering today, as well as the points. For the points, you will redeem this against future goods, and hence you will create a CLP liability. So you'll have a liability on customer liability program of 9,900. Okay, so this is for a notional sale of 10 lakh rupees. However, during the current accounting period, 17-18, the entity awarded 1 crore points to various customers, of which 18 lakh points remain undiscounted. So during the year, 82 lakh points were actually redeemed. They will be redeemed till 31st March 2020. The management expects that only 80% of the remaining points will be discounted in the future. This is the estimate which is available at the end of the year. This estimate probably was not there at the start. You have been clearly given that management expects that only 80% of the remaining points will be discounted in the future. So we will see what is to be done over here. So basically there are 1 crore points which are awarded. Now if you go to point B, it says, how should the redemption transaction be recorded in the year 17-18? The company has requested you to present the sale of goods and redemption as independent transactions. Total sales of the entity is 5,000 lakhs. So what is happening over here is you are probably selling products worth 5,000 lakhs. Standalone selling price is 5,000 lakhs. Against those 5,000 lakhs divided by 500 into 10 points into 0.5. So this is in lakhs. 5,000 divided by 500 into 10. As you can see, this is 100. 100 in lakhs, that is equal to 1 crore points, into 0.5, which will come to, let us say, 50. So the fair value of these points are 50. But is the customer paying me 5050? No, the customer is paying me 5,000 only. So if I have to find how much is allocated to the products, I will say that this is probably going to be, so allocation towards the products, if I go to see towards the products, it will be 5,000 into 5,000 divided by 5050. This will come to approximately 4950. And towards the points, this will be 5,000, let us say in lakhs, into 50 upon 5050 approximately, which will come to, let us say, 49 lakh 50. So basically this is your entry. Now you have created a liability. However, 82 lakh points have been redeemed, but this is 82 lakhs out of what? Well, we will say this is 80. So 18 lakh points remain undiscounted, which means 82 lakh points have been redeemed, but this is 82 lakhs out of what? Well, we'll say 1 crore. However, out of this total points, we can say that 82 lakhs has been redeemed out of a total of 82 plus 18 into 80%. The total points that are expected to be redeemed are no longer 1 crore. They are expected to be only 80% of the remaining points. So this is 82 upon 96.4. So we will say that your total liability was 49.5, which is to be spread over the points as and when they get redeemed. But now I am expecting only 96.4 points to be redeemed, out of which 82 have been redeemed, and hence 49.5, approximately 49.5 into 82 upon 96.4, that will be around 42 lakh 10,000 and something. This will be revenue to be booked, CLP liability account debit to revenue. So if I pass the entry, this will be CLP liability account debit to revenue, that is around 42.1 lakhs, which means if in your ledger you had around 49 lakh 50, out of which 42 lakhs has been booked as revenue. That means the remaining 49.5 minus 42.1, approximately 7 lakh and something will be your deferred revenue or customer liability point liability. So over here point C says what will be the deferred revenue. So we will say the deferred revenue will be the difference, that is around 7 lakh 39,000 or 7 lakh 40,000 approximately. Going forward in the next year, we have been told that in the next year, out of 60% of the outstanding points were 18 lakhs, out of which 60%. So 18 lakhs into 60%, which comes to I think 10.8 lakhs were discounted. The balance 40% of the outstanding points still remain outstanding. How much will be the deferred revenue to be recognized, and what will be the amount of the balance deferred revenue? We will now say that, see, your total CLP liability was 49 lakh 50. That had to be recorded, out of which 82 points were redeemed in the first year and another 10.8 points redeemed in the second year. So out of a total 96.4 expected to redeemed, this is the revenue that should have been recorded till date, minus earlier 42.11 has already been recorded as revenue. So this is a foolproof method. In this particular case, you can even take the shortcut, but this is like the foolproof method. So 49.5 into, let us say, 92.8 upon 96.4. So till date 47.65 should be recognized, out of which 42.11 has been recognized, and hence around 5.54 should be recognized as revenue approximately. So if you go to see over here, you will see 5.54 to be recognized as revenue. Sir, in my ledger, I have around 7.39, out of which 5.454 is recognized, and hence the balance in the deferred revenue 7.39 minus 5.54, this is 1.84. Now in the last year, irrespective of how many points are going to be redeemed, it does not matter. If points are not redeemed, I don't have to give any refund. So whatever is the balance in the CLP liability will be booked as revenue in the last year, irrespective of the points redeemed. So in the last year, this entire 1,84,000 will be booked as revenue irrespective of how many points are actually getting redeemed. Okay, so this is your question number 3. Next is your question number 4. It's a fairly detailed question, can be solved using multiple ways. If I go to see over here, you have a fixed fee of 1 million to develop a product. The estimated cost to complete is 9 lakh 50. So it's not an onerous contract. There will be an expected revenue or a gain of 50,000. The entity will transfer control over 5 years. It uses the input method, and there is an incentive award. So apart from the 10 lakh fixed fee, there is a variable consideration, which can be 0, which can be 1 lakh, which can be 2 lakh 50. The question says we have enough experience, and based on that, we can say, over here a lot of literature is given, but after that it is said that the entity is determined at 95% confidence that it will achieve the 10% performance obligation, and based on this analysis, you have been told that therefore the entity includes 10% award in the transaction price in calculating the revenue, because it has concluded that it is not constrained, in simple words, and hence in initial workings, you will say that your transaction price, if I were to determine the transaction price in year 1, 2, 3, till the time there is a change, the change happens in year 4 and continues in 5. So in this case, you will have 10 lakhs plus 1 lakh, that is your transaction price is 11 lakhs. This paragraph will tell you that later from year 4 onwards, you now believe that you will meet the 2,50,000 bonus criteria, and then you will change. This is 10 plus 2.5, this is 12.5, this will be your revised transaction price. Okay, so over here the entire 25% in year 4, because at this point it is probable that you will get that. So this is your transaction price. Now the cost, you are asked to evaluate the impact of changes in variable consideration. The cost over here is 50,000. If I want to find the cumulative cost, the cumulative cost over here will be 50, add 1,75,000, that is 2,25,000 is the cumulative cost. Then this is 4 lakh, so this is 6,25,000. Then you have another 2,75,000, so this is 9 lakh, and then ultimately 9,50,000. So basically you will try to find the stage of completion, cost incurred upon total estimated cost. So that is 50 upon 9,50,000, then 225 upon 9,50,000, 625 upon 9,50,000, and so on. So if I find the stage of completion, 5.26, 23, 65, 94 and 100. And the revenue to be recognized is revenue till date less revenue earlier recorded. So the revenue will be based on 11 lakhs into 5.26% for the first year, minus nothing was recorded earlier. In the second year, it is again 11 lakhs into 23.68% minus whatever was recorded earlier. So over here, if you go to see, your revenue to be recognized would be 5.26 less earlier recorded. This is 57, 2 lakh 2, 463. But when you go to the fourth year, you can take 12 lakh 15 to your workings less earlier recorded, and hence the impact of variable consideration changing will be considered in the fourth year separately. And similarly is the working for the fifth year. If you want to recognize the profit, you will take these revenues for each of the year minus cost incurred in each of the year, which will give you the profits. If you want to separately show the impact of the variable consideration, then in the fourth year, you will separately show the workings on what will be the total impact for the variable consideration, for which there is an alternative presentation that I have given below, which you can also review from a solving perspective. But in general, for question number 4, you will try to find the transaction price considering the variable consideration, which will be 1 lakh for the first 3 years and then 2 lakh 50 for the next 2 years. You will find the stage of completion and accordingly recognize the revenue. In the fourth year, your revenue recognized till date less earlier recorded will give you the cumulative impact. Question number 5 is a very interesting question where you are a company A who is manufacturing engineering machines and providing some after sales services. You are selling some goods to Mr. Anik to supply and install a model PI on 1st April 18 and to service the machines on 30th September and 1st April. So you are having 3 performance obligations. First is to sell the product. Second is the first service on 30th September. Next is the next service on 1st of April. The cost of manufacturing the product was 1 lakh 60. Okay, so this is the COGS which will be booked against the sale for the product only. Now, it is possible for the customer to purchase both the model and the maintenance service separately, and your Mr. Anik over here is contractually obliged to pay 4 lakhs on 1st April 19. So, he is paying the money after 1 year. So, there is a possibility that there is a significant financing component involved as well, because the product is sold, let us say, on 1st April 18. The prevailing rate for a 1 year credit granted to customers in the industry is 5% for every 6-month period. So, this is 5% for every 6-month period, and as per experience, for servicing cost is expected to be 30,000 for the first service, 50,000 for the second service. This is the cost of the service. We want to find the standalone selling price. Assume actual cost equal to expected cost, and A provides machine services to customers in a separate transaction, earns a profit margin of 50% on the cost, and on 1st April the cash selling price of the machine only is 251,927. So if I go to see the promised model are satisfactorily carrying out, you are asked to segregate the components of the transaction that A will apply to the revenue recognition criteria. Now there are 4 things. First, there is an obligation to deliver the product. So the standalone selling price, if I go to see for the model PI, is 251,927. This is the standalone selling price for model PI. This is discharged on 1st April 2018. Then for the first service, the cost is 50,000 plus a 50% profit margin. Sorry, the cost is 30,000 plus a 50% profit margin. So this will be 45,000. The standalone selling price expected for the first service. For the second service, this will be 50 plus 50%. This is 75,000 expected. So ideally, Mr. Anik should have paid us 251,927 plus 45 plus 75. They should have paid up 371,927. However, he's paying how much? 4 lakhs. Well, why? Probably because the remaining value over here, I mean, you will do that separately, but this is 28,073. This may be because there is a significant financing component involved. So over here, there are 3 main performance obligations, which is sale of machine, rendering of service, and then providing finance. And if I were to allocate the transaction price, we will do the workings, but this allocation would be in the ratio of the standalone prices. Now you can prove by preparing an amortization table. You will start with, let us say, 251,927, then record interest for 6 months. Then further, you will have, let us say, the first service, again interest for 6 months, then further the second service, and that will come to, let us say, 4 lakhs. As you can see over here, if you do the working, start at 251, record 5% interest, then another service. So your closing balance is 3,09,000. Further, record 5% interest for the next 6 months. This will come to 3,25,000. Then further give the second service, and hence that comes to 4 lakhs. And basically, if I go to see, the total over here is 28,073. That is attributable, let us say, to time. So the second part says calculate the amount of revenue which is allocated to each component. 251 towards the sale of the product to be recorded on 1st April 18. 45,000 towards the first service to be recorded on 30th September 19, 30th September 18, 75,000 for the second service to be recorded on 1st April 19, and the 28,073 to be recorded over the entire 12-month period. Prepare the journal entries to record the information in the books of A for the year ended 31st March 19. So basically, the journal entry would be, first, it will be unique account debit to sales only at 251,927. There's no other performance obligation discharge. And secondly, you will record the COGS for the cost of the goods, that is 1,60,000. Second, 6 months will pass by and hence you will record interest income, unique account debit to interest income. This is 12,596. Okay. Further, at the end of 6 months, you will render service. So this will be servicing cost account debit 30,000 to bank 30,000 and unique account debit 45,000, let us say, to servicing income 45,000. So that wise, unique balance increasing by further 45,000. Further, you will record interest for the next 6 months. So this is unique account debit to, let us say, finance income of 15,476. No further cost, and that's it. The year ends. Then at the start of the next year, you will render the service. So servicing cost account debit 50,000 to bank 50,000, and then you will also receive or record a receivable unique account debit 75,000 to sales or servicing income 75,000. So unique's balance now moves to 4 lakhs and you will receive money bank account debit 4 lakhs to unique 4 lakhs. So the last part of the question says, draft an extract showing how the revenue will be presented and disclosed in the financial statements for each of the years. So in the year 2019, you will have 251,927 to be recorded. Apart from that, 45,000 of servicing income to be recorded, and apart from that, 28,073 of interest income to be recorded. So this will be the revenue to be recorded in 2019, 18-19. In the year 19-20, it is only 75,000 of separately revenue to be recorded. So this is a fairly interesting and important question. We have just discussed this, the entire parameters. You should actually practice this because it covers everything: allocation of transaction price, finance income. So it's quite important journal entries. Okay, next you have question number 6. Now this is the only question where the institute has solved using the output method. Whenever it solves using the output method, you need to remember that revenue to be recognized is your overall revenue into, let us say, the stage of completion as per the output method. In the input method, the revenue recognition is based on the cost incurred, as well as the cost is obviously recorded based on the cost incurred, and hence there's a matching. But in case of an output method, the cost incurred may be different as compared to what is the revenue which is recognized. So it is possible that revenue is recognized only to the extent of, let us say, 30%, but cost incurred may be, the stage of completion may be different, in which case for the excess cost that is incurred, you call it as WIP. So if you are manufacturing certain, let's say, inventory, and to some of the parts you are selling, so that will be recognized as revenue. So the part which is unsold will be recognized as a part of work in progress. So Nivan over here has 2 long-term contracts. The first contract with A and company commences on 1st of June 18 with a total sales value of rupees 40 lakhs. Okay, so this is your total sales value. It is envisaged that the contract will run for 2 years. Expected cost will be 32 lakhs, and on 31st March 19, it is estimated that the total cost would now be changed to 34. So maybe there is some additional change in cost. Base of rectification cost, institute has not assumed this to be kind of an abnormal event. An independent survey has estimated on 31st March 19 that the contract is 30% complete. This is the sentence which kind of gauges and tells you that you have to follow the output method. And Nivan has incurred cost up to 31st March 19 of 16 lakhs and received payments on account of 13 lakhs. So if I just focus on Nivan per se, so what happens in case of Nivan, the revenue to be recognized is based on the stage of completion. So your revenue for Nivan would be, let us say, 40 into, as per the contract, as per the value, or 30%. So this is 12. Cost incurred should ideally be your total estimated cost of 34 into 30%. Matching concept. So COGS will be 34 into 30%, which is 10.2, and hence your contract profit based on the matching concept will be 1.8. However, if I go to see, is your actual cost incurred? If I go to see, you will even do it similarly for the other company, but if I go to see, is your actual cost incurred 10.2? No sir, your actual cost incurred is around 16 lakhs, has incurred cost of 16 lakhs, but out of 16 lakhs incurred, 10.2 is attributable to goods which are sold and revenue booked, which means the remaining 5.8 is attributable to the work in progress. So if I go to see the workings, you will see 1.8 as a contract profit to A and company, and then 5.8 is the WIP. Okay, so that is what we have to show. Secondly, you have been told that you received payments on account of 13 lakhs. Now ideally your entry should be debtors account debit to sales, so you should be receiving 12 lakhs, but have you received 12? No, you have received 13, and hence you have received an advance of 1. So if you go to see, ideally I should have received 12, but I have received 13, and hence 1 rupee received is an advance from the customer. If you understand this, you can pause and try the second one on your own. You should be able to solve it. It's a much more easier version. With B and company, you commenced, so this was with A and company. On 1st April for 18 months, the sales value was 30 lakhs, total cost was 24, payments already received is 9.5, cost incurred is 8 lakhs. Okay. However, you have been told that the surveyor measures a contract is 20% complete. So if I have to recognize revenue, my revenue will be 30 into 20%, that is equal to 6. From this I will subtract the cost. Cost will be total 24 of expected cost again into 20%, which will come to, let us say, 4.8, and hence the profit over here will be 1.2. But if I want to find the WIP, I will say my total cost incurred, I am saying, is 4.8 towards the goods sold. However, I am incurring 8 of cost. So 8 minus 4.8, that is 3.2, will be my work in progress. 1.2 over here will be my profit. Now ideally my revenue, based on my revenue, I should recover 6 from my customers, but how much have I collected? Sir, I have collected 9.5, which means the additional 3.5 is the advance that I have collected from the customer, and hence that will appear as an advance which is received from the customer in my liability. So if I look at my schedule 3 balance sheet, ultimately I will see a work in progress of 9 and I will see an advance from the customer at 4.5. Okay, this is the only question which pertains to, let us say, the output method. Next we have question number 7, which is pertaining to, let us say, something like a service concession. So over here, this is a company which is in infrastructure and it has 2 projects. One is the Bhilwara Jabalpur toll project. There's a lot of literature given over here, but you have been told that for this project the company has recorded an intangible. Okay, is it correct or not? We have been told, among other things, that the total cash flow guaranteed by the government under the concession agreement is 200 crores. So there is a guarantee that I'm going to receive a cash of 200 crores, and hence there should be a financial asset. To show it as an intangible is wrong. You can show it as an intangible if there's a toll road where you have the right to collect toll. This is not the case over here, and hence this is wrong. You should ideally recognize a financial asset of 200 crores as and when performance obligations are discharged. So let us say you don't do it on a year by year basis. If I look at the overall basis, what is told over here for this 200 crores, what is the breakup? Well, the fair value of the construction services is 110. So out of 200, I'm saying 110 is attributable towards construction. Finance revenue over the period of operation is 15. So over a period of time, 15 is towards income, and other income relates to services during the operation phase. So the remaining, if I go to see, I think probably 75 is income during the operation phase. So as and when I construct, my journal entry will be financial asset account debit 110 to construction revenue 110. As and when time passes, my entry will be financial asset account debit to finance income, let us say 15. And as and when I operate, my entry will be financial asset account debit to operating revenue 75. Corresponding to that, I will also recognize the cost at the time of operation, the cost of at the time of construction of, let us say, 100 crores. Okay, but to show it as an intangible is wrong. The institute over here has given you the entries on an overall basis. This is considering an overall project. So you recognize the construction cost and then 110 of revenue. During the operating phase, you recognize 15 as income, 75 as income, and at the end you will receive money bank account debit to financial asset. The second project is a Kolhapur-Nagpur Expressway, where with the government of Maharashtra you have entered another concession. The question over here very clearly tells you the said concession is a toll-based project and the company will need to collect toll from the users, which means this should be shown as an intangible asset, and it is shown as an intangible asset under IGAAP, which is correct. So over here you are rendering construction services, and in lieu of that services you are getting a license. So what is the fair value of those construction services? It is like a barter, where the fair value of the construction service is like 200 crores, in which case you are rendering the cost of construction may be 110, but you just tell the government, I'll pay you 110. Will they give you the license? No. They are giving you license in lieu of you doing the construction services, which is worth, let us say, 200 crores. So the value of the license is 200 crores. It will be intangible asset account debit 200 crores to construction revenue 200 crores. Further, there will be a construction cost of 100 or 110 to bank of 110. So over here, if you go to see for Kolhapur, Nagpur, this is construction cost account debit to bank, and then intangible asset account debit to construction revenue 200 crores. Now in the future, this intangible will be amortized over the entire period, and as and when toll income is collected, against that you will book the operating expense, the amortization of let us say this license, and you will record the toll income separately. Okay, so this takes care of the service concession. And the last question, this is pertaining to, let us say, modification. So over here what happened is on 1st April 21, you enter into a contract to buy with Corp Limited for heavy duty equipment for a consideration of 20 lakh rupees and a bonus of 2 lakh 50 if the equipment is completed within 24 months. So 20 lakhs is fixed, 2 lakh 50 is the variable consideration. At inception, S correctly accounts for the promised bundle of goods and services as a single PO. That's fine. At the inception, it expects the cost to be 11 lakhs. Okay, so it's a profitable contract, and concludes it is highly probable that a significant reversal in the amount of cumulative revenue recognized will occur, in which case it appears that this bonus is constrained of 2 lakh 50. Completion of heavy duty equipment is highly susceptible to factors outside the control, and hence when you determine your transaction price will be 20 lakhs only. 2 lakh 50 is constrained and hence will not be included. As at 31st March 22, S has satisfied 65% of the performance obligation on the basis of cost incurred. So this is 65% based on the cost to cost input method, and concludes that the variable consideration is still constrained in accordance with 115. So the revenue to be recognized will be 20 lakhs into 65%, which will probably be around 13 lakhs. However, on 4th June, the contract is modified with the result that the fixed consideration and the expected cost increase by 1 lakh 50 and cost by 80,000 respectively. So your fixed consideration is now going to be 21 lakh 50 and the cost are now going to be 11 lakhs plus 80, that is 11 lakh 80. The time allowable for achieving the bonus is also extended by 6 months, with the result that you now conclude it is highly probable that the bonus will be achieved and the contract remains a single performance obligation. So over here there is a contract modification, and if there is a contract modification, you will see that on account of this contract modification, are there additional goods or services at a standalone selling price? Answer is no. So you will not treat it as a separate contract, rather you will treat it as a modification of the existing contract. Is there a distinct service that you are going to give in lieu of that 1 lakh 50 or anything? Does not appear to be. It is a part of a single performance obligation, and hence you will have to do a cumulative catch-up adjustment. When you do a cumulative catch-up adjustment, you will take the transaction price based on the modified terms into the stage of completion, again based on the modified terms. Now based on the modified terms, your stage of completion is your total cost incurred. I think you have incurred a cost earlier. I think what was your cost incurred? 65%. So you must have incurred 11 lakhs, which was the expected cost, into 65%. Maybe you must have incurred 7 lakh 15 of cost. We don't know whether any further cost is incurred, but 7 lakh 15 of cost. Now upon a total of 11 lakh 80, it is no longer 11. Your expected cost is increasing by 80,000. So 715 upon 11 lakh 80, and in percentage you will have around 60.6%. So your stage of completion is 60.6%. that is revised from 65% because now you have more cost to be incurred. 11 lakh 80 is the total estimate, but then your transaction price will also be revised. Well, your fixed transaction price is 21.5, but there will also be a performance bonus which is now no longer constrained, and hence this will be what, 21.5 plus 2.5, which will probably be around what, I think 24. So this is 24 lakhs. We can say 24 lakhs, which is your modified transaction price, into 60.6%. So 24 lakhs into 60.6% comes to around 14 lakh 54,400 should be the revenue recognized till date, out of which earlier recorded would have been 13 lakhs, and hence a cumulative catch-up adjustment for 154,400 should be recorded. As you can see over here, there would be a 154,400, a cumulative catch-up adjustment to be recorded, because there's no distinct goods or services, and as a result this is an example on contract modification. So I guess that should be it. We have tried to discuss 6 of the most important topics over here. This alone, and with the questions that we have done with the most important questions, I know we have kind of discussed all the concepts, questions we have discussed in the time that we have. I hope I've been able to explain and give a very good refresher course to you. So I hope this really helps you. We will make a separate video as soon as possible for the other topics, for the other Ind AS. along with their important questions. So we are done with Ind AS 115, 116, share-based payment, financial instruments, business combination, consolidation, and joint venture. This alone would easily account for 50% of your paper, including the sums that we have covered over here are also all the important sums. Obviously, we have not solved like we do in class, considering the time constraints, but the adjustments, numericals to the extent possible, I hope we have managed to discuss. I hope this video has been helpful for you. Study well, study hard, and I'll see you soon with another video. Till then, bye bye, take care, and good luck. Please do like and press, that's a mandatory thing. Please do like and subscribe if possible, and I'll see you soon with the next video.